So hello everyone. So SFM, so main problem before starting our class. So let us discuss what is the problem with SFM. So the main problem with SFM is in old syllabus they used to ask one descriptive question for 16 marks. I mean 2 into 8. 2 into 8. I hope you are aware of old syllabus paper pattern. So even if you are not aware, so just follow me. So each descriptive question carries 2 into 8, 16 marks. So the time allowed per question. So what is the time allowed for 100 marks? 3 hours. 3 into 60, 180. 180 plus reading time, 15 minutes. Total time allowed, 195. So 195 divided by 100. 195 divided by 100, what is the time? 1.95. That means time allowed for 1 mark is equal to 1.95. 1.95 for 1 mark. That means for total 16 marks, what is the time allowed? 16 into 1.95. Can you please tell me the number? 16 into 1.95. 16 into 1.95. 31.2 minutes. That means earlier in old syllabus, the time allowed for one descriptive question is 31.2 minutes. And MCQ, each MCQ 2 marks and time allowed for MCQ. So 2 into 1.95, that is 3.9 minutes. Okay. New syllabus. Let us come to the new syllabus. In new syllabus, one descriptive question carries only 14 marks. So the time allowed per question is 14 into 1.95. So 27.3 minutes. Okay. And MCQ time same, because each MCQ carries in new syllabus also 2 marks and time allowed per MCQ 3.9 minutes. So the important point you have to keep in your mind is time allowed per question reduced by 3.9 minutes. Out of 7 questions, we have to write how many questions? 5 questions. Yes or no? Earlier also same, 5 questions, but 5 into 16. So now 5 into 14. Okay. Sir, earlier 80, now 70. What is the difference? Earlier also, the same question which was being asked for 8 marks, the same question they are asking for 7 marks. Are you getting my point? So we have to attempt how many descriptive questions? 5 descriptive questions. So that means our institute is giving lesser time for same content. So what is the less time? I mean, how much time is being reduced? 5 into 3.9. So 5 into 3.9 total 19.5 minutes. Okay. So that means the main difference between the old syllabus and new syllabus is in new syllabus the time allowed has been reduced by 19 minutes. So that's why if you have taken a feedback from previous students, old students, your seniors, they might have told you paper is lengthy. They found paper lengthy. Okay. Why I am highlighting this point? Because the reason you have to trust me till the end. That's why I am highlighting this point. Okay. So the time allowed has been reduced by how many minutes? 19.5 minutes. 19.5 minutes. That means if time reduced by 19.5 minutes means, that means you will be okay losing how many marks? At least 10 marks. At least what? 10 marks. How many marks the students getting? Students might be getting in SFM 45, 55 or 35. So this 10 marks will make a big difference. Okay. And even in MCQs also, many students they will ask me to upload MCQ. They will ask me to discuss MCQs on day before examination. Okay. So you might be thinking that, sir, in new syllabus they are asking 15 MCQs, but in old syllabus they were asked only 10 MCQs. Now they are asking 15. So there we can save time. No, in SFM we cannot save time in MCQs, because out of 15 MCQs, 10 will be problematic. And in problematic also, for example, sometimes they might ask you to find out a value of a call option using risk neutralization method. Okay, you may not be able to understand right now the risk neutralization method. That means sometimes in SFM they will ask you descriptive question as a MCQ. The question which has to be asked for 7 marks, they will ask for how many marks? 2 marks. Okay, so that means instead of 7 into 1.95 time allowed, instead of giving 7 into 1.95 minutes time, they will be giving only 3.9 minutes. So this is also a drawback of a SFM. Okay, SFM while doing you might be feeling comfortable. Okay, and for the past 3 attempts, I'm giving guess questions. Okay, so from 2 years I was doing marathon. Same questions students they are getting in examinations. Okay, same questions. So out of 50, okay, I'm giving 50 questions, and out of 7 descriptive questions, at least 4 they are getting exactly same. I'm saying exactly same. They're getting 4 questions. And in MCQs, they were able to get 10 MCQs. That means they should get 10 into 2 and 4 into 14. Yes or no? But still, students, they were not able to. I mean, few students, they were not able to do, because the reason is, the main reason. So if you observe our question bank, I'm giving 2 books, concept book, question bank. Yes or no? In question bank, I'm dividing questions into 2 parts, main questions and additional questions. Why I'm dividing questions into main and additional? Because the reason is, if you are writing both groups, you will be having only 8 hours of a time on day before examination. For suppose if you are writing both groups, okay, I mean single group, then also you will be having around 24 to 25. Okay, in SFM we have entirely 13 chapters. Enter how many chapters? 13 chapters. So covering entire syllabus on day before examination is a difficult task. So that's why I'm dividing questions into 2 parts, main and additional. In that main also, again I'm giving important questions. You can put any name. I mean important questions, guess questions, super 50, whatever the name it is. I'm giving important questions, expected questions in examination. Okay. Nothing but what are the resources I'm providing? Main questions, additional questions. And I will be giving CMA final past questions compiler also, soft copy. And CA final past question compilation also, that is also a soft copy. Okay. And MCQs a soft copy, multiple choice questions, soft copy. Okay. Total how many sources? Concept book, question bank, MCQ soft copy, and CMA final compiler, CA final compiler. 2 hard copies and 3 soft copies. Okay. So these 5 copies are being given for your satisfaction. But ultimately, even if you become perfect in 50 questions, okay, at last I will be refining and I will be giving only 50 questions. Even if you become perfect in those 50 questions, you will be able to score 70 marks for sure. Okay. So I'm giving these many sources because of, I mean, to satisfy you guys, that's why. Okay. So the point is, for suppose I'm giving how many sources? 5 sources. Will you be able to cover all these 5 sources? I mean 5 sources before the examination? No. You will not be able to cover all these 5 sources. Okay. To be honest, an average student will be able to cover, okay, an average plus hardworking student will be able to cover only main questions. Only main questions. He may not be able to cover main plus additional also. He will not be able to cover entire question bank also. An average plus hardworking student. Please note, a hardworking student will be able to cover only what? Main questions. Okay. And that too, he will be able to understand the concept. But I have highlighted one point. Time allowed per question reduced by 3.9 minutes. Here SFM, only understanding the concept or understanding the problem will not serve your purpose. That is not enough. You will be able to solve the practical question within the time. That means one 7 marks question must be completed within, what is the time allowed? 7 into 1.95. 7 into 1.95. That means you have to keep a timer, and you must try the 50 questions. You should check whether you are able to solve each question within 13.6 minutes or not. Just understand the concept is not sufficient. Because why I am stressing this point, because the reason is, last time I gave a guest questions, I mean for June 24 on day before examination. Many students, they were not able to do. I thought that okay, I gave questions just before the examination, so that's why they were not able to do. Of course, for regular students, I will be okay telling at the time of teaching itself what is the important question, something. For outsiders, I am saying. So this time for December 24, I gave important questions 2 months in advance. Still, few students, they were not able to do, because the reason is they were not practicing. Post COVID, so every faculty is providing a question bank with questions and answers. But pre-COVID, what? So we used to provide questions, and we used to solve what? Answers. But after COVID, what happened? We are providing questions and answers, so that's why student, he is not practicing. That is the main issue. So I'm requesting each and every student, whoever purchasing SFM classes, I'm not asking you to practice each and every question, but practice at least what? 50 questions. Okay, I will be mentioning in regular class which question to be practiced, which question to be referred, which question to be taken light. Okay, and okay, are you getting my point? So keep this in your mind. Time allowed per question reduced by 3.9 minutes. So that's why just understanding the concept and just understanding the problem is not sufficient. You must be able to solve the question within the time allowed. So you have to practice questions. Unless you practice, you will not be able to do. Okay. So for the first attempt, students they were not listening to me. They were not, they are going to examination without practicing. After seeing the question paper, they are finding, okay, this question, okay, I know, but they were not able to solve. But second attempt, they are not able, they are able to do, but already 6 months time wasted, no? So that's why again I'm reminding. So this is important point. Keep in your mind, you have to solve the question within the time. Okay. So if you think that, I mean, sir, for the past 3 attempts, okay. So you are telling that your questions have been asked in examination, guest questions. You can check. Okay. Already my video is available on YouTube. You can check what are the questions I have mentioned, whether they came in examination or not. You can check. For December 24, June 24, and December 23, you can check, and you can watch my marathon also. The questions discussed in marathon came in examination or not. You can check if you have a time. Okay. Otherwise, if you have a belief, then trust blindly. And the main problem is for CMA, I mean for final students, trust issues. Trust issues. CMA inter students, they will be joining some institute and they will be believing the faculty. Okay. So whatever they say, they will listen to the faculty. But whereas at final level, student will be having a trust issues, whether I can blindly trust this faculty or not. So why you have to trust a BCCA? I will give you a logic. Total there are 8 subjects and there are 8 faculties. Earlier I have taught SCM, SPMBV. You can go through my marathon also. But I have left SCM and SPMBV. Now I am focusing only on SFM. Why I am focusing only on SFM? Because the reason is I can have a sufficient time, I can make analysis how the questions are being asked, I can make a research. If one faculty teaches 2 or 3 subjects, then he cannot make enough research. He will be able to teach, no doubt. He will be able to teach concepts, everything. But he may not be able to analyze each and every, concept. So he cannot make a research. At the same time, he cannot support till the examination. Our agenda is to support the student till the examination. So that's why, so the solution to this lengthy papers is, our classes will be in 3 stages. First stage, regular classes. Regular classes. So regular classes comes around 120 hours approximately, and then exam oriented. Exam oriented, that comes around 45 hours, including MCQs and all. Okay. So we will be providing regular classes and exam oriented, and then marathon. So marathon 12 hours. Why we are recording 12 hours? Same questions. Whatever we discussing in regular classes, okay. So the same will be discussed in UO classes, but only few questions, important questions will be discussed, and only A category topics will be discussed. Okay. And marathon. And why these 3 stage model? Because keeping in view job holders, okay, homemakers, already married people, because in CMA final mainly job holders they will be okay, pursuing CMA final, and homemakers. So keeping in view, we will be providing classes in 3 stages: regular class, exam oriented, and marathon. People might be thinking that, sir, whether I can watch marathon directly or not. If you can watch marathon directly, if you can understand directly marathon, why do I teach regular and exam oriented class? Okay. Why we are providing 3 stages classes? Because reason is, in SFM, when you listen to the concepts like, for example, forex, first time you feel forex difficult, you may not be able to understand. If you are able to understand for the first time itself, that means you are extremely talented, not me. You are extremely talented. So that's why in regular class itself, while teaching forex, I will be repeating my class. After teaching for 10 hours, I will come again back to first problem, and again I will be teaching. And the same forex will be taught in exam oriented class and in marathon, because the reason is, in SFM some concepts you have to listen at least 2 to 3 times. Listening only once will not help you. Okay. So that's why 3 stages classes, not only SFM, every subject. So that's why, so we have one faculty for one subject concept. Okay. Every faculty. So we will be supporting till examination, regular class, exam oriented, and marathon. You have to blindly rely on these resources. Some students might come and say whether this material is sufficient or not. Okay, whether these 50 questions will be sufficient or not. That's why before believing, go through my December 24 guest questions, not only my SFM guest questions, go through SCM guest questions, go through SP, okay, cost audit, go through law, every super 50 questions, and whether they came in examination or not, do a research and then start believing this. Because main, some student will come and say, so question bank is volume is too less, whether this will be sufficient or not. Okay. That's why for outsider satisfaction only, I'm giving how many resources? 5 resources. Okay. I'm giving 5 resources just for your satisfaction. Okay. But you have to main focus. What is the main focus? Super 50 questions. You have to solve each and every question. Are you getting my point? So for every subject, the same method. So what are the materials? Color concept book, workbook, main plus additional questions. But you have to mainly focus on what? Not main also. If you have a time, that's okay, fine. Do not compare with others. So first you have to, okay, question yourself, how much time I can give for CMA final SFM? Okay, do not compare with others. You might be doing job, you might be married, okay, you might be lazy. First you have to question yourself how many hours you will be able to do, give. దో ఎగ్జామినేషన్కి ఎంత టైం ఇవ్వగలవు? Are you a hardworking guy? For example, I can spend only 6 hours a day for studies. So you should plan only for 6 hours. You should not compare with a student who is studying for 16 hours. Okay? And next is super 50 questions and details. Already Telugu classes are available. Okay? In Class Plus, I mean BCCA app. Now I'm going to record 100% English classes. Already 100% English recorded classes are also available. So now, then if you are looking for latest recordings, then these classes will be made available as and when recorded. So you can attend face-to-face classes at the rate Hyderabad, live class or recorded classes. Okay? So these are the details. So now let us come to SFM syllabus. Okay? If you have any doubt regarding batch, you can ask me. Otherwise, I will discuss the syllabus. What is the syllabus? Okay. So first, the syllabus. Total we have a 13 chapters. How many chapters? How many chapters? 13 chapters. Total we have a 13 chapters. See our syllabus. 13 chapters. So first chapter, I mean in study material, CMA final study material, you might find 17 chapters. Okay, you might be thinking I'm skipping 4 chapters, nothing like that. So I might have merged two or three chapters into one chapter. For example, portfolio management. Portfolio management. Okay, so this contains 2 to 3 chapters. So that's why CMA final study material order is different and our order is different. Okay, so as per our material, how many chapters? 13 chapters. See the topics. So first I will see the chapters and then I will say the A, B and C category. Okay, so first A category, first we shall see the chapters. What is the first chapter? Investment decisions, project planning and control. This is nothing but capital budgeting chapter. So already you have learned this chapter in CMA Inter. Okay, investment decisions. Second, evaluation of a risky proposal. Evaluation of a risky proposal. So this is similar to a capital budgeting. Okay, this is extension to the capital budgeting chapter. And third chapter, leasing. Third chapter, leasing decisions. And next, the fourth chapter, securitization, theory chapter. Fourth chapter, securitization, theory chapter. Security valuation, problematic, security valuation. Security analysis, theory chapter. Security analysis, theory chapter. Portfolio management, problematic. Mutual funds, problematic. Derivative analysis, problematic. Foreign exchange exposure and risk management, problematic. International financial management, problematic, plus they're asking one theory question. So international financial management, for the past 3 attempts, they have asked the theory question. They haven't asked practical question. Okay. Next, interest rate risk management, problematic, and digital finance theory topic. Digital finance theory topic. Okay. Am I clear? So total how many chapters? 13. Now let us discuss which is A category topic, B category and C category. Especially job holders who are purchasing my classes, listen to A, B and C category properly, because you may not be able to give much time. So that's why. Okay. So what is the A category topic? Two theory topics, obviously A category. That is fourth chapter, securitization, and 13th chapter, digital finance. These two are A category topics. Why sir A category? Because these two are theory topics, and if you see our concept book, okay, how many pages securitization? You can see securitization, how many pages? 4 pages, just 4 pages. Okay, only 4 pages. You will get compulsory one theory question, compulsory one theory question, and one MCQ. This time they haven't asked MCQ, but generally they will ask one MCQ and one theory question. That means 5 plus 2 or 4 plus 2. So 6 to 7 marks is the weightage of this chapter. This comes under A category because the reason is regular class duration of this chapter is just 1.5 hours. Okay, CUO class duration will be 45 minutes and marathon duration will also be 45 minutes. That means overall, including preparation, by spending 4 to 5 hours, we can score how many marks? 6 to 7. That means if you are not able to solve, practical question, then you can choose this theory question. Okay. And next, digital finance. Digital finance also comes under A category because the reason is, once again, what is the reason? Same reason, less number of pages, less investment of a time, and you can get one theory question plus you might get 2 MCQs also. So this is also similar weightage, 6 to 7 marks, sometimes 8. It can go up to 8 also. You must give utmost priority to these two theory topics. Okay, am I clear? Done. Now next A category topic, portfolio management, practical. This is very, very, very important. SFM means it starts with portfolio management. If you are able to understand portfolio management, then mutual funds and derivatives you will find easy. Okay, very important. Portfolio management comes under what? A category. Mutual funds comes under A category. Derivatives comes under A category. Security valuation also comes under A category. Security valuation comes under what? A category. Done. So total how many chapters in A category? 6 chapters in A category. How many? 6. Okay, 6 chapters in A category, and in worst case, I'm expecting you to solve main questions from this A category in worst case. Okay, and important questions from other chapters in worst case. Okay, clear? That means main questions in A category plus important questions from other categories plus MCQs, that is sufficient to score 60 to 70 marks. Perfection is important. Okay, next come to B category. B category, evaluation of a risky proposal, second chapter. Evaluation of a risky proposal, second chapter, comes under B category. And next, Forex, foreign exchange exposure and risk management, comes under B category. Why B category? From Forex you are getting 2 questions. You will be getting 2 into 7, that is 14 marks plus MCQ. You might get 1 to 2 MCQs. That means overall weightage is 14 plus 2 plus 2, 18, around 18 marks. Then why sir B category? we're getting around 16 to 18 marks, then why you are mentioning forex as a B category? Because the reason is, compared to the A category topics, understanding the forex is little bit difficult for some students. Are you getting my point? Okay, you have to invest time to learning the concepts. Okay, so that's why I'm mentioning forex as what? B category. So I'm asking you to solve at least what in forex. You must understand that Super 50 questions from Super 50. IFM B category. You will get one theory question. But why I'm mentioning it as a B category? Because you have a lot of theory. So that's why. Interest rate risk management comes under B category. In new syllabus, no question was asked till now. So evaluation of risky proposal, B category. Foreign exchange exposure, what? B category. IFM, B category. Interest rate risk management, B category. Okay. So in A and B, I can give sure short guess questions. Okay, A and B. But I cannot give sure short questions for C category. For example, what are the C categories? Investment decision, project planning and control. This comes under C category. Sir, why capital bursting comes under C category? You will get one 7 marks question and 2 marks MCQ, 9 marks. So 9 marks. Why you are mentioning it as a C category? Because the reason is, even if after solving all the main plus additional questions in our book, you might get a new question in examination. We cannot predict the question. Okay, even if you prepare 100 questions in examination, they might ask you one question, but not in portfolio management. In portfolio management, I can guess questions because including CA final and CMA final, there are the same concept and the same model will be asked. Okay, in capital bursting, but in capital bursting, by learning a concept, you will be able to attempt the question. Okay, because you know the concept of NPV, IRR. Okay, after learning all the concepts, you will be able to what? Attempt. I'm not sure that you will be able to solve 100% correct that question. So that's why that comes under what? C category. Leasing comes under C category. Leasing also you will be getting only one descriptive question, 7 marks. No MCQ will be asked from leasing. And what is the next topic? Security analysis. From security analysis also you will be getting only one MCQ. Only one MCQ. So that's why that comes under what? C category. And that MCQ also will be covered under past MCQs. Okay, that MCQ, past MCQ is getting repeated. So that's why security analysis comes under what? C category. For example, if you observe the C category, security analysis weightage 2 marks. Security analysis weightage what? 2 marks. And leasing weightage 7 marks. Investment decisions weightage 9 marks. So 9 plus 18. So 3 chapters 18 marks. So our total examination paper will be for how many marks? 128. If you remove 18 from 128, still you have a 110 in your hand. Okay. So B category. What is the weightage of B category? Forex 7 plus 7 plus 2. Total 16 marks. And you will be getting one theory question from IFM, 4 marks. So 16 plus 4, 20. Evaluation of risky proposal. Evaluation of risky proposal, you will be getting 7 plus 2, 9. So total? Total how many marks? 20, 29. If you remove 29 from 110, then still how many marks? 81. Okay, are you getting my point? Okay, if you become perfect in this A category topics, you will be able to attempt perfectly how many marks? 81. And I can expect questions from forex also. So you must be able to do at least important questions given by me from forex. Okay, so that is what I am expecting. So A category, B category and C category. So now once for all, let us discuss what you have to focus first. Worst case scenario, I am expecting what? Super 50. Super 50 questions, important questions. Worst case scenario. If a student is not having a time, okay, so then at least I am expecting super 50 or to solve each and every question. Okay. Sir, I have time. I'm hardworking. I can give more time. Then A category main questions. A category main questions plus MCQs plus super 50. Are you getting my point? Okay. I'm telling you the order based on your time availability. Just okay. So follow this order because students will be asking preparation strategy for SFM on day before exam. Once for all, I'm telling you now, regular students. So you cannot ask me. Outsiders can ask me the preparation strategy, but you cannot ask me because the reason I'm providing now itself. So follow this order. First one, super 50. Okay. For example, on day before examination or 1 month before, you feel like giving up the attempt, then just remember me. You have no time. Okay, due to some unforeseen circumstances, you have wasted your time. You have only 15 days time or 1 month time or 10 days time. Do not give up your attempt. At least solve how many questions? Super 50, 50 questions and go to examination. Do not give up. Okay, you might get fever, something can happen. So family issues, whatever may happen. So do not give up your attempt. Believe me, if you become perfect in super 50, then you are definitely going to clear SFM. You can score 60 marks easily. Okay. No, if you have no problem, your preparation is going well, that's fine. Then A category main questions. In question bank, I am dividing questions into main plus additional. A category main questions plus MCQs plus super 50. Okay. For suppose, okay, you sit for 12 to 16 hours, I mean, even more hard working. Then A plus B main plus MCQs plus super 50. Okay, clear? Then fourth, A plus B plus C main plus MCQs plus what? Super 50. So if you have still time, then A, B, C main MCQs super 50 and then CMA compiler past questions. What CMA by? CMA compiler. Clear? And the order is super 50. Actually, the order is super 50, A category, B category, C category main questions and CMA final compiler. Sir, I have time. Then go for A, B, C main plus what? MCQs plus super 50 plus CMA and CA compiler. CMA and CA compiler. Okay. And next seventh. Okay, if I was still time, you are hardworking, then you register for CA also. Do CA final. Okay, do CA final. If you have a time, even more time, then apply for civil services and write civil services examination. And then you have still time. Then come to main question. I mean additional questions. Come to additional questions. I mean additional questions is your last priority. Okay, if anything is important from additional, then I will be discussing in class. Okay, otherwise what? Additional questions, that means if you are able to, if you have a time to solve additional questions, that means you are extremely talented. You just shall not restrict to CMA. You have to become a CA, you have to become an IAS officer. Okay, so that's why before going to additional questions, just question yourself, am I perfect in these questions or not? And the main important point, whether you will be able to cover all these resources on day before examination or not. That is very important, because students forget about day before exam. If you are writing both groups, especially if you are writing both groups, you will be having 8 hours of time. You will get confused what to focus, what to try. Then they ask me important questions. Instead of that, from the beginning itself, just focus on what? Important topics, important questions. Are you getting my point? Okay. So writing exam on day before examination, that is very important. So covering these many topics is not possible. Okay. So but still some students might think I have to do everything. So that's why I'm writing. So these are the resources. So if you are a student like me, then you should focus on second. Like me means if you can give only 6 to 7 hours, 8 hours, effective hours. I'm telling you effective hours, because some students will be sitting in study hours and thinking, I'm doing the right thing or not, why I came to CMA, when should I get married. They will get random thoughts. Okay, so that should not be considered. You should count only effective hours. If you are able to study only 6 to 7 hours daily, then you should focus on what? Second. What is the second one? A category main questions plus MCQs plus super 50. MCQs plus what? Super 50. Done? Clear? సో అర్థమవుతుందా? మెయిన్ పాయింట్ ఏంటి? ఎగ్జామ్ ముందు రోజు టైం సరిపోదా? సరిపోదు. మీరు అనుకోవచ్చు, సార్ ఐ హ్యావ్ ప్రిపేర్డ్ ఫర్ 3 to 4 months, సో I will be able to write examination even before, I mean even without revising concepts before examination. No. For example, I have taught CA Inter FM classes, I mean 3 years back. Recently I haven't taught the CA Inter FM classes, but from December 26 I want to take CA Inter FM exam oriented class. Will I be able to go to class directly? No. So more than 50 times taught class to the students earlier, 2 years back or 1 year back. Okay, 2-3 years back I have taught CA Inter FM. Okay, at least 50 to 60 times, sir. More than 50 to 60 times I have taught and I have revised the concepts. Okay, now my question is, for December 26th class, will I be able to go to class without revising or not? No. Being a faculty, after revising 50 to 60 times also, I have to revise before going to the class. You are a student, I'm having only FM or AFM or SFM. You are having 8 subjects. Will you be able to revise 50 times? No. At most you will be able to revise 3 times. That means on day before examination, you have to revise for sure. So you cannot cover all these resources. That depends upon individual, I mean, person to person that changes capability. So that's why question yourself. You comes under which category? How many hours you will be spending? Are you a positive minded person or negative minded person? Okay. Because in CA and CMA, mostly people are negative. If you're writing both groups, someone will come and say, you're writing both. How can you clear both? Okay. If you're writing group 3, someone will say, clearing group 3 is not that easy. Clearing both is easy, but clearing only group 3 is not easy because you cannot get aggregate. Somehow negative feeding will be done. So that's why you have to consider all these calculation and you have to choose from the beginning itself restrict. Okay, you come under which category? So first, second, third, or fourth, or fifth, you have to choose now itself. If you are writing both groups, you should restrict to what? Second or third. Second or third. If you are writing both. If you are writing both groups, you should restrict to second or third. That's it. Okay, if you are writing single, then at most you can go to what? 4. This is my recommendation. This is my recommendation. You can go up to what? 4. Okay. So what about 5 and 6? At most 6 verse 6. But I would not suggest you to solve additional questions. Then why you gave in material? Already I told you. You are paying money. Okay. So something 900 rupees or something you are paying. So you will be expecting, okay, at least if a volume is less, you will not be considering me as you will not consider me as a faculty. So that's why I gave main and additional questions. So clear? Okay. So in next class we shall start SFM syllabus. I hope you got a clarity. Any doubts, Ishwar? దీని గురించి ప్రిపరేషన్ గురించి నీ పేరేంటమ్మా? కామేష్, యశస్విని, మీకేం డౌట్ ఉందా? మీకు అర్థమవుతుంది నేను చెప్పేది? నేను ఎందుకు ఇంత ట్రై చేస్తున్నానంటే మెయిన్ రీజన్ ఇన్నిసార్లు చెప్పిన ఆఫ్టర్ సేయింగ్ దీస్ మెనీ టైమ్స్ స్టూడెంట్స్ వాట్ దే ఆర్ డూయింగ్, దే ఆర్ రిలయింగ్ ఆన్, okay, they are coming under 6th 7th category. What is the 7th one? Additional questions. And they were not able to solve in examination because you cannot practice. You cannot practice. First you have to restrict the boundary. If you keep on, okay, adding the questions, then you cannot what? Practice. So that's why you have to understand the concepts and restrict yourself to a super 50 main questions from A category and B category. That would be more than enough. And MCQs. And in MCQs, I will not say you will be able to get 15 into 2 30 marks after listening to the class. You will be able to get at least 10 into 2. Worst case, you will be able to get 10 into 2. Okay? Clear? Done? So we shall meet tomorrow. Tomorrow I will start class. And generally final students will not come to class regularly. Okay, so my least expectation is you should come to at least what? A category, B category. That is what I am expecting. You should come to class at least for what? A category, B category, and then solve each and every super 50 question. That is my least expectation. Clear, Ishwar? Thank you. So what are the A topics? I mean A category topics. So this is our class 2. So in first class we discussed what is the problem with SFM, and we are seeing the topics A category, B category and C category. Okay. So now once again I am reminding what is the problem with SFM? Time. So the time allowed was reduced by how many minutes? 19.5 minutes. So that's why we have to practice each and every question. So I can guess questions for June 25 also, but whether you will be able to do or not, that depends upon your practice. Okay. So I would recommend you to practice each and every super 50 question to score 60 or 70. Okay. So what are the A category topics? Portfolio management, mutual funds, derivative analysis, securitization, digital finance, security valuation. Security valuation. Okay. What are the B category topics? Forex, international financial management, interest rate risk management, evaluation of a risky proposal. So these are the B category. And what are the C category topics? Investment decisions, leasing decisions, security analysis. Security analysis. So last three are the C category topics. Okay. And so I have given you the order. In worst case scenario, for suppose if you are thinking of to give up examination, so due to lack of time, then at least okay. So focus on what? Super 50. For suppose you have a time 1 month before itself you have realized to prepare, then go for super 50 plus A category main questions. Okay. And check at least 2 to 3 times whether you became perfect or not. If you become perfect in super 50 plus main questions of A category only, then only you go to what? Okay, so B and C category main questions. Of course, you have to do super 50. You will be doing super 50 questions from B and C category also. Okay. But once again, I'm warning you and reminding you, check at least 2 to 3 times whether you become perfect or not. Once you become perfect only, then move on to B and C category. Of course, under B category, you will be doing what? Super 50 important questions. Okay. So I've given you the order, follow that order. So based on your time, if you're writing both groups, writing both groups, then you have to restrict yourself to A and B category. Okay. So the main important point is you have to, consider time before examination. On day before examination, you will be having 8 hours. If you are writing both groups, if you are writing only one group, then 24 hours. Keep that time in your mind while preparing. Okay, now you will be having enough time. But on day before examination, you will be having only 8 hours to 24 hours, depending upon your, groups. Okay. So keep that in your mind. Now, before proceeding to SFM, strategic financial management, let us start with time value of a money. Time value of a money. So time value of a money, you won't find it in question bank or a concept book, but that is very important. So without having a knowledge of time value of a money, you cannot understand SFM, because this time value of a money concept is relevant for investment decisions, evaluation of risky proposal, leasing decisions, security valuation, derivative analysis and valuation. And even in Forex also we use the time value of a money. So the time value of a money concept is very important. Okay. So now let us start time value of a money. 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 Okay. So this time value for money concept is very important from SFM, point of view, as well as to take a crucial decisions. Okay. In life also, this is very important. Time value for money. Okay. So whether there is a time value for money or not, that means money value will change depending upon a time or not? That is the question. Yes, money value change depending upon a time. Okay. So for example, so what is the concept? Time value of a money. So time value for money, this concept is very important. So why it is important? So from SFM point of view, it is important. At the same time, in life also, after completing CMA, you might get a job. After getting a job, next question is whether to buy house or take it on a rent. Whether to buy a house or take it on a rent. To take a decision, you must have a sound knowledge of a time value of a money. Okay. If you are taking a loan, what will be your EMI, equated monthly installment? To know that EMI also, you have to learn this concept, time value of a money. So what is this time value of a money? For example, if I have to give 10 lakh rupees to you, okay, whether you want the 10 lakh rupees as on today or after 10 years. If I have to give 10 lakhs, so let me know if I have to give 10 lakhs. You want that 10 lakh rupees as on today or after 10 years? You will be expecting as on today. Because if I give 10 lakhs as on today, you can make investment of rupees 10 lakhs somewhere and you can earn some return, yes or no? Okay. So that is the reason. For suppose you have to give 10 lakhs to me. Now, will you give as on today or after 10 years? You will be giving after 10 years. Why you will be giving after 10 years? Because the reason is, okay, what is the reason? Because there is a time value of money. Time value of money. Present 1 rupee will have a more value than the future 1 rupee. Present 1 rupee will have a more value than future 1 rupee. Okay. So always present 1 rupee will have a more value than the future 1 rupee. For example, as on today, for suppose, okay, for 1 rupee you might get one chocolate at least, small chocolate, eclairs, yes or no? But after 10 years, for the same 1 rupee, will you be able to get the same chocolate or not? You may not get it. For the same chocolate, you will be spending what, 5 rupees or 10 rupees, yes or no? That means to buy the same chocolate or same toothpaste or same Rapido ride, you have to spend more amount. Yes or no? That means which rupee is having a greater value? Present 1 rupee or future 1 rupee? Present 1 rupee is having a greater value. Okay. So this is based on a logic that bird in the hand. Bird in the hand is always better than bird in the air. Bird in the hand. Bird in the hand is certain. Okay, you can fry it and eat. Yes or no, bird in the hand. But if a bird is in the air, so that is uncertain. Whether you will be able to catch that bird or not, that is uncertain. So future 1 rupee is like bird in the air. Present 1 rupee is like bird in the hand. So there is a time value of a money. Present 1 rupee will have a more value than future 1 rupee. And the reason is, one of the main reason is, first one, risk. First one is risk. Uncertainty. What? Uncertainty. Uncertainty. So, future is uncertain. Yes or no? Future is always uncertain. Okay? So, future is always uncertain. A lender will charge interest from the borrower? I mean, lender will be charging interest on loan, yes or no? Why lender will charge interest on a loan? Because the reason is, if a lender is giving amount to the borrower, okay, borrower will be repaying in the future, okay. So now, why lender is charging interest? Lender is charging interest because there is a time value of a money. Present 1 rupee will have a more value than future 1 rupee. Okay. So why present 1 rupee is having a more value than future 1 rupee? Because the first reason is uncertainty, risk. For suppose, lender is giving money to the borrower. So, but there is a question mark. There is a question mark whether borrower will repay or not. Borrower may not repay for various reasons. So borrower may die, business may not do well, okay. Borrower may not be willing to pay. Borrower is having money, but borrower may not be willing to pay. So the point is there is an uncertainty, okay. So that's why, as there is a risk, there is a possibility of risk, means a possibility of occurrence of a loss. What is the meaning of risk? Risk means a possibility of occurrence of loss. If lender is giving money to the borrower, there is a possibility of occurrence of a loss. That means borrower may or may not repay. If a borrower makes a default, then lender will be incurring loss, yes or no? So this possibility of occurrence of a loss is known as risk. Okay. So as the lender is taking risk, he wants some return. So this is the basic fundamental. If risk increases, expectation of a return will also increase. Expectation of a return will also increase. Yes or no? So for example, a student who is doing a degree, BCom, CMA, okay. If you compare these two students, when compared to BCom students, CMA student is taking a high risk. When compared to BCom student, CA student is taking a high risk. So now the point is whether this CMA student or a CA student is taking high risk. As they are taking a high risk, they will expect what? High returns. Yes or no? So now the point is, if a risk increases, expectation will also increase. This is the basic fundamental. So that's why if a bank is giving a loan to a government employee, bank will charge less interest because here the borrower is a government employee. So there are less chances of making a default. If a bank is giving a loan to a private employee, then it will charge high interest. Why the reason? What is the reason? Because there is a comparatively high risk of default. So that's why bank will charge a high interest. For suppose if a bank is giving a loan to a person who doesn't have any financials, doesn't have any job, then it will charge even high interest. Okay. So that means if risk increases, expected return, required return will also increase. So the same you have came across in CAPM model, in CA Inter or CMA Inter. How do we get CAPM return? RF plus RM minus RF into beta. Yes or no? RF means a risk-free rate of a return. RM means a market return. Beta is the risk factor. Yes or no? So that means if risk increases, required rate of a return will increase. So this is the basic fundamental for SFM. Okay, so you need not by heart. You have to understand the concept. If risk increases, what happens? Required rate of a return will also increase. Yes or no? What is your expectation? Your expectation is 3 lakhs package or 12 lakhs package? 3 lakhs or 12 lakhs? 12 lakhs package. Obviously, you will be expecting what? 12 lakhs. Because the reason is you are taking a risk. When compared to BCom in CMA, there is a possibility of occurrence of a loss, high possibility of occurrence of a loss. Okay. So that's why. So the main reason, So why we charge interest when we give a loan is there is a risk, uncertainty. Uncertainty. Second reason, inflation. Second reason, inflation. Second reason, inflation. Inflation means a rise in price. Rise in price. Inflation. If inflation increases, okay, then interest to be charged will also increase. Okay, why? Because the reason, for suppose Ishwar, he wanted to buy a bike. He wanted to buy bike. Right now, even Activa price is around 1.2 lakhs. Yes or no? So Ishwar, he wanted to buy Ola bike. Of course, it is not performing well, right? So Ola bike, and the price of Ola bike is, let us say, 1.5 lakhs. Okay, right now. So now instead of buying Ola bike, he decided to lend this 1.5 lakhs to Allu Arjun. Okay, right now he's trending. So 1.5 lakhs. Now the point is, Allu Arjun, he agreed to repay that 1.5 lakhs after release of a Pushpa 3. Okay. Now the point is, Pushpa 3 released after 3 years, and after 3 years Allu Arjun repaid 1.5 lakhs to Ishwar with interest. Okay. Now the point is, after 3 years, Ishwar will be getting Ola bike for the same 1.5 lakhs, or he has to pay extra amount. Extra. Because there will be a rise in price, inflation. Okay. So if inflation is high in the market, then interest to be charged will also increase. Are you getting my point? Next, third reason for time value for money. Third reason, why do we charge interest? So while lending, we charge interest because there is a time value for money. Why there is a time value for money? Because the reason is there is a risk, inflation, and the third one, postponement of a present consumption. What postponement of present consumption? Postponement of present consumption. Postponement of present consumption. Am I correct? So what is this postponement of a present consumption? So in our example, Ishwar, instead of buying Ola bike, he is lending 1.5 lakhs to whom? Allu Arjun. Okay. So he gave 1.5 lakhs to Allu Arjun. So the next day, one girl came to Ishwar and asked we shall go out for date. Okay. Now Ishwar, he told, we shall go on bus. Okay. Now the point is, whether that girl will come to date or not, no. She said break up. Okay. So, or something. She left. So the reason is what? No bike. Okay. So after 3 years, Allu Arjun, he returned money and he bought Ola bike. So thereafter, another girl came and asked for a date and he went to a date. The point is, he postponed his, consumption of how many months? He can use the Ola bike, yes or no, for 3 years, but he postponed his consumption. So we all humans will prefer a present consumption or future consumption? Present. For suppose, if you have a chance to buy an Audi car, for example, if God comes to you and whether you want Audi car now or after 5 years, what do you say? You want Audi car now itself. After getting 8 years, what do you do with Audi? Yes or no? So the point is, you prefer what? Present consumption. For postponing your present consumption, you need premium. Lender is charging interest because the reason is lender is postponing his present consumption. So that's why he will be charging what? Interest. Are you getting my point? So these are the 3 reasons for time value for money, main 3 reasons. So there are other reasons as well. These are the main 3 reasons for time value for money. So this is the reason why So an investor, whether it is a lender or a stock market investor, whoever it is, will expect a return. Will expect a return. Okay? Are you getting my point? Now, slowly we shall start with concepts. So first we shall see with simple interest. You know simple interest. How to find out simple interest? Simple interest. Next, compound interest. In this chapter, we are going to discuss simple interest, compound interest, annuity. What is the concept? Annuity, and D, valuation of a asset. Valuation of a asset. So this chapter is very important because I will take time for this chapter. Later on, while discussing the other chapters, I will not discuss extensively. Okay. Simple interest, compound interest, annuity, valuation of a asset. Okay. So first a simple interest. A simple interest. Simple interest. Simple interest. Okay. So example 1, principal is equal to 1 lakh rupees, interest rate is equal to 10% per annum, number of years is equal to 5. Number of years is equal to 5. Okay. Number of years is equal to 5. Now the question is, what is the simple interest? So I hope you are aware of simple interest calculation. Every mother will be able to calculate simple interest because my mother and your mother might be a member of Dwakra group. Yes or no? They used to calculate interest. Simple interest is equal to PTR, principal into time into rate of interest. What is the principal here? 1 lakh into 5 into 10%. So what is the simple interest? 50,000 is the simple interest. 50,000 is the simple interest. Clear? So 50,000 is the simple interest. Done? So practically this is not relevant because nobody will charge simple interest. Okay. So next one, compound interest example. Same example but compounded annually. Same example but compounded what? Annually. Compounded annually. Okay, same example. What is the meaning of compounded annually? So meaning compounded annually means every year interest will be added to the principal. For example, what is the principal here? 1 lakh. That is for the first year. But for the second year, Principal 1 lakh plus first year interest will be the principal for second year. Okay, that means interest on interest will be charged. Compound interest, interest on interest. So compound interest, how do we calculate compound interest? Compound interest, so first I'm calculating amount A. Amount A is equal to P into 1 plus I power n. A is equal to P into 1 plus I power n. I'm not finding out compound interest directly. First I am finding out what? Amount. Amount means nothing but future value. Principal is the amount given as on today. Amount is the amount to be received in the future. So A is equal to P into 1 plus I power n. So that is equal to 1 lakh into 1 plus 0.1 power 5. So what is the amount? 161,051. Amount is equal to 1,61,051 rupees. Amount is equal to 1,61,051 rupees. Okay. So first you have to understand the shortcut. Okay. Before moving on to shortcut, let us find out compound interest. Compound interest is equal to amount minus principal. That is equal to 161,051 minus 1 lakh is equal to 61,051 rupees. Compound interest is equal to 61,051 rupees. Am I clear? Done? But you have to habituate the shortcut. Okay. What is the shortcut? So first, for finding out amount, always take interest rate first. So first take interest rate in the calculator. What is interest rate? 10%. Take 0.1. Okay. 0.1 plus 1 into 1 then equal to. So when you press 1 time equal to, you will get 1.1. Press again equal to 1.21. In some calculators this may not work. It's okay. So 1.21. First understand these numbers. So first you are taking 0.1 in the calculator. That is interest per 1 rupee. So 0.1 plus 1 into 1 then equal to you are getting 1.1. What is that 1.1? If you are lending 1 rupee as on today, then amount at the end of a first year will be 1.1. This can be called as a future value factor also. Future value factor. Are you getting my point? Future value factor. Press again equal to. Then you will get 1.21. So this is the second year future value factor. What is the meaning of 1.21? If you are depositing 1 rupee as on today, by the end of a second year that will be equal to 1.21. Press again equal to. You will get 1.331. This is the future value factor for third year. Press again equal to 1.4641. Press again equal to 1.61051. What is the meaning of this 1.61051? If you are investing 1 rupee as on today at the rate of 10%, then the value at the end of a fifth year is 1.61051. Am I clear? So the point is, but here we are not lending 1 rupee. We are lending what? 1 lakh. So that's why then multiply with 1 lakh. So the amount is 161,051. 161,051. Okay. So this is how you have to calculate. Why it is important? Let us say, for example, you might be taking a loan, then you have to take a decision. Okay. So let us say, for example, so what is the market interest rate? Market interest rate. I mean, what is interest rate prevailing in market? Practical, not personal loan outside. Generally, we depend on outside. 2 rupees per month. Yes or no? In calculator, take 0.02. Do understand what is this 0.02? 0.02 is nothing but interest per 1 rupee per month. If you are taking a loan at the rate of 2% per month, then what is the effect? Shall see. Okay. 0.02. Then add 1. Multiply with 1. Press equal to. You're getting what? 1.02. First understand this number 1.02. What is this 1.02? This 1.02 is, if you're taking 1 rupee, then after 1 month, you have to pay 1.02 after 1 month. Okay, this is very important because to take a decision, so keep this in your mind 1.02 and press again equal to 1.04 something. This is the value at the end of a second month. Now forget about the amount. So already you pressed how many times? 2 times equal to. Now count equal to until you get 2 rupees. I mean until you get 2 in your calculator. Are you getting my point? Thirty 35. For 35 months, you are getting 1.99. So that 1.99 is, what is the meaning of that 1.99? If you are taking 1 rupee as on today, after 35 months, you have to repay, so around 2 rupees. Nothing but, if you are taking 1 lakh rupees loan in 3 years, that will get doubled. Okay. So that is very crucial because the reason is, first suppose you have taken 1 lakh 12 years back. First suppose you have taken 1 lakh 12 years back. Then what happens? 1 lakh will become 2 lakhs in 3 years. That 2 lakhs will become 4 lakhs in 3 years. Yes or no? Next 3 years. And that 4 lakhs will become 8 lakhs in 9 years. And in next 3 years that will become what? 16 lakhs. That means if you have taken 1 lakh 12 years back, now you have to repay 16 lakhs. Are you getting my point? So, so this is very important because your parents might be taking a loan at the rate of 2% per month. If you are able to repay in 1 to 2 years, that's fine. But if you are not able to pay, then in 12 years, are you able to understand now? But suppose if you are taking a loan at the rate of 3% per month, 3% per month, then you have to take in calculator 0.03. 0.03 plus 1 into 1, count equal to until you get 2. 24 months. In 24 months itself, that is okay, becoming 2.03. Yes or no? Now the question is, if you have taken 1 lakh 12 years back at the rate of 3% per month, now in 2 years, 2 lakhs, next 2 years, 4 lakhs, next 2 years, 8 lakhs, next 2 years, 16 lakhs, next 2 years, 32 lakhs, next 2 years, 64. See the difference. If you have taken 1 lakh 12 years back, now you have to pay how much? 64 lakhs. Okay. So this is very important because some friend might come to you and ask you for interest. So he may agree to pay 10% per month. If it is 10% per month, in 10 months itself, it will get doubled. Okay. So the point is repayment of 10% per month interest is impossible, not possible. Okay. Clear? So this is how you have to find out what amount. So now, same example, compounded half yearly. Same example, compounded same example, compounded half yearly. Compounded half yearly. Okay. So now what is the calculation? Compounded half yearly. A is equal to, so first write down A is equal to 1 lakh into compounded half yearly means we should take half year interest. What is the half year interest? 0.05. Here n means not number of years, n means number of periods. So 5 years means 10 half years. So that's why 1 plus 0.05 power 10. So 1 lakh into 1 plus 0.05 power 10. So clear? So what is the shortcut? First you have to take 0.05 in calculator. Then add 1, multiply with 1. Press equal to 10 times. And then multiply with 1 lakh. What is the answer? 1 lakh 162,889. Obviously, compounded half yearly amount will be greater than compounded annually. For suppose if it is compounded quarterly, compounded quarterly. If it is compounded quarterly, then A is equal to 1 lakh into 1 plus 0.025 power. How many quarters? For 1 year, 4 quarters. For 5 years, 20 quarters. 1 lakh. What is the amount 1 lakh? 63,861. 163,861 rupees. 163,861 rupees. Clear? Done? So A is equal to 1 lakh into 1 plus 0.025 power 20. For suppose if it is compounded monthly, example. So need not write it. Let me know the procedure. If it is compounded monthly, then instead of 20, we should take what? Instead of 20, n is equal to how many months? 5 into 12, 60. Okay. Instead of 0.025, you should take 0.1 divided by 12. That is 0.00833. Am I correct? Need not be done. Okay. For suppose if it is 365 days, then n is equal to 5 into 365. Yes or no? And instead of taking 10%, we should take interest rate per day. If it is compounded daily. Are you getting my point? Okay. So before proceeding to continuous compounding, let us find out effective interest rate. Again, this is not relevant for SFM, but SFM or AFM. So, but to take a decision, effective rate of interest, we call effective rate of interest. Okay, what is this effective rate of interest? So, effective rate of interest is nothing but conversion of compound interest rate into simple interest rate. Okay, so in calculator, let us take 0.02. What is the 0.02? 2% per month. Nothing but compounded monthly. What is the rate per month? 2%. Take 0.02, add 1, multiply with 1, press equal to 12 times. Already 1 happened, press equal to 12 times. 1.268. Let us understand the concept. First, suppose if you are taking a loan at the rate of 2% per month, that means you are paying interest every month at the rate of 2%. You might be thinking that 12 into 2%, I am paying 24% interest. No, you are not paying 24% interest, you are paying more than 24. Okay. If it is a compounded interest, compound interest rate is 24% per annum. But if you convert it to simple interest, then if you're taking 1 rupee, you're paying 1.26 something at the end of a first year. So that means you are paying interest of 0.26, nothing but 26.4. You are paying 26.4% interest. So what is this 24 and 26.4? Okay. So if you see it as a compound interest rate, then you are paying 24% per month, sorry, per annum, compounded monthly. What is interest payable? 24% per annum, compounded monthly. 24% per annum compounded monthly is equivalent to 26.4 simple interest. So effectively you are paying how much interest per annum? 26.4. You are not paying 24, you are paying what? 26.4. Are you getting my point? For suppose, so if it is compounded quarterly, 24% per annum, compounded quarterly, then what is the quarter interest? 6%. So take in calculator 0.06. 0.06 plus 1 into 1, press equal to 4 times. 1.2624. That means 24% per annum compounded quarterly. That is equivalent to what? 26.24. Are you getting my point? First, suppose if it is compounded half yearly, then 0.12 plus 1, 0.12 plus 1 into 1, press equal to 2 times. 1.25. Nothing but what? Effective interest rate is 25%. Are you getting my point? Okay. So compounded quarterly completed. Then continuous compounding. Continuous compounding. Continuous compounding. What is this continuous compounding? So we have seen up to compounding quarterly. So compounded quarterly means nothing but what? Compounded quarterly. So compounded quarterly. So we are taken n is equal to 20. For suppose if it is compounded daily, then instead of 20 we should take what? 5 into 365. In that case we have to press equal to how many times? 5 into 365 times. Yes or no? For suppose if I mention you compounded every minute. Compounded every minute. Then that will become even more difficult. Yes or no? Compounded every second. Compounded every nanosecond. Okay. So we cannot apply this formula, that is A is equal to P into 1 plus I power n. In that case, if it is continuous compounding, then our formula is A is equal to P into e power TR. We use this concept in derivative analysis extensively. Okay. Amount is equal to P into e power TR. T means time. R means rate of interest. R means rate of interest. So what is the principal? 1 lakh into e power. What is the time? 5 years. Rate of interest? 0.1. So 1 lakh into e power. E means exponential. E power 0. What? 5. 1 lakh into e power 0.5. Okay. So clear? Now the point is amount is equal to 1 lakh into e power 0.5. How do we find out e power 0.5? Simple. E power x is equal to 1 plus x divided by 1 factorial plus x square by 2 factorial plus x cube by 3 factorial and so on. E power x is equal to 1 plus x by 1 factorial plus x square by 2 factorial plus x cube by 3 factorial. Okay. So here what is x value? 0.5. So e power 0.5 is equal to 1 plus 0.5 divided by 1 plus 0.5 square divided by 2 into 1 plus 0.5 cube divided by 3 factorial. How it is written? 3 into 2 into 1. Okay. In examination you have to do up to x cube. X power 4 is not required. Okay. If there is no time, then even x square is also okay. Fine. So what is the value? 1 plus 0.5 plus 0.25. So what is the 1 plus 0.5 plus 0.025 or 0.25? 1 plus 0.5 plus 0.1 plus 0.020. So overall 1.6, 1.645. So that is amount is equal to 1 lakh into 1.645, that is 1 lakh 64,500. So this is how we do a continuous compounding. Continuous compounding 164,500. Done. So 1 lakh into e power 0.5. Okay. So continuous compounding. For suppose if they mention 3 months, then What is the value of e power x? Instead of taking 5, t means time in years. T means time in years. If they mention 3 months, 3 months means nothing but 0.25 years. So 0.25 into 0.1, nothing but e power point, e power what? 0.25. Not 0.25, I think. E power 0.02. E power 0.025. 0.25 into 0.1. So e power 0.025. For example, if it is 3 months, then you have to find out the value of e power 0.025. If it is 6 months, then then e power 0.05. E power 0.05 if it is half year. Am I clear? So here t means time in years. Nothing but we should take overall interest rate. Okay, here the time is 5 years. So that's why we have taken 5 years interest. So 5 years interest is 5 into 0.1. Or suppose if it is 3 months, then we should take 3 months interest rate. What is the 3 months interest rate? 0.1 divided by 4. So 0.025. Okay, done. So this is what? Continuous compounding. Continuous compounding. Okay. So simple interest we completed, continuous compounding we completed. Next concept is annuity. What is the next concept? Annuity. Annuity means same amount at same intervals. Same amount at same intervals. Annuity means same amount at same intervals. For example, if you take a loan from bank, you will be paying equated monthly installment. So the installment you are going to pay every month will be same. And every month you are paying every month same amount at same interval. So that's why the installment paid to the bank is nothing but an annuity. Okay. For suppose if you are taking a loan from the private private lender. Okay. So if you're taking loan from private lender, what happens? You will take a loan and at the end of the first year, you will be paying interest plus loan. Is this an annuity or not? This is not an annuity. For suppose you have taken 1 lakh from the, Ishwar. For example, Ishwar gave 1.5 lakhs to Allu Arjun. Now Allu Arjun, he is paying every month interest. Every month he is paying 2% interest. Now the question is whether this is an annuity or not. Why it is not an annuity? No, that is not the reason. My point is Ishwar gave 1.5 lakhs to Allu Arjun. Now Allu Arjun is repaying 2% per month interest. Okay, what is the 2% per month interest? 1.5 lakhs into 2%. 3,000. So first month ending he paid 3,000. Second month ending he paid 3,000. Third month ending 3,000. Likewise he is paying same amount, same intervals. You might be thinking that this is an annuity. But this is not an annuity because the reason is at the end of a third year, Allu Arjun will pay 3,000 rupees interest plus 1.5 lakhs. Okay, 1 to 35 months, same amount, same interval. But 36th month, he is paying interest plus principal. So that's why this is not an annuity. Annuity means same amount at same intervals, whether it is a payment or receipt. So that doesn't make any difference. If it is same amount at same interval, then that is termed as what? Annuity. Okay. So for example, zero coupon bond. What is a zero coupon bond? I hope you are aware of zero coupon bond. Zero coupon bond. For example, if a company is issuing a zero coupon means zero interest. No interest will be paid. Generally, zero coupon bonds are issued at a discount and redeemable at face value, par value. Let us say, for example, par value 10,000. So BCCA, for example, issuing a zero coupon bond. So BCCA will issue a zero coupon bond to issuer at the rate of 6,000. At the rate of what? 6,000. So now the point is, at the end of a maturity, after 5 years, BCCA will repay 10,000 to issuer. Okay. So forget about the zero coupon bond. Zero coupon means zero interest. So that doesn't mean no interest is paid. So zero coupon means nothing but interest is not paid every year. Okay. So zero coupon bond issued by BCCA to issuer at the rate of what? 6,000. Nothing but BCCA is collecting 6,000 from issuer as on today and will repay 10,000 at the end of 5 years. Okay. So now the discount 4,000 rupees is the benefit to the investor. That is the cost to the company. Are you getting my point? Okay. So zero coupon, it indicates zero interest. Now the point is whether this is an annuity for the investor or not. For the investor, this is not an annuity because investor is not getting 10,000 rupees every year. First year, issuer will not get any amount. Second year, no amount. Third year, no amount. Fourth year, no amount. Fifth year ending, he will be getting what? 10,000. So this zero coupon bond is not a annuity. I mean, it is not paying any annuity. Zero coupon bond is not paying any annuity. So in market, companies will issue a plain vanilla bond. Plain vanilla bond. Plain vanilla bond means nothing but, for example, BCCA issued plain vanilla bond at the rate of 10%. 100 rupees bonds issued at the rate of 10%. What is the meaning of this? BCCA will pay every year interest. 100 rupees bond at the rate of 10%. Nothing but BCCA will pay 10 rupees to issuer at the end of first year. Second year 10 rupees. Third year 10 rupees. Fourth year 10 rupees. Fifth year 10 rupees plus redemption value 100 rupees. If a question is silent, then redemption value is face value. Like in Allu Arjun case, the same case. Likewise here also we are paying what? 10 rupees every year, but at the end of fifth year, we are paying what? Principal plus interest. Whether this is an annuity or not. Even in this case, this is not an annuity. This is not an annuity. Okay. Perpetuity bond. Perpetuity bond means continuous. For example, BCCA issued perpetual bond. 100 rupees bond at the rate of 10%. What does it mean? Company will pay 10 rupees interest every year forever. This is an annuity. Equal amount at equal intervals. Okay. There is another bond, annuity bond. So annuity bond name itself indicates company will repay the bond every year annuity. BCCA will pay annuity to the investor every year same amount. Nothing but like we pay equated monthly installment to the bank. So same likewise BCCA will pay annuity to the investor. So that is called as what? Annuity bond. So here we should, so you must be able to understand what is an annuity. Annuity means same amount at same intervals. For example, Ishwar is giving every year 3,000 rupees cash gift to his wife. Every year rupees 3,000 cash gift to his wife for every birthday. Okay, this is an annuity or not? This is an annuity because same amount at same intervals. Same amount at same intervals. Are you getting my point? Okay. Ishwar, he is paying 1,000 rupees every Sunday to his wife. Annuity. Same amount at same intervals. Okay. Ishwar, he is paying 1 lakh to his wife every Vinayak Jyoti. This is not an annuity because interval may not be same. Interval may not be what? Same. So annuity means what? Same amount at same intervals. Okay, same amount at same intervals. Okay. So here we are going to learn future value of annuity and present value of a annuity. Future value, present value. So amount is nothing but what? Future value or a present value? In previous examples, we have calculated what? Amount. So amount is a future value. What is the principal? Principal is a present value. To get amount, we are doing a compounding. Compounding is nothing but multiply. Yes or no? Okay. So if in the question they have already given what? Present value, and if they ask you to find out future value, okay, then what we are going to do? We are going to do compounding. Okay. Present value is given in the question, and if they ask you to find out what? Future value, then we are doing compounding. Yes or no? If you observe the formula, A is equal to P into 1 plus I power n. P into nothing but we are doing what? Compounding. Compounding. Okay. For suppose if the future value is given and if they ask you to find out present value. So let us say for example, what is our formula? A is equal to P into 1 plus a power n. Yes or no? If you observe this formula, to find out amount, we are compounding the principal, present value. If they ask you to find out principal, then my formula will be A into 1 divided by 1 plus I whole power n. So now the point is, okay, if amount is given and if they ask you to find out principal, that is nothing but future value is given and they are asking you to find out present value, then so we have to go for what? Divided by nothing but this is called as discounting. This is called as what? Discounting. Am I clear? Discounting. Nothing but if you have to find out the future value, then multiply present value with future value factor. Multiply present value with future value factor. If you have to bring future value to the present value, then multiply future value with present value factor. Okay. So annuity. Let us discuss annuity. So annuity can be annuity regular or annuity immediate. Annuity regular or annuity immediate. Annuity regular means at the end of the period. Annuity immediate means at the beginning of the period. Annuity regular means annuity at the end of the period. Annuity immediate means at the beginning of the period. Beginning of the period. Am I clear? Annuity regular and annuity immediate. Done? Okay. So annuity immediate is also called as annuity due. Annuity due. Okay. If a question is silent, then we should consider annuity as a annuity regular. Okay. For example, in capital bursting, they will give cash inflows, even cash inflows. Even means equal cash inflows. We should consider those cash inflows at the end of the year. Simple logic. If you purchase a machinery as on today, you will get a cash flows beginning or ending. You are purchasing a plant and machinery as on today. Immediately you will not get cash inflows or no. You will be getting cash inflows at the end of first year, second year, third year. So that's why if a question is silent, we should assume what cash inflows as annuity regular. Okay. So future value annuity annuity. Okay. Future value and the second one is present value. Future value, present value. And in future value, it can be what? Regular or immediate. Future value. So future value regular and next immediate. Later on I will not discuss these concepts, okay? Regular, immediate. Done. So how do you get future value? Future value. Annuity into future value annuity factor. Regular. Annuity into future value annuity factor regular. Next one. Annuity into future value annuity factor immediate. Okay. The next annuity into present value annuity factor regular. Next annuity into present value annuity factor immediate. Okay. So nothing but future value of annuity is equal to annuity into future value annuity factor. Present value of annuity is equal to annuity into present value annuity factor. If it is regular, we multiply with regular annuity factor. If it is immediate, we multiply with immediate annuity factor. Okay. What is the meaning of regular? Regular means end of the period. Okay. Immediate means beginning of the period. Immediate means beginning of the period, and regular means what? End of the period. Am I clear? Okay. So now, how to find out future value annuity factor regular? So I am not giving any formula. Understand conceptually. Future value annuity factor regular. Okay. Let us say, for example, here 1, 2, 3. I am taking only 3 years. Cash flow 10,000, 10,000, 10,000. I am getting 10,000. Here it is regular. Regular means what? Regular means end of the period. Okay. Now I want what? Future value of a annuity. Here this 10,000 is an annuity. Same amount at same intervals. I want future value of an annuity. How to find out future value of annuity? Future value of a cash flow. Okay. I want future value of annuity at the end of a third year, because I am getting annuity for how many years? 3 years. If I have to find out future value of annuity, then one way is to take a table and the other way is shortcut. First we shall see the table. If you are getting 10,000 at the end of first year, that 10,000 can be invested for how many years? 2 years. So 10,000 into, let us assume interest rate is 0.1. So 10,000 value will be equal to 10,000 into 1 plus 0.1 power square by the end of the third year. Yes or no? Okay. Next 10,000 into, if you are getting 10,000 at the end of second year, that can be invested for how many years? 1 year. So 10,000 into 1 plus 0.1 power 1. Next 10,000. So what is the value? 10,000, 11,000, 12,100. You cannot add the cash flow column because that is 10,000 at the end of first year, second year, third year. They will have a different values. They cannot be added. The last column can be added. So what is the total? 33,100. Or what is the shortcut? Future value of annuity is equal to annuity into future value annuity factor regular. That is equal to 10,000 into, we should multiply with what? Future value annuity factor. So now let me know the future value annuity factor. Do understand it conceptually. First, okay. So habituate to the shortcut like compound interest rate. In compound, while finding out amount, first we are taking what? Interest rate. So you take interest rate in the calculator 0.1, 0.1 plus 1 into 1 press equal to 1 time equal to. Just understand the number. What is the number? 1.1. What is this 1.1? Okay, do understand this 1.1 before proceeding to further calculation. What is this 1.1? For suppose if you are receiving 1 rupee at the end of a second year, that 1 rupee will be equal to 1.1 by the end of the third year. Are you getting my point? Press again equal to 1.21. If you are getting 1 rupee at the end of a first year, by the end of a third year, that will be equal to 1.21. Grand total 2.31. What is this 2.31? You are considering first and second. Then add 1. What is this 1? What is this 1? At the end of third year, if you are receiving 1 rupee, you will not be receiving any interest. So that's why you are simply adding 1. So you might have got 3.31. Nothing but if you are getting 1 rupee at the end of first year, 1 rupee at the end of second year, and 1 rupee at the end of a third year, then what is the value at the end of a third year? 3.31 is the future value annuity factor. So nothing but shortcut for future value annuity factor is nothing but first we should take I and then add 1 and then multiply with 1 and then press equal to how many times? N minus 1 times. Why only n minus 1 times? Because the reason is for the last year annuity we are not going to get any interest, and for first year annuity we are going to get only 2 years interest, not 3 years. Do understand it conceptually. Okay, press equal to how many times? N minus 1 times, and then press GT and then add 1. This is the shortcut to find out future value annuity factor regular. Future value annuity factor regular. Are you getting my point? So take I and then add 1, multiply with 1, press equal to n minus 1 times grand total, add 1. For suppose if it is 5 years, then what is the calculation? 0.1 plus 1 into 1 equal to how many times? 4 times. And then grand total, then add 1 separately. Are you able to understand why it is n minus 1 times? Because this is annuity regular. If it is annuity regular, I am not going to get interest for the last year annuity, and for the first year annuity I will be getting interest for n minus 1 years. Clear? Are you getting my point? For suppose if it is future value annuity factor immediate, then my answer will change. Annuity immediate means beginning of the year. So first year beginning means I will get interest for first year, second year, third year. Second year beginning means I will get interest for second year, third year. Third year beginning means I will get interest for third year also. In that case, what is my shortcut? Take I, add 1, multiply with 1, press equal to n times. Then grand total. That's it. We need not add 1. Are you getting my point? So in next class we shall see that future value annuity immediate and then present value. So in next class we are going to complete what this time value of a money chapter. And once again I am reminding, I am taking this much time because I am not going to remind this concept afterwards. Okay, in advanced chapters. Okay, you have to understand these concepts. Okay, thoroughly. Okay, done. So next, so this is our class 3. So this is our class 3. Okay. So now, so what is the problem with SFM? So practice, you have to practice. So understanding the concept itself is not enough. You have to solve the question within the time. So that is very important. So that's why I have made it clear. So what is the order? First super 50, and next is super 50 plus MCQs, multiple choice question. If time permits, then super 50 plus MCQs plus A category main questions. And if even more time is there, then B category main questions. Okay, and then C category main questions. If a time permit, then go through CMA compiler, past questions compiler, and then CA final past questions compiler, and then Ishwar CA, UPSC, MLA, MP, and then come to additional questions. Okay, especially if you are writing both groups, then restrict to Super 50 plus MCQ, A category, B category. That is more than enough if you are writing both. Okay. And I would recommend, I mean, if you are writing both, then just restrict to A and B category classes also, so that you can save time. Okay. Listen to C category and then just practice MCQs, multiple choice questions. So now we are discussing what time value of money. Okay. If a present value is given in the question, to find out the future value, so we have to do compounding. If a future value is given in the question, to find out the present value, we have to do discounting. So we have to do what? Discounting. Okay. So annuity means same amount at same intervals. Annuity regular means end of the period. Annuity immediate means beginning of the period. Annuity immediate is also known as annuity due. Annuity due. Okay. So how to find out the future value of annuity? So future value of annuity is equal to annuity into future value annuity factor. If it is regular, we multiply with future value annuity factor regular, and if it is immediate, future value annuity factor immediate. Okay. So now, so we have already seen future value annuity factor regular. So future value annuity factor regular. How do we get future value annuity factor regular? What is the shortcut? Take I and then add 1, multiply with 1 and press equal to n minus 1 times. Why press equal to n minus 1 times? What is the logic behind it? Because for the last annuity, we are not going to receive any interest. At the same time, for the first period annuity, we are going to get interest for how many years? N minus 1 periods. So that's why. So take I, add 1, multiply with 1, press equal to n minus 1 times. Grand total and then add 1. Okay. For suppose if it is future value annuity factor immediate. Future value annuity factor immediate. So then whether our answer will remain same or not. Our answer will change. Future value annuity factor immediate. Future value annuity factor immediate. Immediate means ending or beginning? Beginning. Future value annuity factor. Okay. So future value annuity factor immediate. Immediate means we have to press how many times? Equal to n times. Why n times? Let us take the same example. So let us take the same example. Year 1, what is the cash flow? Year 1, 10,000. Year 1, 10,000. So if it is future value annuity factor immediate, then press equal to how many times? Press equal to n times. Press equal to how many times? N times. Okay. So let us take the same example. What are the columns? Here, cash flow. Here, cash flow. Future value of a cash flow. Here, cash flow and future value of a cash flow. So here, cash flow, future value of a cash flow. Here 1, 2, 3. Cash flow. So we are taking 10,000 as an example. And what is the rate of interest? 10%. We are taking 10% as a example. So now annuity immediate means beginning. So we are getting 10,000 at the beginning of the first year. That means as on today. So we have to find out the future value. That is value at the end of the third year. That means how many times we have to do compounding? We have to do compounding for 3 times. So that's why what is the calculation? 10,000 into 1 plus 0.1 power 3. 10,000 into 0.1 plus 0.1 square. 10,000 into 1 plus 0.1 power 1. What is the future value of annuity? Likita, am I audible? So what is the future value of annuity? 36,000 for 10. Or what is the shortcut? Future value of annuity is equal to annuity into future value annuity factor. How do we get future value annuity factor? How do we get future value annuity factor? What is the shortcut? Shortcut is, so future value of annuity is equal to 10,000 into future value annuity factor. How do we get future value annuity factor? Take I, add 1, multiply with 1, press equal to n times. This time n times, because for the last year annuity also we are going to get interest. And for the first period interest, we are going to get interest for how many periods? N number of periods. So that's why. So what is the factor? 3.641. So the answer is 36,410. 36,410. Am I clear? Okay, done. So now present value of annuity. Present value of annuity regular. Present value of annuity regular. So this time we are finding out what? Present value. So this is important from examination point of view. Present value of annuity regular. In most of the cases we apply this concept. Okay. Present value. Same example here, cash flow This time what? Present value factor, discounted cash flow. Present value of a cash flow is nothing but discounted cash flow. Year 1, 10,000. Year 2, 10,000. Year 3, 10,000. So this 10,000 is end of the period or beginning? End of the period. So at the end of first year means we have to discount one time. End of the second year means two times. End of the third year means three times. Yes or no? So I want the present value factor for first year. So simple, how do I get it? So to find out a present value factor, we have to do discounting, nothing but divided by. Okay. So P is equal to A divided by 1 plus I power n. So the same logic will be applied. So that's why. So 1 divided by 1.1. 1 divided by 1 plus 0.1. Factor 0.909. So first understand this meaning of a 0.909. If you are going to receive 1 rupee at the end of first year, the value of that 1 rupee as on today is 0.909. Are you getting my point? Okay. If a time value of money is 10%. Okay. Press again equal to 0.826. Next is 0.751. So 9090 8260 7510. So the total is 24,860. Future value will be greater than 30,000. I mean total of cash flows. Present value will be less than 30,000. Are you getting my point? So what is the shortcut? Multiplying annuity with present value annuity factor. So present value of annuity is equal to annuity 10,000 into present value annuity factor. How do I get present value annuity factor? 1 divided by 1.1. Nothing but take 1, divide with 1 plus I, press equal to how many times? N times. Okay. Grand total. So 2.486. So the answer is 24860. First, suppose if it is present value of annuity, present value of annuity immediate, present value of annuity immediate, so calculation, year cash flow, present value factor, discounted cash flow. Year 1, 2, 3, cash flow 10,000, 10,000, 10,000. Present value factor. Now annuity immediate. Annuity immediate means beginning. So beginning of the first year means as on today, 0 year. If you have 1 rupee, then the value of that 1 rupee as on today is 1. We need not discount. What about the second one? I mean second year beginning means end of the first year. The factor will be 0.909. Third year beginning means Third year beginning means what? Third year beginning means end of the second year. So that's why 0.826. So discounted cash flow 10,000 9090 8260. So the total 27350. 27350 is the answer. Okay. Overall, shortcut present value of annuity is equal to annuity into present value annuity factor. This time the present value annuity factor we require immediate. Likita, am I audible? How do I get it? 1 divided by 1 plus I press equal to n minus 1 times, because first year, first period annuity need not be discounted. So that's why 1 divided by 1 plus I press equal to n minus 1 times grand total and then add 1. Are you able to understand the logic? So what is the factor? 2.735. So the answer is 27350. You have to understand the logic because time value of money is very important. Done. So in capital bursting, you will come across equated annual cost concept. Equated annual cost. Okay. Or in capital bursting, you might come across finding IRR, internal rate of return. Okay. So all these concepts are linked to this concept only, present value annuity factor. For suppose example, so this is important in real life also. For suppose if you are taking a loan, okay, you have to pay installments, right? You have to pay installment, monthly installments. So the point is that monthly installment is an annuity because you will be paying same amount at same intervals. So that's why the installments you are going to pay is an annuity. Now the point is loan amount. There are three components: loan amount, interest rate, installment. Okay. Loan amount is nothing but present value of future installments. You are taking loan as on today. You will be taking loan as on today and will be paying installment every month in future. So the point is this loan amount is nothing but what? Present value of future installments. Okay. But suppose if I am taking a loan, so that is nothing but what? Present value of annuity. Let us say I am purchasing a car worth rupees 10 lakhs by taking a loan. Okay. Interest rate 8% per annum. Now the question is, what is the equated monthly installment? Okay. If you have been appointed as a credit manager, then you have to decide whether loan to be granted to the customer or not. Okay. For that, you will be considering the income earned by the customer and what is the EMI he is going to pay. Suppose customer is earning 1 lakh and his EMI is coming up to 1.5 lakhs. Whether you are going to go grant a loan or not? No. So the point is how to calculate this equated monthly installment. So what is the present value of annuity formula? I mean logic, we already know the logic. Annuity into present value annuity factor. Yes or no? Here the present value of annuity is nothing but what? 10 lakhs. Yes or no? So 10 lakhs is equal to annuity. We have to find out, that is EMI into PV at the rate of 8%. Okay. Let us assume tenure is equal to 5 years. Loan tenure 5 years. Loan tenure 5 years. Loan tenure 5 years. Loan tenure. Loan tenure 5 years. Okay. Now the point is the calculation. How to find out. Okay. So loan tenure is equal to how many years? 5 years. Loan tenure is equal to what? 5 years. So first understand the concept. I mean present value of annuity is 10 lakhs. We have to find out annuity. I mean using the interest rate and tenure we can find out what? Present value annuity factor. How do we get it? 1 divided by 1 plus I equal to n times. So nothing is, if a question is silent, then it is annuity regular. So 1 divided by 1.08. So mistake. That is not 1.08 because the reason is we are not going to find out equated annual installment. We are finding out what? Equated monthly installment. So what is the answer you got? What is the answer you got? 250? By giving 10 lakhs as a loan, if you ask, okay, customer to pay 250, 457 every month. For how many months? 60 months. That means you are charging 8% interest per month. So what is the calculation? How do I get present value annuity factor? You have to take interest rate per month. What is interest rate per month? 0.08 divided by 12. Nothing but 1 divided by 1 plus 0.08 divided by 12. Equal to how many times? Is equal to how many times? 60 times. Total 60 installments. Total 60 installments. For suppose if it is equated annual installment, then your answer is right. Okay. For suppose if it is equated half yearly installment, then 1 divided by 1 plus 0.04 equated half yearly installment means you should take half year interest. In that case, what is my calculation? 1 divided by 1 plus 0.04 equal to how many times? 10 times. 5 years means 10 half years. If it is equated quarterly installment, then 1 divided by 1 plus 0.02 equal to how many times? 20 times grand total. So understand this concept logically, okay? Clear? So what is the factor? 1 divided by 1 plus 0.02, I mean 0.08 divided by 12 equal to how many times? 60 times, and then grand total. Okay? Time value of money. We have to consider time value of money. So let me know the answer. What is the present value annuity factor? One divided by 1 plus 0.08 divided by 12 equal to how many times? 60 times grand total. Let me know the factor. Twenty. What is the factor? 49.41. So annuity is equal to 2 20238. So clear? 49.2719. Done. How am I getting annuity? Annuity is equal to present value of annuity divided by present value annuity factor. Yes or no? So this concept was given in foundation syllabus itself. Okay. The terminology is changing from foundation to inter and inter to final. Okay. Is it correct? 49.41. Now, if you link this concept to the capital budgeting, NPV, okay. In NPV, how do we get NPV? Sum of our discounted cash inflow minus sum of a discounted cash outflow. For the timing, forget about sum of a discounted cash outflow. How do I get sum of a discounted cash inflow? Sum of a discounted cash inflow is nothing but what? Present value of a cash flow. First, suppose if a cash flow is equal, nothing but if it is an annuity, how do I find out sum of a discounted cash inflow? Annuity into present value annuity factor. So this is what we are applying the logic. Okay. And in capital bursting, you learned one more concept, IRR. Okay. When the cash flows are even, to find out IRR, you will be having the sum of a discounted cash outflow, nothing but present value of annuity on left side. You will be having annuity, and you will be finding what? Present value annuity factor. After finding out present value annuity factor, then you will find out the rate at which this present value annuity factor lies. Yes or no? Nothing but same. Here I am mentioning loan, but whereas in capital bursting they will mention it as a initial cash outflow. They will give 20,238 as a annual cash flow or monthly cash flow, and they will ask you to find out IRR. What is the IRR for this example? 8% is the IRR. Nothing but this rate of interest is cost to the customer. This is IRR to the bank. IRR to the bank. And in capital bursting itself, we have learnt equated annual benefit. Equated annual benefit. Equated annual benefit is nothing but annuity. How do I get equated annual benefit? Net present value divided by present value annuity factor. I hope you remember this concept. Equated annual benefit is equal to net present value divided by present value annuity factor. Equated annual cost is equal to sum of a discounted cash outflow divided by present value annuity factor. The same logic. Present value of annuity is equal to annuity into present value annuity factor. But annuity is equal to present value of annuity divided by present value annuity factor. If it is equated annual benefit, then present value of annuity is NPV. If it is equated annual cost, then present value of annuity is nothing but sum of a discounted cash outflow. Okay. If it is equated monthly installment, then present value of annuity is loan amount. Am I clear? The same concept can be asked in different ways. Clear? So they might ask you, for example, asset cost is 10 lakhs. Asset cost is 10 lakhs. Interest rate is 8%. As a lessor, what is the minimum lease rent to be charged? So the answer is 20,238 is the minimum lease rent to be charged. Are you getting my point? You have to apply this concept in different ways, time value for money. And before taking a loan also, you must know how to find out EMI. How do we get EMI? Loan amount divided by present value annuity factor. Loan amount divided by what? Present value annuity factor. Am I clear? Done? Next, last concept in time value for money, valuation of asset. valuation of asset. So this concept is very, very important. Valuation of asset. This concept is very important. This will be useful for SFM or AFM and financial reporting. Financial reporting as well. Valuation of a asset. The first point is valuation is a subjective concept. Subjective means the value differs in perception, I mean from the perception. For suppose, in my perception, Ishwar, okay, is inspiring, okay. His value is somewhere beyond imagination, my perception. But from the other perception, from the, okay, so the other person perspective, Ishwar value might be 0 or might be negative. So the value always depends upon what? Perception. First we shall come from our life. Some people might like us, okay. Some people might be hating us, yes or no. So we are same for everyone. But some people will be giving much value. They will be waiting for us, okay. So they will be giving importance to us. Some people might be ignoring us, yes or no. So that means value depends upon a perception. Likewise, business value also depends upon a perception. For suppose if I ask Ishwar what is the value of a BCCA, so Ishwar might, sir, we have a ACs total 20 ACs and 200 benches, so 4 mic systems, camera, TV. He might what? Okay, collect all the tangible assets, fan, projector, everything, and he might take what? Assets and the value. Okay, and the value also he might take a realizable value. Realizable value. What is the realizable value? For suppose if I sell this bench now, okay, I might get what? 1000 or 2000. That is the realizable value. So this is the Ishwar perception. Ishwar perception is BCCA value means total assets, and he is taking the asset value at realizable value. So the point is it correct or not? Okay. First thing, we take the asset realizable value if it is going to wind up, but it is a going concern. When it is a going concern, we cannot apply this realizable value concept. Yes or no? Okay. What is your name? Kamesh. Kamesh might apply the same concept with small difference. For example, he might take what? Assets and historical cost. Historical cost. Purchase value. Okay, so this is also not relevant. Okay, what is your name? Prasanna Kumar. He might take what? Replacement cost. Replacement cost means if we are going to purchase a camera now, what is the price? For suppose Ishwar is asking the camera, I am giving it to Ishwar. If it is a going concern, I have to buy another camera. So what is the replacement cost? I may take assets and replacement cost. Are you getting my point? Okay. So I might take book value. Book value means nothing but balance sheet value. Book value means what? Balance sheet value. So this is called as a net asset method. Net asset method. So, but for service organization, this net asset method is not correct. Because for service organization, goodwill, all India ranks, pass percentage, results, brand value. Okay, brand value that has to be considered. Okay, so what is the concept to be applied? Depends. In my perception, the concept, the valuation concept to be applied is discounted cash flow method. Discounted cash flow method. Nothing but bringing the future cash flows to the present value. That is my perception. But your perception might be different. Instead of bringing the cash flows to the present value, you might bring earnings to the present value. Kamesh might bring dividend to the present value. Prasanna Kumar might bring free cash flow to equity to the present value. Again, here also there is a, it is a subjective concept. Subjective concept. And to bring the future benefit to the present value, we use a required rate of a return. And that required rate of a return depends upon the risk. Depends upon risk. If risk increases, required return increases. If required return increases, value decreases. Nothing but expectation. Let us say, for example, if risk increases, expectation increases. And if expectation increases, value decreases. Yes or no? For example, nowadays we have too much expectations on life. So that's why the value of life is decreasing. Yes or no? Previous generation, they used to have a mutton or a chicken once in a month. They used to go for shopping once in a year. Now, this generation, they're doing shopping regularly. Okay, they can have a chicken or mutton on any day. They have a money, they have a mobile. To have a time pass, they have Insta, everything. But still, at 11:30, so they will keep a status, I am alone. Lakkanna mate nillu nillu. Okay. So the reason is too much expectation, this generation. If expectation increases, then what happens? Value decreases. Same with our SFM or AFM also. Value of asset decreases. Value of a asset decreases if expectation increases. If expectation increases. And this value depends upon completely a perception. Completely a perception. Some students, after getting a 3 lakhs package, after completing BCom and getting 3 lakhs package also, they feel happy. Okay. Some students, after getting 12 lakhs package also, they will feel, why I have wasted time. Likewise, they might feel. So that means value completely depends upon what? Perception. That depends upon the expectation. If your expectations are too low, then value will be high. Value will be high. Are you getting my point? Okay. So second hand car value will be low for various reasons, and one of the reason is risk. Second hand car means that person might have stolen the car somewhere else. No proper registration. There is no proper registration. Then the value of a car will be less. Yes or no? Why? There is no proper registration means he might have stolen the car. The true owner may come at any time and may claim the car back. So that's why the value of a second hand car is less. Okay. Government employee, private employee. Government employee is earning 1 lakh per month. Private employee is also earning 1 lakh per month. But the value of government employee is high because from the perception of an investor, government employee risk is less. Okay. So required return will also be less. So that's why the value of government employee will be high. So that means here the value depends upon what? Two factors. Value depends upon two factors. Valuation is a subjective concept. There are a lot of methods we are going to learn in business valuation. But right now I am discussing discounted cash flow method, which is a popular method and which is more relevant. Okay. Valuation of asset. Discounted cash flow method. So value of any asset is equal to, this is very important, value of any asset is equal to present value of a future economic benefit. How do you bring this future economic benefit to the present value? We bring this future economic benefit to the present value using Using what? Required rate of a return. Using what? Required rate of a return. And that required rate of return depends upon what? Risk. If risk increases, write it in order. Value or wealth depends on A, benefit, B, risk. Value or a wealth depends upon two factors, that is benefit and risk. Benefit and risk. If a benefit increases, wealth increases. Wealth means nothing but value. Profit is different from wealth. For example, getting a rent on a building is a benefit or a profit, but the building value is a wealth. Okay, for suppose you are doing a job and getting a 1 lakh salary per month. If someone comes and asks you what is your wealth, will you say 1 lakh per month? No. You will be saying minus 1 crore. Assets minus liability. Yes or no? So, if a benefit increases, what happens? Wealth increases. Yes or no? If a benefit increases, wealth increases. Okay. For example, BCCA value will be more than ECCA. East for College of Commerce and Arts. Okay. So, because the reason is a benefit. If a benefit increases, what happens? Wealth increases for the time being. Okay. Next, if risk increases, required return increases. If required return increases, value decreases. Okay. Risk increases, what happens? Required return increases and the value decreases. Are you able to understand this logic? For example, the same building. So, for example, building value, okay, let us say 5 crores. Let us assume 5 crores. Building is located in Hyderabad, JNU, okay, safest place. For suppose, similar kind of a building which is giving the same benefit, same rental income, located in Afghanistan, Kabul, whether value will remain same or not? No, risk is high. Right now, India is the safest place because Russia-Ukraine war, Israel-Palestine war, okay, Syria and Iran, okay. So everybody fighting, but nobody coming towards India right now. Okay. So the point is, if risk increases, required return increases and value decreases. Value what? Decreases. Okay, if you want to buy land in Ukraine right now, the value of land will be less. Yes or no? Because risk is high. Okay, clear? So this is the basic fundamental. If risk increases, what happen? Required return increases and value decreases. So that's why before making any investment, any investor will be considering two factors. Will keep in mind two factors. One is the benefit. What is the return I am going to get? Second one is risk. What is the risk I am going to take? And risk also depends upon a perception. Again, I am telling risk depends upon a perception. Some people may feel not taking risk itself is a risk, like RGV. Okay. So some might feel doing a job itself is a risk. Stepping outside home is also a risk. Risk depends upon a perception. So value of any asset is equal to present value of a future economic, future, not the past, not the past. Okay. So the value depends upon what? Future economic benefits. If in pure monetary terms, if we value the humans also on pure monetary grounds, then the value of a Ramcharan will be greater than value of a Chiranjeevi. Yes or no? Future economic benefit. People will consider only what? Future economic benefit. Mega Chiranjeevi was a mega star. That doesn't make any sense for making a valuation, because the reason is we have to consider only what? Future economic benefit. Are you getting my point? Okay. So nobody is going to spend 300 crores on Amitabh Bachchan, because the reason is they will consider what? Future economic benefit. Okay. So Allu Arjun value is greater than what? Okay, other Amitabh Bachchan or something, because Allu Arjun will be having a school students, I mean, as a fan, just or no. So more future economic benefit by, I mean, I don't know, I have seen memes. They might be elders also. So generally by future economic benefit. So the value depends upon what? Future economic benefit. Once again, I'm repeating future economic benefit. What you have earned in the past, that does not determine your value. What you are going to earn. For suppose if you have to find out your value as on today, write down the future cash flows, bring it to the present value. Okay. So valuation of asset, there are 5 examples. We can categorize the assets into 5. First one, single cash inflow. Single cash inflow. So the asset might give a single cash inflow. The asset might give single cash inflow. For example, red sandal. Red sandal. So red sandal will not give a benefit every year. Okay. So red sandal. So the benefit will be received after 20 years. So suppose if you are growing a red sandal, you are going to get a benefit after 20 years, 15 to 20 years. Yes or no? And you will getting a even cash flow or a single cash flow? Single cash flow. Red sandal, Pushpa, Harchandana. So you will be getting only what? Single cash flow. Likewise, if we come to our financial management, zero coupon bond. Zero coupon bond. If you are purchasing a zero coupon bond, you will be investing money in zero coupon bond, and the company will redeem the zero coupon bond at face value. So the investor benefit is face value. Investor is going to receive only the face value. Single cash flow. He is not going to get any coupon, interest. Single cash flow. So that's why, what is the calculation? So let us say, for example, year cash flow PVF at the rate of 10% discounted cash flow. Let us say, for example, zero coupon bond having a maturity of 5 years, redeemable at 10,000. Investors required rate of return is 10%. Investors required rate of return is 10%. That depends upon risk. How do we calculate that 10%? That is a different concept right now. But that depends upon what? Risk. What is the factor? 0.621. 6209 means 6 to 1. So discounted cash flow 6210. So we are bringing the future benefit to the present value. So value of a zero coupon bond from the perception of an investor is 6210. From the perception of an investor, the value of a zero coupon bond is 6210. Are you able to understand? So now, why are we doing a valuation? To take a decision. whether to buy, sell, whether to buy or sell. Are you getting my point? First, suppose right now the market value of a zero coupon bond is 4210. 4210. So what I am going to do? I am going to buy, because in my perception the value is 6210. This 6210 is known as theoretical value. We have learned one theory, we have applied that theory and we have found the value. The value is 6210. We compare this theoretical value with actual value. Okay, if actual value, actual market price is 4210, then I'm going to invest in zero coupon bond. But suppose if in the market the zero coupon bond price is 7000, then I'm not going to buy it. If I have a zero coupon bond, then I'm going to sell it, because it is overpriced in the market. You have to understand the terms underpriced and overpriced. Theoretical value is 6210, but the actual value is 4210. That means undervalued. If it is undervalued, I'm going to buy, invest. For suppose if in the market the price is 7000, that is overvalued, I'm going to sell. Undervalued, overvalued. If it is undervalued, buy, overvalued, sell. Okay. From other perspective, always gold is underpriced. So that's why every time they will be purchasing, because in their perception the gold price is going to increase in the future. Right now we are going to get for less price. Yes or no? That is their perception. So gold is always what? Underpriced. Okay. So the point is, if it is underpriced we buy, if it is overpriced sell. Done. So single cash flow, what is the example for single cash flow? Zero coupon bond. So these 5 examples are very important, because value of any asset will fit into these 5 examples. Any asset, that might be a zero coupon bond, that might be equity share, that might be a debenture, plant and machinery, building, business, even business also. Okay. So the valuation is the predominant part of our SFM. Valuation. Are you getting my point? Security valuation, derivative analysis and valuation. Likewise, business valuation. So value is nothing but present value of a future economic benefit. Value of any asset, that might be a bench, camera, system, AC, business, plant and machinery, bond, equity share, debenture, preference share, see Ishwar, Kamesh, Ravi sir, whatever it might be. So how do we get the value? By bringing the future economic benefit to the present value. Okay. You might have seen acquisitions, mergers and acquisition. So to acquire some other company, so we have to value, we have to make a valuation. This valuation is a base for negotiation. This valuation is a base. That is not the final value, because value depends upon perception. Okay. Next is second. Even cash inflow. This even cash inflow you might have came across in capital budgeting. Yes or no? The plant and machinery might give a even cash flow. Year 1-5, cash flow 10,000. Present value annuity factor 1 divided by 1.1 equal to 5 times grand total. 3.10%. I am taking an example, but in your perception the time value might be 15. 3.79. So 37,000 900. Asset might give a even cash inflow. Asset might give a even cash inflow. Example, plant and machinery. You might have came across in capital budgeting or annuity bond. Annuity bond. Annuity bond means it is a debenture issued by the company and investor will get a annuity in return. Annuity means same amount, same interest. Nothing but here bank is a borrower. Bank is a borrower. Investor is a lender. Investor will get a installment, equated annual installment. Like in case of a bank, customer will be paying a equated monthly installment. Likewise, here the customer is bank, sorry, company. Company will repay the bond in the form of installment, equated installment. If a company is paying the bond in installments, then it is called as annuity bond. Okay. Next, third, uneven cash flow. Uneven cash flow. Uneven cash flows. So the example is plain vanilla bond. Plain vanilla bond is an example, or you can take plant and machinery as an example. Plant and machinery building. So PV F at the rate of 10% discounted cash flow. Plain vanilla bond means company will pay interest every year and at the end of the maturity will pay interest plus principal redemption value. So let us take year 1, 2, 3 interest 80 rupees 80 1080. These are examples, okay. Face value of a bond might be 1000. Interest rate is 8%. Interest rate is 8. Interest rate is different from required rate of return. Bond is paying 8%, but investor require how much? 10%. So factor 0.909, 0.826, 0.75. Are you able to understand the plain vanilla bond? Plain vanilla bond will pay interest every year and at the end of the maturity will pay redemption value. What is the discounted cash flow? 950, 950 no. 7, 72, 66, 811 total 9, 950. 950 plain vanilla bond 950 uneven cash inflow. So clear. Next, fourth one. Are you getting my point? Are you able to link this concept to the assets? For example, you comes under which category? 1, 2 or 3? You comes under third category. You will be earning uneven cash flows. You will be earning uneven cash flows for a definite period. Your life is not indefinite period, yes or no? Next, fourth, even cash flows. Even cash flows infinite years. So in this category, generally, what comes under this category? Infinite years, perpetual bond. Perpetual means continuous. Perpetual bond. That means company will pay interest every year for infinite years. Perpetual bond. Equity share. Equity share also will pay dividend for indefinite period. That comes under fifth category. Sometimes we assume that there is no growth. There is no growth. For example, after reaching the maturity, there will not be any growth. Any business or product life cycle, whatever it may be, after reaching the maturity, there will not be any growth. It depends. Perpetual bond, equity share, business. Plant and machinery will not come under this category because plant and machinery life is limited, but business life is indefinite. Business life is indefinite. Equity share, indefinite period. So there is no redeemability period. Perpetual bond, indefinite. Okay. So no doubt there can be uneven cash flows also for that fifth. Okay. That means how do we get benefit? Year column, cash flow, year column 1 hyphen infinity. Let us say cash flow 10,000. 1 hyphen infinity means I cannot find out the present value annuity factor. So 1 divided by 1 plus I equal to how many times? Infinite times. I cannot, yes or no. So this is very simple. So if you are getting an even cash flows for indefinite period, then the value is simple. Value is equal to cash flow divided by required return. You can take dividend, earnings, EPS, cash flow, free cash flow to equity, whatever. So what is the cash flow? 10,000 divided by 10%. 1 lakh. Okay. So I hope you remember what cost of a capital chapter. Under cost of a capital chapter, K is equal to D1 by P naught. Nothing but P naught is equal to D1 by K. Is it similar to this concept or not? P naught means price of a equity share. Value of equity share is equal to D1 divided by K. Nothing but we are bringing the future economic benefit to the present value. Yes or no? Okay. Or you might write P naught is equal to E1 by K. The value depends upon perception. So that's why sometimes we take dividend, sometimes we take earnings, sometimes we take free cash flow to equity. Are getting my point? E1 by KE. Likewise, you might have came across value of firm is equal to EBIT divided by KO in capital structure. Business will give a benefit for indefinite period. What is the benefit business is going to give? EBIT. You might consider free cash flow to the firm also. Free cash flow to the firm. That's why I'm saying it is a subjective concept. So EBIT divided by KO. Is it similar to this one or not? I mean, value is equal to cash flow divided by required return. Yes or no? The value of firm is equal to EBIT divided by KO. Done? Okay. Next, fifth. Cash flow infinite years plus growth. Cash flow infinite years plus growth. Is it clear? Cash flow infinite years plus growth. Done? Okay. So cash flow infinite years plus growth. In that case, my value is equal to cash flow divided by required return minus growth rate. Required return minus what? Growth rate. Okay. Nothing but for suppose in the above example, if growth rate is 5%, then my answer is 10,000 divided by 0.1 minus 0.05. So the answer is 2 lakhs. So the answer is 2 lakhs. That means if there is a growth, then value will increase. Growth rate cannot be greater than required return. For suppose if a growth is 15%, then why do investor will require only 10? Obviously he will expect more than the expected growth rate. So clear? So now, so this is similar to K is equal to D1 by P naught plus G. I hope you already know this formula. K is equal to D1 by P naught plus G. Expectation of equity shareholders, required return on equity. So now the point is Ke minus G is equal to D1 by P naught. Now P naught is equal to D1 by Ke minus G. Always take D1, dividend at the end of the first year. Here also we should take cash flow at the end of the first year, because value means present value of a future, not the past, future economic benefit. Because in examination questions they might give dividend just paid, that is D naught. So we have to take what? D1. For suppose if it is a firm, then value of firm is equal to EBIT divided by KO minus G. KO means overall cost of a capital. Value of a firm, EBIT divided by KO minus G. Am I clear? Value of firm is equal to EBIT divided by KO minus G. Sometimes we write it as value of firm is equal to free cash flow to the firm at the end of first year divided by KO minus G. So okay. So you have to understand the concept. If they ask you to find out the value of equity, value of a equity. So value of equity is equal to earnings available to equity shareholders at the end of first year divided by KE minus G. Instead of earnings available to equity shareholders, you can also take what? Free cash flow to equity. Based on the information given in the question, you have to select. But you have to understand only the one concept is you should bring the future economic benefit to the present value. Okay, value of any asset, we should bring the future economic benefit to the present value. So that is important. Okay, are you getting my point? Now, one more point we have to consider is growth rate. How the growth rate is determined. Sustainable growth rate. Growth rate is equal to B into R. B means retention ratio into return on investment. Retention ratio into return on a investment. Growth rate is equal to B into R. Retention ratio, return on a investment. So let us, okay, take example, I mean simple common sense. Growth depends upon two factors. One is the retention ratio, second one is the return on a investment. Retention ratio, retaining. For suppose Ishwar's grandfather, okay, let us assume in time machine we shall go back. He was earning 1000 rupees per month. 1000 rupees per month. But retention ratio was 0. Retention ratio was 0. That is why Ishwar coming to classes regularly. Ishwar grandfather's earnings retention ratio 0. Earnings retention ratio 0 means no growth. So some families will not grow because the reason is why? No retention ratio, no savings, nothing. So you have to retain some of your earnings. Okay, retention itself is not sufficient. You have to make a investment. Okay, so growth is equal to 0. For suppose Kamesh's grandfather earning 1000 rupees per month, he retained 100%. Okay, so but kept under pillow 1000 rupees. Will there be any growth or not? He might have bought, so okay, 1 acre land in Kokapet at that time. But what he has done, he kept 1000 rupees under pillow and he slept. Okay, will there be any growth or not? No, that is why he is coming to class regularly. Okay, Prasanna, grandfather, retention ratio 100% and he bought 1 acre in Kokapet, just for example. So, growth will be there or not? Yes. Likewise, a company, if it retains its earnings and will make a reinvestment, then okay, earnings will grow. Okay, are you getting my point? So, growth rate is equal to retention ratio into return on a investment. How do I get retention ratio? 1 minus dividend payout ratio. If a dividend payout ratio is 0, that means retention ratio is equal to 100%. Am I clear? Are you able to understand? So growth, ప్రసన్న ఆ ఊహ ఎంత బాగుంది కదా కోకాపేటలో ల్యాండ్ 1 acre. So growth rate depends upon two factors. What are the two factors? Retention ratio and return on a investment. Business అయినా అంతే. If you are getting earnings, what you have to do? If you make a reinvestment, then there will be a growth. But after reaching a certain level, saturation point, after reaching that point, so we cannot make a reinvestment. We have to diversify. So we have to diversify the investment. Okay, clear? So with this we have completed what time value of money. Okay, this is very important, especially last 5 examples. Very important. Okay. Last 5 examples, very important conceptual understanding instead of by hearting. Okay. So apply this practically before taking any decision. This present value of annuity, whatever the concept we have learned, then You will find SFM easy. So clear? Nikita? Nikita or Likita? Online. So now we are entering into SFM subject. How many chapters we have as per our BCCA material? 13 chapters. Okay. You might find different from CMA final study material, board material. The total 13 chapters. In these 13 chapters, what are the A category topics? Securitization is utmost important topic. A category comes under. So is it a problematic or theory? Theory topic. Okay. Theory topic. Next important one is digital finance. This is also a theory topic. Very important. A category. Give utmost priority to securitization and digital finance because content is very less and you might be investing overall 5 to 6 hours overall including the class timing, regular class timing. You would be spending 6 hours time. By spending 6 hours time you can score at least 12 to 14 marks. 12 to 14. Okay, if you find practical question difficult then we should go for theory. Next A category topics: security valuation, mutual portfolio management, mutual funds, derivatives. So these are the 6 topics comes under A category. Next B category: foreign exchange exposure and risk management, evaluation of risky proposals, and in this B category also forex, evaluation of risky proposals, international risk, interest risk management, international financial management. These comes under B category. Next C category: investment decision, leasing, security analysis. Okay, so clear. Now we shall start with investment decisions first. Investment decisions comes under C category. So you might be wondering why it is C category, because already we know. So we have learned this concept in CMA inter level itself. Then why it comes under C category? So why it is coming under C category? Because the reason is weightage of this chapter is 2 plus 7, 9 marks. 2 plus 7, 9 marks. Actually, this topic should come under A category generally, because the reason already we have learned this concept in CMA interlevel and now we are going to learn again. Then why it comes under C category? Because the reason is always in examination you might find a new question. Okay, and this question has to be answered conceptually. I mean, doing a number of problems, too much of practice does not help. Conceptual clarity is important, and you may not be able to solve this question 100% correct, but you will be able to attempt. Okay, so there are n number of questions. They might ask a question from CA inter FM study material, CMA inter FM study material, CMA final study material. Okay, you will always find a new question. So that's why you have to understand the concepts. You have to listen to NPV, IRR, everything, ranking conflict, all the concepts you have to learn. But practicing and wasting time on this topic is not, recommended. Okay? Because anyway, you are going to get new question, not out of syllabus, new question. That's why. And 2 marks MCQ, 2 marks MCQ. Okay? So this is the weightage. Let us start with investment decision. So before starting the investment decision, so introduction to SFM. So what is the financial management? So simply we say management of a finance. So to manage the finance, first we have to procure. We have to procure. Okay. So the financial management is concerned with two factors, two aspects. The financial management two aspects are financial management two aspects. Financial management two aspects are procurement of fund and effective utilization of a fund. Okay. So financial management two aspects. What are the two aspects? Procurement and second one utilization, not just utilization, effective utilization. So we procure fund from two sources, equity, debt. Debt can be called as a plain vanilla bond, zero coupon bond, annuity bond, masala bond, Anki bond. There are several names for debt. Okay. So equity. So preference can be categorized as equity or a debt. That is a hybrid instrument. Hybrid means two breeds. Preference will be having a features of equity and debt both. So financial management two aspects are procurement. As a chief financial officer, you have to procure fund and next utilize the fund. We utilize that fund for two purposes: fixed assets, current assets. Fixed assets, current assets. So investment in fixed assets. For that we have already seen a capital budgeting chapter in CMA interlevel. And for investment in current assets, we have seen working capital management. Working capital management. And for procurement, we have already seen sources of finance theory topic, and then cost of a capital structure and leverages. All these topics we have discussed in CMA Inter. So financial management is concerned about procurement of fund and effective utilization of a fund. Now in CMA final, we do not have a source of finance. We do not have a source of a finance, cost of a capital structure, leverages. We do not have source of finance, cost of a capital structure, and then leverages. And the working capital management also not there. So At final level, we have only capital budgeting, nothing but investment decisions, and there is an extension to this investment decisions chapter also, that is evaluation of a risky proposals. Evaluation of risky proposal, and we can say leasing is also an extension to the capital budgeting. Okay. So financial management, the objective is to maximize the wealth. Maximize wealth. Wealth depends upon two factors. What are the two factors? Wealth value depends on two factors: benefit and risk. Benefit and risk. Objective of financial management is to maximize the wealth. For that matter, objective of any business is to maximize the wealth. So as a CMA, you have to maximize the wealth of a business. Okay. For that, we use financial management tools and techniques. So wealth depends upon two factors. What are the two factors? Benefit, and the second one is risk. That is why at CMA inter level, we have learned the cost of a capital chapter. We are not just acquiring funds from equity. Okay, we are determining the optimum capital structure, capital mix. See in which ratio we have to procure fund from equity and debt. Because we should keep the expectation risk at low. We should keep the risk low, and we should get a more return. Yes or no? Because wealth depends upon two factors, that is profit and risk. Now, after procurement, effective utilization of fund is also very important. Effective utilization. So there should not be any over capitalization. Over capitalization. There should not be any over capitalization, and there should not be any under capitalization. Over capitalization means making an investment more than required. For example, if we are maintaining a stock more than requirement, then what happens? Profit will decrease, because we are making a huge amount in working capital, which is not at all required. So then what happens? Returns, profits will decrease. For example, DMart. If you have gone to DMart in Hyderabad, you might be finding a lot of a stock. For example, similar kind of a DMart has been started in a small town. Okay, so let us take Kandukuru. Okay, it is a small town there. Okay, DMart has started its branch and maintaining a huge stock. Then what happens? Are you getting my point? The return will decrease because high capital is tied up in the stocks. So that is over capitalization. Under capitalization means investing less than what is required. If that happens, then goodwill will get affected. Goodwill will get affected. For example, if you are not maintaining a working capital and if you are not making a salaries, payment of salaries on time, so we will be losing a trust. Yes or no? Employees may shift to other company. So that's why under capitalization is danger, as well as over capitalization is also danger. So we have to utilize the fund effectively. Okay. So the capital bursting, only one chapter capital bursting is being discussed here in CMA final. So SFM, strategic financial management. Strategic financial management. So to be any business to become successful, first we must have a financial resources. Financial resources. Before financial resources, first we should have a clear strategy, clear and realistic strategy. Strategy means a long-term action plan. We should have a long-term action plan, and that long-term action plan should be clear and realistic. Clear and realistic. For example, Ishwar, he wanted to start a real estate business in Mars, on Mars. He is having a long term action plan. He wanted to start a real estate business on Mars. Now the point is it a realistic strategy or not? As of now, doing a real estate business on Mars, Venus, or Jupiter, Moon, is it realistic or not realistic? It is not realistic. Okay. So now the point is, first you must have a clear and realistic strategy. A business to become successful, there should be a clear and realistic strategy. And next is second. So strategy is there. Ishwar is having a strategy. He is having a vision. He wanted to start film institute in Andhra Pradesh. Okay, as requested by Deputy CM Pawan Kalyan Garu. So now the point is, he wanted to start a film institute or film academy there. Now the point is, what is the second one required? The strategy is sufficient or not? Is enough or not? Strategy itself is not enough. We require what? Financial resources. Financial resources. Not only the financial resources and strategy itself is not enough. We require the right management skills. Right management skills. Strategy is important. Financial resources are important, and we require what? Right management skills. Nothing but we require a strategy, finance, and what? Management. Okay, nothing but we require SFM. A business to become successful, what we require? We require what? SFM. Obviously. For example, capital bursting decision. If it goes wrong, it may affect going concern. It may affect what? Going concern. Okay. So SFM is fundamental essential element of any business. Okay. So to maximize wealth, the following decisions fall within the scope of a financial strategy. Scope, boundary. What is our boundary? What are the decisions comes under SFM, financial strategy? First one is financing decision. From where to procure money? From where to procure money means whether equity or debt, and in which proportion. And debt also, what type of a debt? Okay. Financing decision. So falls within the scope of a financial strategy. So this already we have discussed in CMA Inter. Next one is investment decision. Where to invest money? Okay. So generally we invest money in fixed assets and current assets. Okay. Where to invest money in the sense, what is the point here? For example, PVR Inox. So PVR and Inox, they are operating what? Multiplex theaters. Yes or no? Now if they want to start another 20 multiplexes, then where to start these multiplexes? Okay, where to invest? Where to invest? For example, if they are starting a multiplex theater in Mahbub Nagar or Adilabad, Srikakulam or somewhere else, at interior places, rural areas, so that will work out or not? That may not work out. So theaters may not be occupied. Yes or no? Likewise, investing money in operating aircrafts. So will it be, feasible or not? So investment decision will fall within the scope of what? Financial strategy. Okay. Next, dividend decision. This already we discussed in CMA inter level. Dividend decision, whether to declare a dividend or not. Whether to declare a dividend or not. So we have seen models like Walter model, Gordon model, Modi Gilani, Miller model. Irrelevant approach. Okay. So Modi Gilani Miller says whether you declare a dividend or not, that doesn't make any difference. to the wealth of shareholders. Okay. So Walter model. Walter says if return on an investment is greater than cost of equity, then optimum payout ratio is 0. Best payout ratio. If return on investment is greater than cost of equity, KE. Okay, if return on investment is greater than KE, that means if you can earn more than what investors is expecting, more than what investors are expecting, then optimum payout ratio 0. Do not pay anything to investor because anyway you are going to earn return more than what they are expecting. So that's why if R is greater than KE, optimum payout ratio 0. If R is less than KE, optimum payout ratio 100%. If R is greater than, R is less than KE means you cannot earn what they are expecting. You cannot earn what they are expecting. In that case, what? Optimum payout ratio is equal to 100%. Optimum payout ratio is equal to 100%. Are you getting my point? The next one is portfolio decision. So this is very important, portfolio decision. So SFM means first priority. We should learn portfolio management. Okay. So portfolio decision will also come under the scope of financial strategy. What is the portfolio? Portfolio means two or more assets, two or more securities, two or more investments. Portfolio decision means, we should not invest money in one asset. We should diversify the investment. We should diversify the investment. Okay. So portfolio decision. Portfolio means two or more assets. Okay. So these are all comes under what? Which category? Which scope of a financial strategy? Now, let us come to introduction to investment decision. Why we are discussing investment decisions? Because investment decisions fall within the scope of a financial strategy. That comes under our purview. So that's why we are discussing investment decision. Investment decision may relate to long term or short term. For short term working capital management, there is no, we do not have working capital management in our syllabus. Long term decision means capital budgeting decision. So what are the examples for capital budgeting decisions? For example, purchase of a new plant and machinery. Purchase of a new plant and machinery is a capital budgeting decision. For suppose for Larsen and Toubro company, construction of a metro rail project is a capital budgeting decision because metro rail project is a long term decision for L&T. For GMR International Airport, Rajiv Gandhi International Airport located at Hyderabad is a long term decision, capital budgeting decision. For PVR Inox, every multiplex is a long term decision. Are you getting my point? Okay. So likewise, so for Tesla, car manufacturing unit is a what? Long term decision. Okay. So the long term decision is known as what? Capital budgeting decision. So taking up of a new project, purchase of a new machinery, setting up of a new plant, spending money on research, advertisement is also a capital budgeting decision. Spending money on advertisement is also a capital budgeting decision because the reason is the advertisement. Generally, if we make an advertisement, we are going to get a benefit over a period more than 1 year. We will be getting a benefit for more than 1 year. Yes or no? I hope you still remember Nirma ad, washing powder Nirma. Okay. You might be you still remember OLX ad. OLX ad. Who is the brand ambassador for OLX? Bye. Allu Arjun. He was the brand ambassador for Rolex. Main boss. Okay. And next for quicker, Surya. Okay. Santur, Mummy, Mahesh Babu. Okay. So, I mean, even if they stop advertising, for the next 2 3 years, we still remember what? Santur. Yes or no? Likewise, Coca Cola, Thumbs Up. Okay. So, we might, I mean, for next 2 or 3 years, even though they do not make an advertisement, we are going to purchase. Yes or no? So, advertisement is also a capital budgeting decision. Okay. So these days, manufacturing a product, more than manufacturing a product, advertising is very important. Advertisement, publicity is very important. Okay. Publicity. I think you have watched Pushpa and Pushpa 2, both, yes or no? Which part you like? One or two? One. But second movie collected more, yes or no? Second part. Okay, when compared to part one, part two is nowhere. I mean, so my perception and your perception also. But publicity is at peaks. When collections were declining, again, so police came and they are arrested and again, okay, peaks. Publicity is peaks, marketing is next level. I mean, I'm not saying that police case is a marketing, but initially the marketing done by them, PR, was very good. I mean, nowadays, just producing a product is not enough. Okay. You might have seen Satyam Chandra movies, some other movies also. You might have, found those movies well, or some movies. But they are not doing well because the reason is publicity. PR is very important. Okay. So, Triple R, if you observe Rajmouli movies from the beginning itself, he will be, good PR. During Chhatrapati, they played cricket, Prabhas, okay. And next, during Bahubali, they made cooking and everything. So, and at the same time, to create a pan India market also, instead of marketing here, they were marketing where? Outside. For example, he went to Bihar for pre-release function. Okay. So that's how they are doing market. So when okay people come to Bihar, what is our feeling? Are in Bihar itself he is having so much of space. That is our perception. Are getting my point? This is the psychology. Okay. So PR is important. So these days, even if you do a business, even if you are producing a good product, that will not bring you a profits. Marketing, PR, publicity is very, very, very important. Very, very important. Okay. So Kampa, have you came across Kampa cool drink? Kampa cool drink. Cola. Kampa cola. So it is not that famous. I'm not commenting about taste. That is not. Every distributor is not distributing that Kampa cola and all. Why? Because the reason advertisement. Advertisement makes everything. Advertisement. It creates an impact. Okay. So whether it is good or not. Okay. So advertisement, if some celebrity comes and says, we feel that okay, it is safe and we can consume. Okay. Mahesh Babu, he won't drink cool drink. He won't consume what? Cool drink. He never drinks milk. Okay. Chiranjeevi, he will not consume country delight. Okay. So the point is, so advertisement will make a impact. So spending money on advertisement and research. So generally research will be done by pharmaceutical companies, cosmetics, skincare products. Okay. So skincare products nowadays, skincare industry is growing rapidly. Okay. So nothing but what traditional skincare has gone. Traditional skincare, haldi, using haldi and all. Now what a sunscreen. So these are came. So advertising and research also comes under what? Okay, capital budgeting. If you do a research and if you are inventing a new formula, you can get a patent and the patent validity will be around 20 years. Okay. So you will be getting benefit more than 1 year. So that's why spending money on research is also a capital budgeting decision. Next, the phases in capital budgeting decision. What are the phases? The phases are planning, analysis, selection, implementation, review. And after implementation of capital budgeting decision, we review the project. This review will help, while taking up of the next project. This experience will help, this review will help us to, to take a decision for the new project. So that's why there are 5 steps of planning, analysis. In analysis, there are several analysis, market analysis, technical analysis. Okay, but we are concerned about financial analysis. As a finance department, we are concerned about what? Financial analysis. Market analysis is not our job. That will be done by the PR team. If you have to start a PVR, okay, multiplex theater, so PR will, okay, public relations department, they will do a market analysis, whether occupancy will be there or not, how the OTT is going to affect, and how this OTT is going to affect, and how the hike in ticket prices is going to affect, whether there will be any occupancy or not, how the snack prices are going to affect the occupancy. Okay, so all these are going to affect what? Our decision. But market analysis will be done by PR, public relations department, but we are concerned about only what? Financial analysis. That marketing department will give us occupancy, will give us the life of a multiplex theater. They will give a price, what price can be charged. Okay, based on that, we will be finding out NPV, and then we decide whether the project is feasible or not. But this was earlier. But now the functions of CFO has become wider. If we are just getting restricted to our finance, then there will not be any growth. We have to do market analysis also. We have to involve in everything. Okay. So the point is analysis, selection, implementation, and then okay, review. Capital bursting decisions are considered most important. Most important capital bursting decision. Why it is most important? Capital bursting decision. Capital budgeting decision is most important because the reason is substantial amount of investment. Capital budgeting decision, capital asset itself means that involves what? Substantial amount of investment, huge amount to be invested, and it is irreversible. Once you have taken a decision, it cannot be reversed. It cannot be reversed. Example, so Amaravati capital project is a long-term decision for Andhra Pradesh. Yes or no? Okay. It involves a substantial amount of investment. Whether it is a reversible or irreversible. Irreversible. Once you have taken a decision, that cannot be reversed because already agricultural lands were procured, already 100 feet drainage system and roads, the work has been done. If a government decided not to construct a capital there, okay, so even if it give lands back to the farmers, farmers cannot do farming because those lands now cannot be used for what? Farming purpose. That means before taking a decision itself, you have to think twice. Okay, it is irreversible. And why it is important? Because it may affect the going concern of a company also. going concern of a company. If Amarapati capital was built and if it is not profitable, then going concern of AP is going to affect. Like some people say Kaleshwaram project is, not financially feasible. Okay. So that might affect what going concern of Telangana. Too much of amount is invested. Okay. So irreversible. Once the decision is taken, it cannot be reversed. Okay. And next, difficulty in estimating the benefits. Difficulty in estimating the benefit. Estimating the benefits is a difficult task. In classroom, we will be able to do problems comfortably, but practically, estimating the benefits is too difficult task. Too difficult. For example, so while going back to home, so whether you go by, you have a choice to go by Rapido bike, Rapido auto, Rapido car, or bus, or metro. These are the options, yes or no. See from the other side. From the other side, metro rail project is a capital bursting decision to the L&T. Okay, bus is the capital bursting decision to the TS, TG, RTC. Okay, are you getting my point? Rapido bike is a capital bursting decision to the biker, rider. Auto, okay, driver, for him it is a capital bursting decision. Okay, cab, for driver it is a capital budgeting decision. And for Rapido, okay, is also a capital budgeting decision. Even Rapido owner, investor, promoter will not know how many people are going to travel on a Rapido bike or a car or a auto. Yes or no? So estimating the benefit is very difficult task. From the point of view of L&T, how many people are going to travel in metro? Estimating it is a difficult. And based on the people traveling in metro, so L&T will be getting a advertisement revenue. If nobody is traveling in metro, then nobody is going to advertise. Yes or no? And based on occupancy only, the rent of outlets, Vijayata, KFC, whatever might be in a metro station, they will pay rent. Yes or no? The rental income, advertisement income, and ticket revenue, all these three are dependent on occupancy. Even we don't know in the evening whether we go by bike, a cab, or a car, we do not have a certainty. But from the other side, L&T has to what? Estimate the benefit. So it is difficult, yes or no? And GMR airport revenue depends upon again occupancy. That depends upon multiple factors: occupancy, government, okay, regulatory decisions, okay, number of airlines operating, number of airlines operating. So based on that, advertisement revenue will depend, landing charges revenue will depend, parking revenue will depend, rentals will depend. Yes or no? Are you getting my point? Of course, there is a huge occupancy in, GMR airport. Hyderabad airport is occupancy is more than MGBS bus stand. Okay. So these days, the point is, so difficulty in estimating what? The benefits. It is difficult. So that's why the capital bursting decision is very, very important. Long time period. Long time period. Once you have taken a decision, you cannot take it back. Irreversible. At the same time, you are going to get a benefit in not in 1 year or 2 years. Benefit long time period. In all these infrastructure projects, metro, airport, roads, whatever, the benefit will be received in 15 to 20 years, sometimes 30 years also. That's why generally preference shares redeemability period shall not exceed 20. But in case of infrastructure projects, it can extend up to 30 years. Maybe ఇప్పుడు 40 అయి ఉండొచ్చు, I don't know. But earlier, why? What is the logic behind it? Because in case of infrastructure projects, construction of a project itself will take 5 to 10 years. Then afterwards, a return will be recovered in 20 years. So that's why redeemability period will be, is up to 30 years. Okay. So these are the reasons for importance of a capital budgeting. Okay. Irreversible, long time period, substantial amount of investment, difficulty in estimating the benefits. Now let us come to the concept 3, estimation of a project cash flow. Estimation of a project cash flow. So you have to keep in mind time value of a money. The rupee as on today is not equal to the rupee to be received in the future. Okay. So practical thinking is very important in capital budgeting. So in case of a capital budgeting, so there are non-discounting techniques and discounting techniques. But our main focus will be on discounting techniques. In examination, 7 marks question will be asked for discounting techniques. Okay. So there are non-discounting techniques and discounting techniques. Before learning these capital budgeting techniques, the first crucial part is more than a technique. First crucial part is estimating the cash flows. Estimating the cash flows. For suppose we are purchasing a bus for BCCA. Is it a capital budgeting decision or not? Bus to carry junior MAC students. To carry MAC students, we are purchasing a bus. Now the point is it a capital budgeting decision or not? Capital budgeting decision or not? It is a capital budgeting decision. Because the reason is, if I purchase bus today, am I going to get a return in 1 year or more than 1 year? More than 1 year. Because life of bus will be more than 10 years. More than 10 years. Yes or no? So that is a capital budgeting decision. So give me a simple, figures. So I have to estimate a cash flows. First, what initially I will be having an inflow or outflow? Initially, inflow or outflow? Outflow. Because I have to purchase bus. Let us say 40 lakhs. On purchase of bus, after purchasing a bus, I will carry MEC students from house to college and college to house. I will collect fee. Yes or no? So we will be collecting what? Fee. And against that fee, we are going to incur what? We are going to incur driver's salary, cleaner's salary, petrol or diesel, whatever it may be, repairs and maintenance, lot of expenses. Nothing but what we do every year, fees minus these expenses will be my cash inflow. So I have to estimate what? Cash inflow for the next 10 years. Yes or no? For suppose for L&T, initially outflow or inflow? Obviously, in all capital bursting decision, initially there will be outflow. The outflow can be in the 0 year. For example, in case of a bus, outflow will be in 0 year. Immediately I am going to incur what? Cash outflow. But whereas in case of metro rail project, airport construction, roads construction. So in that case, I will be incurring outflow in 0 year, first year, second year, third year, 4, 5 depends. Cash inflow might arise from 6th year. Are you getting my point? Actually, those kind of problems will not be asked in examination. Practically, that is relevant. Are you getting my point? Generally, in examination or in books, outflow will be given in the 0 year, from first year inflow. But practically, in case of infrastructure projects, 0 year outflow, First year outflow, second year outflow, third year outflow, fourth year outflow, fifth year outflow, and then inflow might come. Sometimes inflow might come from 11th year. Sometimes inflow might come from 31st year also, like Polavaram project, not yet completed. Okay. So the point is inflow might arise. Inflow might arise in the future. Clear the point? So in case of multiplex theater, in case of PVR Inox multiplex theater, initially outflow for construction of a theater, AMB cinemas. Okay. And next to how the inflow will arise, ticket revenue, ticket revenue, and next shop rentals. In multiplex theater, we might take one outlet for selling juices or popcorn something. Okay. So or multiplex theater, they might sell these products on their own. Depends. So they might get rent. They might get snacks revenue on snacks. Next advertisement. Main revenue what? Advertisement. But advertisement revenue mainly dependent on occupancy. If there is no occupancy, there will not be any revenue from tickets, revenue from advertisement, and revenue from snacks, no rent. Okay. So that risk is always involved. Uncertainty. That is why we are going to learn evaluation of a risky proposals chapter, next chapter. In this chapter, we are not talking about uncertainty or risk involved in capital budgeting decision. In this chapter, we assume that no risk is involved in capital budgeting decision. In this chapter, we assume that no risk is involved in capital budgeting decision. Are you getting my point? Okay. So now, estimation of a project cash flow. This is a crucial part. So first estimation, initial cash outflow. Initial cash outflow, purchase cost of asset, transportation cost, installation and other incidental cost. Working capital is also initial cash outflow. Sir, what is this working capital? What is this working capital? So for example, we came to Hyderabad with an intention to start all commerce courses, CMA plus CA, ACCA, all courses. Okay. So this is a capital budgeting decision. So we are purchasing a camera, benches, everything. These are all capital assets. But along with this capital investment, we have to make a working capital investment as well. What is the working capital investment? We have to get a print of a CA inter books, CA foundation books, CA final books. Yes or no? Are you getting my point? So we should get print of a company secretary books as well. We should get print. We have to maintain a stock. So these books printed, whether it is a current asset or a current asset or a capital asset. Current asset. That is a current asset. So at any point of a time, you will be finding books, BCCA books, yes or no? But suppose SFM books were not available right now, but we will be ordering for print. Again, 1000 books will come, yes or no? After selling these 1000 books, again we will be going for printing. So the point is, while taking up of a new project, along with a capital investment, you have to make an investment of a working capital also. For example, if a DMart, they wanted to start a new unit. In that unit, they will be constructing a structure, yes or no, with iron structure. That iron structure is a capital investment. But along with structure, that structure inside they have to maintain what? Stock. That stock is what? Working capital, investment. That is also a outflow in the initial year. That will be inflow at the end of the project. Working capital is outflow in the 0 year and inflow at the end of the project. Why it is inflow at the end of the project? Why it is inflow? Because when the project is ended, obviously I will take back my investment in working capital. I will sell all the books and I'm not going to order for new books. Yes or no? Likewise, I will be selling all the stock in DMart. I'm not going to order new stock. Yes or no? If a business is winding up, if a project is winding up, then people will take back their investment in working capital. For suppose, if you have gone to almond house and if you are not finding any sweets there, what is your opinion? They might be closing the business. That is our perception. If you're going to Kirana store and in that Kirana store all racks were empty and you might have finding one Medmix soap and two Santoor soap, what is your feeling? What is your feeling? This business might be closing. Nothing but if a business is going to close or if a project is going to end, then we take back our investment in working capital. So that's why working capital is outflow in the 0 year, inflow at the end of the project. You might forget working capital at the end of the project. Our subconscious mind will not remind. Okay. So working capital is inflow at the end of the project. Sunk cost. Sunk cost means the cost which was already incurred and not relevant for decision making. Sunk cost means the cost which was already incurred and not relevant for decision making. For example, okay. For example, yesterday I have seen, some short Indian 2, Indian 2 movie. So already they have spent 243 crores on Indian 2. After spending 243 crores by Leica Productions, some producer, went and told, so you have already spent 243 crores, leave it here itself. If you're going to complete the movie and if you release the movie, then you will be end up with getting a even more loss. Getting my point? They have already spent 243. Okay. So one producer has given suggestion to the another producer, original producer. What is the suggestion? Just stop the shooting because no story, nothing, and this movie is going to become a flop. So already you have spent 243 crores, just leave it. If you're going to complete the shooting and if you release the movie, then you're going to get a even more loss. Okay. So the point is, for suppose we shall take a same example. Ishwar, he is a director. Ishwar is a director and Prasanna producer. Prasanna producer. Okay. So Ishwar, he told that movie budget is 250 crores. What is the movie budget? 250 crores is the budget. Kamesh is the hero. He is having a pan India presence. Okay. After Prabhas. Okay. So, sorry, after Prabhas, Allu Arjun and then Kamesh. Okay. So, now Kamesh is the hero. So, Ishwar communicated story to producer. Producer, he got convinced 250 crores is the budget. Okay. So, Ishwar, he spent 250 crores for one song and one introduction scene. Only for one introduction scene and one song, he spent how much? 250 crores. Okay. So 250 crores already spent. So second half had to be shooted. Now Ishwar again came to Prasanna Kumar and he asked for funding the second half. So Prasanna Kumar asked, what is the, amount required for completing the shooting? He told another 350 crores required. Another 350. Okay. Already 250 crores spent. Now what is the amount required, further amount required? 350 crores is the further amount required. Okay. So Prasanna Kumar, next question is, what is the market of our hero, Kamesh? Market. I hope you are aware of market. Market in the sense, for example, Prabhas movie, okay, will be watched by everyone. Sahos, Salar, everything. So got collections, yes or no? So Manchu Vishnu, he is also having a pan India presence. Kannappa, okay. Fifth place in Bollywood. So the point is, when compared to Prabhas and Manchu Vishnu, Prabhas is having a less market. Okay, let us assume. Now the point is, so now the question is, what is the market of a Kamesh? Kamesh is having fans all over the India, Bangladesh and Pakistan. So what is the market? Okay, 500 crores is the market. 500 crores is the market of a Kamesh. Already spent 250, amount yet to be spent 350. 600 crores is the total budget of a movie. Okay. And what is the market of a Kamesh? 500 crores. So pure accounting. So what is the profit or a loss? Loss. What is the loss? 100 crores. Expected loss is 100 crores. This is the pure accounting. But as a finance manager, you have to take a decision whether to continue shooting or not. Whether to continue shooting or not. So, are you going to continue shooting or not as a producer? Shooting should be continued or not? Are you getting my point? Already 250 crores spent. Already 250 crores spent. We are not going to get back the 250. Yes or no? That means we should not keep in mind that 250. That 250 is irrelevant for decision making. That is not relevant for decision making. Yes or no? Now, Prasanna Kumar, producer, he has to consider only two figures. What is the further investment? 350. What is the collection he is going to get? 500. So he is going to get a profit of, incremental profit of 150. Nothing but if he stops shooting now itself, he is going to lose 250. If he complete the shooting, then that loss will get reduced to 100. Are you getting my point? So sunk cost means the cost which was already incurred, that is 250 crores. Okay, and it will not have a relevance. It is not relevant for decision making. Because whether you complete shooting or not, anyway you are not going to get that 250 crores back. Are you getting my point? So sunk cost means the cost which was already incurred and has no effect on future capital budgeting decision. Future capital budgeting decision. Are you getting my point? So one more example, research and development. Research and development. Kamesh is a scientist and chemical engineer, research expert. He made a research on a manufacturing waste. So after spending 1 crore, he found that this waste can be further processed. Waste can be further processed and a product X can be produced and sold in the market. Okay. For that, an equipment worth 20 crores to be purchased. Are you getting my point? Kamesh, he has done a research on manufacturing waste. What he realized that, what is the realization? If waste is further processed, then product X can be produced and can be sold in the market. But for that, an equipment worth 20 crores has to be purchased. Okay. So now, whether to purchase an equipment worth 20 crores or not is a capital budgeting decision. Yes or no? Whether to purchase an equipment worth 20 cr is okay, worth or not, that is a capital budgeting decision. While taking that decision, the research expenditure which was already spent 1 cr is relevant or not relevant? Not relevant. The amount already spent is not relevant. Why it is not relevant? Why it is not relevant? Because for suppose a company is not going to buy an equipment, whether I will get 1 crore back or not? No. I will purchase an equipment. Will I get it back? No. So that means 1 crore has no relevance because that 1 crore was already spent. So sunk cost means the cost which was already incurred, and it will have a no effect on a future capital budgeting decision. Okay. Are you getting my point? So estimation of a cash flows. First one, what? Initial cash flow. Initial cash flow. Okay. Next, the subsequent cash flow. Subsequently, what we are going to get? In conventional cash flow, cash outflow occurs at the initial period and a series of a cash inflow occur in the subsequent periods. Yes or no? Conventional cash flows. For example, in 0-year outflow, first year inflow, second year inflow, third year inflow. So these are the conventional cash flows. On the other hand, non-conventional cash flow. Non-conventional cash flow means it involves intermittent cash outflows. Intermittent cash outflows. In the subsequent periods, also for major repairing, additional working capital requirement, etc. Are you getting my point? For suppose, sometimes what we do is, we have constructed a building, initial outflow. Okay, building life is 20 years. But after 5 years, again what? So we have to do some repair works, especially in case of boys hostels. Okay. So hostels, boys hostels and girls hostels. So after 5 years, again we have to incur what? Okay. Expenses. I mean, substantial amount for repairing. Okay. Sometimes additional requirement might be there. So that is unconventional, non-routine. Non-routine. So nothing but non-routine is what? 0-year outflow, first year inflow, second year inflow, third year inflow, fourth year inflow, fifth year outflow, sixth year again inflow. This is non-conventional. This is non-conventional. Conventional means 0-year outflow, and after that inflow. So clear? Prasanna, Nikita, sorry Likita. ఫోటోలే ఉండవు, మా పేరు కనిపిస్తుంది అంతే. So next one, cash inflow after tax. Cash inflow after tax. Okay. So what are the three fundamental essential elements of a business? A clear and realistic strategy, a clear and realistic strategy, financial resources, next financial resources, next management, okay, right management team. So these three are the fundamental essential elements. What is the objective of SFM? Wealth maximization. Wealth depends upon two factors. One is the return, profit and risk. If a profit increases, wealth increases. If risk increases, required return increases and wealth decreases. Wealth decreases. Okay. So, what are the decisions falling within the scope of financial strategy? The decisions are falling within the scope of financial strategy or, so first one, financing decision from where to procure money, and second one, investment decision where to invest, and next dividend decision whether to declare a dividend or not, and next portfolio decision. Portfolio decision. So procurement of fund can be done from two sources, equity and debt. How to procure fund and all we have discussed in CMA inter level. And next dividend decision was also discussed in CMA inter, and investment decision, long term decision, short term decision. Short term decision is nothing but working capital management, already discussed. And now we are discussing long term decision. Portfolio means two or more assets or securities. Okay. So now capital budgeting, investment decision is very important because the reason is it is irreversible. It involves a substantial amount of investment. Next, long time period. Long time period. For suppose if you are making investment as on today, you will be getting inflow over a period of 10 years or 20 years. So that is a long time decision. Next one is difficulty in estimation of cash flows. It is not that easy to estimate the cash flows. Okay. So before proceeding to capital budgeting techniques, we are discussing what cash flows, estimation of a cash flows. First we have to estimate what? Initial cash flow. Initial cash flow in the sense, first purchase of a asset, transportation cost, installation and other incidental cost. Here transportation cost means cost incurred for bringing the machinery from, okay, supplier to the our place, supplier to our place. Okay. And next working capital is also outflow in the initial year. Working capital is the outflow in the initial year. And next working capital is outflow in the initial year and inflow at the end of the life of the project. Sunk cost is the cost which was already incurred and not relevant for decision making. Sunk cost is not relevant for decision making. Okay. So it was already incurred. Example, research and development, research expenditure. Research expenditure which was already incurred is not relevant for decision making. Okay. To purchase an equipment or not. Next, generally there won't be any after outflow series of a cash flows will be followed. That is a conventional cash flow. Under non-conventional cash flows, so there can be outflows after certain period of a time with respect to repairing, major repairing or working capital requirement. Okay. Now let us discuss cash inflow after tax. Cash inflow after tax. Prasanna, can you please call me? Cash inflows after tax. So income statement. Generally, costing income statement is sales minus variable cost, contribution minus fixed cost, profit. I mean, in costing, what is the income statement? Sales minus variable cost, contribution, sound increase, contribution minus fixed cost, the profit. So this is the income statement under what? In costing. Income statement in costing. Okay. So in costing, interest is not considered as an expense because interest is a pure financial expense. Tax is also a pure financial expense. Dividend is also a pure financial expense. So this is the income statement. Okay. Whereas in FM, financial management. Financial management. What is income statement? Sales minus variable cost, contribution minus fixed cost, EBIT, earnings before interest and tax. EBIT, earnings before interest and tax. The next, interest is an allowable expenditure, so that's why we reduce what? Interest, and then earnings before tax minus tax, earnings after tax, sorry, and next minus preference dividend, minus what? Preference dividend. So earnings available to equity shareholders minus equity dividend. So minus equity dividend, then I will get what? Retained earnings. Retained earnings. Yes or no? And earnings per share is equal to earnings available to equity shareholders divided by number of shares. Earnings per share is equal to earnings available to equity shareholders divided by number of shares. Number of shares. Okay. So this is the earnings per share. Am I clear? So this is the income statement under financial management. Okay. But whereas for capital budgeting, we have to consider cash flows, not the profit. We should not consider what? Profit. Profit is a vague term. Profit is a vague term. For example, so this is the profit as per costing. Yes or no? And this is the profit as per FM. That too, that is the profit available to all the investors, including preference shareholders and equity shareholders. So this is the profit available to the firm. That is the profit available for equity shareholders preference holders, debenture holders. Okay, this is the profit available to equity shareholders, and this is the profit before tax. So the point is, profit is a vague term, unclear. Profit is unclear. So that's why in capital bursting we are not going to consider profit for decision making. So we have to consider what? Cash inflows. Cash inflows. And in the picture we are not discussing about accounting profit. Accounting profit. I have mentioned only costing profit and financial management profit. But there is another term. What is that? Accounting profit. And there is another one, profit as per Income Tax Act, PGBP. Okay, so profit is a vague term, unclear. And why we should not consider profit? Because the reason is, profit is arrived after reducing depreciation. Profit is arrived after reducing depreciation. After reducing depreciation. So what happens, sir? If I consider depreciation, how does it affect? For example, how do we calculate NPV? Investment. NPV, what is the formula for NPV? Sum of a discounted cash inflow. Okay, forget about inflow and discounting also. For suppose if we are taking a profit, profit means nothing but already you have reduced what? Depreciation. After reducing depreciation only profit figure is arrived. Yes or no? So now again you are reducing from the profit, total profit. Okay, you are reducing what? Investment. You are reducing investment. Then you will get what? NPV. But suppose instead of cash inflows, if you are taking a profit, forget about discounting. So nothing but what you are doing, a profit for the entire life minus investment. So why we should not consider a profit for capital budgeting decision? Because the reason is, one of the main reason is, here you are reducing depreciation 2 times. How you are reducing depreciation 2 times? The profit figure is arrived after reducing depreciation. Yes or no? And this investment itself is also a depreciation. Investment is also depreciation. Yes or no? For example, if you are purchasing a machinery for 10 lakhs, life is 5 years. So then what is the depreciation? 10 lakhs divided by 5. So depreciation per annum 2 lakhs. So here under investment head you are reducing 10 lakhs. Okay, and to arrive the profit figure you are reducing what? 2 lakhs per annum. If the life is 5 years, overall you are reducing what? 10 lakhs. That means 2 times you are reducing. So that's why we should not consider what? Profit. We should not consider profit because the reason is, you are considering 2 times as an expense, as an outflow. Investment, for example, cost of a machinery is 10 lakhs. Cost of a machinery what? 10 lakhs. Life how many years? 5 years. What is the depreciation? 2 lakhs. Okay. So now to arrive at NPV. So how do we get NPV? Sum of a discounted cash inflow minus sum of a discounted cash outflow. My point is, instead of cash inflow, if you take profit, then profit minus what? Investment. So total profit in the sense profit per annum into 5. Profit per annum into 5. Ignore the time value of the money. Now you are reducing depreciation how many times? 2 times. Okay. How do we get profit? Revenue minus cost. In that cost you are including depreciation. You are reducing, and again you are reducing what? Your investment. So that is having a double effect. So that's why we should not consider what? Profit for capital budgeting decision. And profit is a vague term. Profit is a vague term. Are you getting my point? Okay. For example, Sales equal to 10 lakhs minus cost 5 lakhs. So let us assume this 5 lakhs is the profit, or 8 lakhs, consider this 8 lakhs, 2 lakhs is the profit. Okay. In that cost already you might have included what? Depreciation. How much? 2 lakhs. So 2 lakhs into life of the project is 5. So the total profit is 10 lakhs minus what is your investment? 10 lakhs. And what is our NPV? 0. Profit from the investment is 0. Is this correct or not? No. Because the reason is you are reducing your investment 2 times. Okay. Here in this 8 lakhs, you already considered how much? 2 lakhs. And again, this 2 lakhs is being multiplied with 5. Double effect. So that's why what? We should not consider profit. We have to consider only what? Cash flow. Okay. And now, how to find out annual cash inflow? Annual cash inflow. Before, noting down the income statement, or before understanding the income statement, let us assume, let us apply our common sense. So purchasing a bus for junior college is a capital budgeting decision. Yes or no? Okay. And now these days you might have seen T times something, T times. Okay. So without making a large investment, so on highways, okay, they are constructing what? Temporary structures. Temporary structures means nothing but having a life of 5 to 10 years. Okay. So using iron sheets and all. Yes or no? For suppose if Prasanna he wanted to start a tea time. He wanted to start a tea time. The point is he has to make some investment. That is our initial cash outflow. Just visualize after investing, okay, how Prasanna Kumar is going to get a return. In the tea time, Prasanna Kumar will be selling what? Snacks, tea, coffee, etc. Yes or no? So nothing but he will get money from the customers. He will get money from the customers. So what is the first one? What is the revenue source here? Selling tea, okay, coffee and snacks. So sales. So the amount collected from customers is not our net cash inflow. Yes or no? For example, Prasanna Kumar, he is collecting 10 rupees from the customer. This 10 rupees is not the cash inflow. Yes or no? Because for making tea, he has to incur what? Incur material cost, labor cost, overheads and all. Yes or no? Nothing but he has to incur variable cost and fixed cost. He has to pay salary to the employees. He has to pay salary to the employees. Yes or no? So the point is he will be incurring costs which can be categorized into variable cost and fixed cost. Am I correct or not? Just visualize. Okay. Okay. Likewise, if you are operating an aircraft, you will be collecting fare from the passengers. So that is your sales minus what? Variable cost. So for operating the flight between the cities, aviation turbine fuel. Aviation turbine fuel will be what? Variable cost. And at the same time, irrespective of occupancy or irrespective of traveling time, so salary has to be paid to the pilot and air hostess. Yes or no? So there will be some variable cost and fixed cost. So sales minus what? Variable cost. Contribution minus what? Fixed cost. Okay. So this is nothing but our cash inflow. This is our cash inflow. So collecting 10 rupees collected from customer, against the 10 rupees we are going to incur variable cost and fixed cost. After reducing variable cost and fixed cost, the amount left is the cash inflow, but that is the cash inflow before tax. We have not yet paid tax. Income tax department will come and ask you, you have started your tea time, you are generating a revenue, you have to pay taxes, yes or no? So this is not your net cash inflow, this is what? Cash inflow. Please do understand the terms. Cash inflow before tax, because tax was not yet paid. So simply we have reduced, okay, variable cost like tea powder, sugar and all. And next, salary to the staff. Okay, tax was not yet paid. So that's why this is called as what? Cash inflows before tax. Am I clear? Now, this is also called as profit before depreciation and tax. Profit before reducing depreciation and tax. Why it is called as profit before depreciation and tax? Let me explain. So cash inflow before tax. So okay, income tax will, department will come and ask you to pay tax. Okay, so they might be charging 50% tax, and they are willing to charge 50% tax on this amount. Okay, so will you pay 50% on this amount? No, because the reason is, as per section 32 of Income Tax Act, depreciation is an allowable expenditure. Yes or no? Yes, no doubt. We have started at tea time. Due to tea time, our income has got increased. At the same time, we are, okay, incurring some depreciation. So, and the depreciation is what? Allowable expenditure. So that's why this cash inflow before tax is not the taxable profit. Are you getting my point? Because depreciation is allowed as an expenditure. So that's why what? Minus depreciation. Minus depreciation. So this is profit before tax. Okay. For suppose if income, if in the question income tax rate is not given, if in the question income tax rate is not given or income tax is not applicable, if income tax is not applicable, then profit before depreciation tax itself is the cash inflow. If income tax is not applicable, then profit before depreciation and tax itself is what? Cash inflow. Am I clear? Okay. So profit before tax minus what? Tax. Profit after tax, add depreciation, and then why I am adding depreciation again? Because depreciation is a non-cash expenditure that was reduced only for the purpose of calculating the tax. Okay, so that's why I am adding depreciation again. Then this is called as cash inflows after tax. Cash inflow after tax, or this can be called as profit after tax but before depreciation. Be careful with the terminology. Profit before depreciation tax means before reducing depreciation and tax. Okay. Profit before tax means before reducing the tax. Profit after tax means after reducing tax and depreciation. Okay. And again you are adding back the depreciation. So that's why we can call it as profit after tax, but before depreciation. Nothing but cash inflows after tax. Okay. So in capital bursting, understanding this calculation is very important. This is crucial because techniques are easy because already you are learned in CMA Inter. So techniques will be easy, but identifying the cash flows is the crucial part, difficult task. Identifying the cash flows. Okay. So for identification of a cash flows, you have to think practically. You have to create your own business. You might be having a business ideas. Many of the students might be missing the time value of a money, some opportunity cost. Let us say, for example, most of the students they are interested in starting what right now CA and CMA students study hall, okay, hostel, okay. They are interested in starting what study halls, okay, sitting in study hall. Okay, this person is collecting 2,500 per month. That means for 6 months, okay. So that's how what they will be starting that business, particular business, or they might be starting a girls' hostel or a boys' hostel. Okay, so they will have a tie-up with college. So that these are the businesses. But students missing some points. For example, if they are starting a study hall, okay, will a study hall have a goodwill or not? Are you getting my point? Will there be any goodwill or not? Will there be any goodwill? For suppose BCCA, I will teach classes for next 5 years. After that, so I can sell this venture to someone else. That time, the purchaser will be considering what goodwill, brand name. Yes or no? So by starting a study hall, by investing 40 to 50 lakhs in study hall, will that person is generating any goodwill or not? No. Even I don't know the study hall name, yes or no? So there is no, I mean, brand name. There won't be any brand name. Okay. So that study hall is entirely dependent on that person. Whenever you start any business, the business should not depend on one person, one particular person. If a business is dependent on one particular person, that means you are not creating any brand value. Okay. So for example, if it is a college, admission should come by seeing the college, not by the person. But suppose if that person does not exist, okay, due to various reasons, then the business will collapse, yes or no? Okay. So you might have seen food businesses also successful people, okay, but they might have not generated the brand name goodwill. For example, Paradise, okay, they have generated a goodwill. So the business was started as an individual, but later on, what they have created a brand, Pullareddy Sweets, Almond House, okay, Paradise, so Bawachi, etc., etc. All these were started by an individual, but later on, what we forgot the individual name, okay. But whereas in Guntur or somewhere you might have found, okay, uh, hotels or restaurants better than these, but they don't put any name. They keep on working from the morning to evening. Then what happens? After a certain period of time, if that person expires, so then there won't be any future for the business. Are you getting my point? So likewise in study hall, while taking a decision, first you have to consider what is your investment. The most important point to be considered is opportunity cost. If you are operating that study hall, you have to consider what? Opportunity cost. And will there be any growth in earnings or not? Will there be any growth in earnings or not? All these points are to be considered. So that's why if you observe, the owners of that study halls might be changing, keeps on changing, or they might be closing out the study hall. And that is dependent on another market. If a CA or CMA admissions gets reduced, then the study hall will also get affected. Okay. So there are a lot of points to be considered, and you have to think practically. So cash inflows after tax calculation, identifying the cash flows is very important point, crucial point. For example, if you are an RMP, okay, Prasanna Kumar, he is an RMP, okay, he is RMP. So he is having a patients, lot of patients, nearby villages. He is operating from the Mandal, okay. I hope you are aware of RMP, okay. The person who treats patients without having a degree, MBBS degree, okay. He's have a lot of patients. So for example, if a patient comes and if a blood test need to be done or some X-ray has to be taken, he is referring that patient to some other diagnostic center. Okay, okay. And if the disease is, I mean, if a disease can't be cured by RMP, then he is referring that patient to what? Another super specialty hospital. Now tell me, will he get any commission or not? Yes, he will get commission. If you observe, RMP will be referring every time to one particular diagnostic center only or one particular doctor only. Okay, so due to that, what? Prasanna Kumar will be getting what? Commission. Are you getting my point? Okay, and he will be writing a medical, okay, medicine required. And again, he will be having a tie with what? Medical shop, and he will get commission from what? Medical shop as well. Okay. Now the question is, first suppose if he wanted to start a medical shop himself, he wanted to start a medical shop himself, then that is a capital budgeting decision. Yes or no? So that is a capital budgeting decision. So he will be estimating the initial cash outflow and then he has to estimate the annual cash inflow. While finding out annual cash inflow, he will take sales minus variable cost, contribution minus fixed cost, and one more cost he has to consider is opportunity cost. By starting a medical shop on his own, he is losing an opportunity of earning commission. He is losing commission. If he start medical shop on his own, he is losing what? Commission, and the commission is the benefit foregone in choosing an alternative course of action that has to be considered for decision making. So that's why we have to reduce what? Opportunity cost as well. Are getting my point? And next, Prasanna Kumar, okay, his son completed MBBS FRCS and now he wanted to start his own super specialty hospital. So construction of this super specialty hospital is a capital bursting decision. So while taking that decision, he has to consider opportunity cost. He is losing an opportunity of commission because he will not refer patients to other hospital, right? Yes or no? He will get treated in other hospital, but he will not refer his patients to other hospital. Okay. So he is losing commission. So that commission is what? Opportunity cost. Okay. So this is a calculation. I mean cash inflows after tax. Next, terminal cash flow. Terminal cash flow. Terminal cash flow means end of the project. At the end of the project. Okay. At the end of the project, for example, tea time. Okay, every year you will get cash inflow, but at the end of the life, you will get additional cash inflow. What is that additional cash inflow? Salvage value of asset. Salvage value. If you visualize all the iron sheets, everything will be sold at the end of the life. Salvage value. And next, working capital realization. Tea powder, sugar, biscuits, Usmani biscuits, all those will be sold. Working capital realization. Okay. And at the end of the life, on selling an asset, we might get a gain or a loss. We might get a capital gain or a capital loss. If you are getting a capital gain, then you have to pay tax on gain of a asset. If you are getting a loss on sale of asset, so tax savings, you will be saving tax. Okay, how can we save tax? Because this loss can be set off with another, profit from another machine. This loss can be set off with profit from another machine. Okay, if there is no profit, then this loss will be carried forward to the next year, and this loss will be set off against the profit of next year. So that's why anyway we are going to what, save tax. Okay, so now these are the capital bursting techniques: payback period, payback, reciprocal, payback profitability, accounting or average rate of a return. These are the non-discounting techniques, and discounting techniques are discounted payback period, NPV, profitability index, IRR, modified NPV, modified IRR, adjusted NPV. So adjusted NPV is important from MCQ point of view. So most frequently asked MCQ multiple choice question, adjusted NPV. Adjusted NPV, simple. Okay. So do not forget about, adjusted NPV. You have to go through the main. For suppose this chapter comes under what? C category. But if you have no time, at least go through that adjusted NPV concept. Adjusted NPV. So MCQ, you can expect MCQ from this concept. Done? Clear? Now slowly we shall start question number 1. See the question number 1, simple question. This question is not for practice. This question is not for practice or refer, because this is a question for basic understanding. So that's why light. This question need not be referred also. This question is for basic understanding and this question need not be referred. I will mention which question to be practiced. So practice only that question. Okay. Practice only that question which I mention. Do not practice each and every question. Okay. For suppose if for other subjects, for SCM sir will be mentioning, Rajesh sir will be mentioning which question to be practiced. For suppose if they forget to mention which question to be practiced, ask them, or otherwise. So do think practically. For suppose during coaching, what is your class timings, 9 to 5 or 6? Okay. After class, how many hours you will be able to spend on this? Studies. 2 to 3. So okay, max you will be spending what? 3 years maximum. I am considering maximum time. Okay, I am assuming you are a dedicated student. Okay, so 3 hours. If you have a 4 subjects in group 3, so per subject you will be spending what? 45 minutes. Okay, and your class will be for how? What is the duration of your class? 2 hours. In 2 hours, 2 hours class has to be revised in 45 minutes. You have to limit only, you have to allot time to the subject, 45 minutes, that's it. Okay. So the point is 45 minutes, in 45 minutes, for suppose I have discussed 5 problems in the class. If you want to practice all the 5 questions in 45 minutes, is it possible or not? Not possible. So that's why you have to select 1 or 2 questions for practice. In SFM I will be mentioning, in SCM also sir will be mentioning. If they forget to mention, so follow this strategy. So generally what mistake student will do is in study hours or after classes, they will be okay starting with one subject. Let us say for example SFM. If they find SFM easy in that particular day, they will start with SFM and they keep on practicing SFM problems for the entire 3 hours. They will forget about DT and all. So that is not correct. Okay, even if you get 70 or 80 in SFM, that doesn't help you to clear group 3. Okay, so that's why you have to give equal importance to all the 4 subjects, or otherwise if there is a time constraint, then give priority to DT. In group 3, give priority to what? Direct taxes, because the reason you have to recall or remember lot of provisions, tax rates, etc., etc. So that's why give priority to what? Direct taxes, and then law, then SCM, and then SFM. So my only request is you're giving less time to SFM. That's okay, fine. But at least what? Give practice 50 questions. So that is enough. Okay. So the cost of a plant is here what? 5 lakhs. It has an estimated life of 5 years, after which it would be disposed of. Profit before depreciation, interest and tax is estimated to be 1,75,000 per annum. Find out the yearly cash flow from the plant. Find out the yearly cash flow from the plant. What is the tax rate? 30%. Okay. Generally these, small questions you feel like practicing, but this is not required. అర్థమవుతుంది. జనరల్గా హ్యూమన్ టెండెన్సీ ఏంటంటే మనకి ఏదైనా క్వశ్చన్ ఈజీగా అనిపించింది అనుకోండి, వెంటనే పెన్ ఆటోమేటిక్గా వెళ్ళిపోద్ది. ఓకే, బట్ ఏదైనా క్వశ్చన్ బాగా లెందీగా అనిపించింది అనుకోండి, చూడగానే ఏంటి ఇది మనం చేయకూడదు, ఓకే, రిఫర్ చేస్తారు. అదే పెద్ద మిస్టేక్. ఇప్పుడు ఇది అసలు ప్రాక్టీస్ చేయాలా అవసరం లేదా? అవసరం లేదు. ఈవెన్ క్లాస్లో రాయకపోయినా పర్లేదు ఈ క్వశ్చన్, బట్ మనకి ఇదే రాయాలనిపిస్తుంది. అదే కదా ప్రాబ్లం. ఓకే, సో చూడండి ఒకసారి. ప్రాఫిట్ బిఫోర్ డిప్రిషియేషన్ ట్యాక్స్. వాట్ ఇస్ ద ప్రాఫిట్ బిఫోర్ డిప్రిషియేషన్ ట్యాక్స్? 1,75,000 minus depreciation. What is the depreciation? 1 lakh. Earnings before tax 75,000 minus tax at the rate of 30%, 22,500. Profit after tax 52,500 plus depreciation 1 lakh and annual cash inflow 1,52,500. Question for basic understanding. Okay, you can strike it off because the reason might waste time practicing this question or referring this question. Okay, that's why. Question number 2. Question number 2. Kajal Limited is evaluating the purchase of a new machinery with a depreciation base of rupees 1 lakh, expected economic life. Evaluating the purchase of a new machinery with a depreciable base of rupees 1 lakh, expected economic life of 4 years, and change in earnings before taxes and depreciation of rupees. Change in earnings before taxes and depreciation of rupees 45,000 in year 1, 30,000 in year 2, 25,000 in year 3, 35,000 in year 4, and assume straight line depreciation and at 20% tax rate. You are required to compute relevant cash flow. For the last problem we have taken only 2 columns, particulars and amount, but for this problem we have to take particulars year 1, year 2, year 3, year 4, because cash flows are not even. Profit before depreciation tax is not even. So earnings before taxes and depreciation, first year 45,000, second year 30 third year, 25,000 fourth year, 35,000 minus depreciation. What is the depreciation here? 1 lakh divided by 4. 25,000 is the depreciation. So profit before tax 20,000, 5,000, 0 and 10,000. For suppose here if in this case depreciation is WDV, written down value, then you have to prepare a working note. Working note for calculation of a depreciation. Next, minus tax at the rate of 20%. Profit after tax, add depreciation. Okay. So this question also simple. So light. This is for basic understanding. For the first time you have to just refer. Not required. Okay. Why it is not required? For suppose even if this question is asked in examination, you will be able to do. Okay. Question number 3. Question number 3. Refer. Question number 3. Refer. A firm buys an asset costing rupees 1 lakh. A firm buys an asset costing rupees 1 lakh and expects operating profits before depreciation 20% WDV and tax 30% of rupees 30,000 per annum for the next 4 years. For the next 4 years, after which the asset would be disposed of for rupees 45,000. Find out the cash flows for the different years. Tax rate 30% is applicable to both revenue income as well as capital gain or a loss. Tax rate 30% is applicable to both revenue income as well as capital gains or a losses. Okay. The firm buys an asset costing rupees 1 lakh. In the previous question, this depreciable base is nothing but what? Asset cost. Okay. So now a firm buys an asset costing rupees 1 lakh, expects a profit before depreciation tax of rupees 30,000 per annum for the next 4 years. That means for all the 4 years, profit before depreciation tax is same. After which the asset will be disposed of for rupees 45,000. Find out cash flows for the different years. Tax rate 30%. Applicable both on revenue as well as capital gain. Now here depreciation, it is straight line method or written down value? Written down value. So that's why first we have to take a working note. Working note 1. Working note 1. Calculation of depreciation. Calculation of depreciation, particulars amount. Particulars amount. Particulars. First, what is the asset cost? One lakh minus depreciation first year. What is the depreciation for the first year? Depreciation for the first year 20,000. Next, WDV at the end of first year. WDV at the end of first year 80,000. Next minus depreciation. Second year 16,000. So 64,000 minus depreciation third year 12,800. So 40 or 50. 51,000 minus depreciation fourth year 10,000 to 40. So the answer is 10,000 to 40. So what is the answer? 40,960. So this is the book salvage value, book value, balance sheet value. Balance sheet value at the end of the fourth year will be 40,960. Here the new point we are going to learn is capital gain, tax on a capital gain. Okay. So working note 2. Terminal cash inflow. Terminal cash inflow. So terminal cash inflow. What is the sale value? Sale value 45,000 minus book value 40,960. Capital gain 4040. Capital gain tax 1212. 4040 is the capital gain. On that we have to pay tax at the rate of 30%. So what is the capital gains tax? 1212. Okay. Two eight. Now our subconscious mind, be careful with your subconscious mind. Generally what our subconscious mind will say is reduce 1212 from 4040. Generally, okay, 99% of the times we reduce this below number with from the above number. Yes or no? 99% కేసెస్లో కింద నెంబర్ని మనం పై నెంబర్ నుంచి ఏం చేస్తాం, రెడ్యూస్ చేస్తాం. ఇన్కమ్ స్టేట్మెంట్లో కానీ ఎక్కడైనా కానీ మనకు అది అలవాటు అయిపోయి ఇక్కడ కూడా అదే చేసి ఉంటాం. బట్ ద 2828 ఈస్ అ మీనింగ్లెస్ నెంబర్, బికాస్ హౌ కెన్ వి రెడ్యూస్ క్యాపిటల్ గెయిన్స్ ట్యాక్స్ ఫ్రమ్ క్యాపిటల్ గెయిన్? సో ఇట్లాంటి సబ్కాన్షియస్ మైండ్ మనతో చాలా మిస్టేక్స్ చేస్తుంది. ఎస్పెషలీ మరీ ప్రాక్టీస్ ఎక్కువైపోయింది అనుకోండి, ప్రాక్టీస్ మరీ ఎక్కువైనా కానీ ప్రాబ్లమే. ప్రాక్టీస్ మరీ ఎక్కువైతే అప్పుడు కాన్షియస్గా చేయం, మన సబ్కాన్షియస్ మైండ్ చేసేస్తుంది. అందుకే నేను కొన్నిసార్లు పేపర్ ఈజీగా వచ్చినా మన తక్కువ మార్క్స్ వచ్చేస్తాయి. పేపర్ టఫ్ వచ్చినప్పుడు బాగానే వస్తాయి మార్క్స్. ఇంకా పేపర్ టఫ్ వస్తే మనం వెంటనే కాన్షియస్ అయిపోతాం, అమ్మో కష్టం ఇక్కడ అని చెప్పి. ఈజీగా వచ్చినప్పుడు దెబ్బ అయిపోతాం. సో లైక్ వైజ్ ఇక్కడ అంటే ఇది ఒక్కటే కాదు మిస్టేక్ నేను చెప్తుంది, చాలా మిస్టేక్స్ ఉంటాయి ఇలాంటివి తెలియకుండా. అర్థమైందా? సో టర్మినల్ క్యాష్ ఫ్లో ఈజ్ ఈక్వల్ టు ఐఎమ్ సెల్లింగ్ మై అసెట్ ఫర్ హౌ మచ్? 45,000. Out of 45,000, I have to pay tax 1212. At the end of a fourth year, at the end of a fourth year, at the end of a fourth year, I am going to get what? Terminal cash inflow at the end of fourth year. Asset. So on purchase of that asset, what benefit I am going to get? I am going to get every year cash inflow, plus at the end of the life I am going to get terminal cash inflow. How much I am going to get? I am selling asset for rupees 45,000, and on that I have to pay capital gains tax 1212. So my terminal cash inflow is equal to 43,788. Am I clear? Okay. So this is the terminal cash inflow. Now let us come to the main answer. What is the main question? So main question. So find out the cash flows for the different years. Every year cash flows will not be same, because the reason is every year PBDT is same, but depreciation is not same. So that's why. So cash inflows. Cash inflows. So particulars. Year 1, year 2, year 3, year 4. So particulars. What is the first one? Profit before depreciation tax. Year 1. What is the year 1 profit before depreciation tax? 30,000. 4 years the same, 30,000. Minus what? Depreciation. What is the depreciation amount? First, 20,000, 16,000, 12,800, 10,240. Next, profit before tax. 10,000, 14,000, 17,200, 19,760. This is the profit before tax, minus tax at the rate of 30%. 3,000, 4,200, 12,040, 5,160. And next, 5,928. So profit after tax 7,000. Profit after tax 7,000. Next, 9,800, 12,040, 13,832, and then add depreciation. What is the depreciation? 20,000, 16,000, 12,800, 10,240. Next, annual. Sorry, before writing this, what is the first number? 27,000. Next, 25,800, 20, 24,840, 24,072. For this, we should add terminal cash flow. Terminal cash flow means cash flow arising on terminating, on closing, at the end of life. So that means we have to add at the end of fourth year. What is the amount we are going to get? 43788. So this is the cash inflow. 27,000, 25,800, 24,840, 67,860. In books, you will not be finding 100% correct answers. Generally in books. Okay, in leasing or capital bursting, if you apply your 100% knowledge, you will find answers, some answers wrong. For example, here we are considering what tax on a capital gain. Okay, sometimes we may not be considering tax on a capital gain. Okay, so I will tell you the wrong answers when they come in the class. Okay, so this question is not for practice. This question is for what? Okay, refer. Just refer, and that too. What is the point to be referred? The point to be referred is terminal cash flow. So this is the point to be referred. This is the point to be referred. Am I clear? Done? So this question is not for practice. Okay? Done? So let us start with capital bursting techniques. So what is the first capital bursting technique? Payback period. Payback period. So payback period means time taken for recovery of a investment. Payback period means time taken for recovery of a investment. Nothing but number of years in which the amount put in to the project will be recovered. So how do we calculate payback period? Payback period is equal to initial investment divided by annual cash inflow. If a cash flows are even, then simple payback period is equal to initial investment divided by annual cash inflow. You might get MCQ, multiple choice question. Okay, so there was a past MCQ on this concept. When cash inflows are not uniform, when cash flows are not uniform, then table. We take a table, year cash flow, cumulative cash flow. We take three columns, year cash flow and cumulative cash flow. So payback period means time taken for recovery of a initial investment. This is a non-discounting technique. Non-discounting. Nothing but we are not considering time value of a money. Okay, we are not considering time value of a money. So as per time value of a money, the rupee as on today is not equal to the rupee to be received in the future. Am I correct? So now payback period is equal to initial investment divided by annual cash inflow. Okay. So let us see the merits and demerits. Merits, it is easy to understand and easy to operate. Easy to understand, easy to operate. Okay. Demerit, it emphasizes on recovery rather than profitability. Our focus will be on how fast are we recovering our investment. Our focus will not be on the profitability, how much we are going to earn. Okay. Our emphasis is only on what recovery. Okay. Next, this method is suitable. Of course, this method is suitable for the industries where there is a technological obsolescence. Where the technological obsolescence is very high, there this payback period is relevant. What is the technological obsolescence? Change in technology. For suppose if a technology is changing fast, technology is changing fast, in that case, this payback period method will be used. Nothing but we select a project which is having a lesser payback period. So, okay. So, technological obsolescence is very high in case of electronics. Yes or no? In case of mobiles, laptops, cameras. Okay. So, the technological obsolescence is very high. Okay. In that industries, we use what? Payback period. Payback period means time taken for recovery of a initial investment. Next, this method promotes liquidity. Liquidity means ability to meet short-term commitments. Liquidity, ability to meet short-term commitments. For example, liquidity. What is the liquidity? So we say current ratio is the liquidity ratio. Liquidity means ability to meet a short-term commitment. So payback period promotes liquidity. How it promotes liquidity? Because the reason is we select a project having a lesser payback period. So our investment will get recovered fast so that we can make investment again. Liquidity position, nothing but always cash will be available. Always the cash will be available. Are you getting my point? For suppose in case of infrastructure projects, payback period will be very high. Yes or no? When payback period is high, what happens? We may face a liquidity problem. Liquidity problem means what? Are you getting my point? Liquidity problem is, for suppose if I have started recording my class. So this class may get completed in 1 month, 2 months, or 3 months. Okay. So the actual sales will be made after completion of this class. So for this 1 month or 2 months, I will be facing a liquidity issue because I will not getting any revenue, but I have to make an investment in purchasing camera. I have to pay rent, everything. Yes or no? So if a payback period is less, let us say for example payback period is only 4 months or 5 months. In that case, what happens? 4 days or 5 days. If a if a payback period is only 4 days or 5 days, then what happens? My liquidity position will be improved. Are you getting my point? Liquidity means having a cash in your hand. Having cash in your hand to meet the short term commitments. So payback period advantage is this method promotes what? Liquidity. Okay. The next, demerits of a payback period. What are the demerits of a payback period? It ignores time value of a money. And one more drawback is it does not consider cash flows arising after payback period. It will not consider cash flows arising after payback period. So for example, project X, project Y. Okay. Or let us see question number 4 with question number 4. Initial investment. What is the initial investment? 100 lakhs for both the projects A and B. The net cash flows are as follows. Project A 25 lakhs every year for 5 years. And for project B 20, 25, 30, 30, 20. So for first project cash flows are even, and for the second project cash flows are uneven. Okay. So simple calculation. Question number what? 4. Just refer. Project A. Payback period is equal to project A. Payback period is equal to initial investment divided by annual cash inflow. So that is equal to 100 lakhs divided by 25 lakhs. So the answer is 4 years. So we are able to recover our investment in how many years? 4 years. We are able to recover our investment in 4 years. Clear? Here we are ignoring the time value of our money. Our emphasis is only on recovery of our investment. Project B. Project B. So what are the columns project B? Year, cash flow, cumulative cash flow. Year column 1, 2, 3, 4, 5. What is the cash flow? What is the cash flow? 20, 25, 30, 30, 20. So this, I mean, in second case we cannot apply the formula initial investment divided by annual cash inflow because cash flows are not even. Okay, cumulative cash flow 20, 45. Why we are taking a cumulative cash flow column? By the end of our second year we are able to recover 45, but our initial investment is 100. So next 75. By the end of a third year we are able to recover 75, but our investment is 100. Next 105. That means by the end of a fourth year we are able to recover our entire investment. Yes or no? But 4 years is not my exact payback period. My payback period is between 3 and 4th year. So payback period is equal to 3 years plus, because by the end of a 3 years we are able to recover only 75 lakhs. So that's why payback period is equal to 3 years plus 3 years plus. What is the balance amount to be recovered? 25. But whereas in the fourth year we are able to recover 30. For 31 year. For 25, what is the duration? We have to find out. So nothing but 25 divided by 30 into 1. Are you getting my point? For 30 it is what? 1. For 25 lakhs, how much? So what is the answer? 3.833 years. So in MCQ they will be asking, they will be giving option with months. So some students might write 3 years, 8 months, 3 days. That is not correct. So what is the answer? 3 years. 0.833 years means nothing but 0.833 into 12, because for a year we will be having 12 months. So that's why 3 years, how many months? 0.833 into 0.833 into 12 months, nothing but 3 years, 10 months is the answer. 3 years, 10 months is the answer. So payback period is the most frequently asked multiple choice question. 3 years, 10 months. Done? Clear? 3 years, 10 months. Now, next point. So, what is the payback period drawback? We are ignoring the time value for money. Our focus is only on what? Focus is only on what? Recovery of a investment. We are not concerned about profitability. We are concerned about early recovery of a investment. Okay. And we ignore the cash flows arising after payback period. What is that point? So, which project are you going to select for, as per payback period? A or B? B, because B payback period is 3 years, 10 months. But suppose in this question, in 5th year, I am getting 100 lakhs. In the 5th year, 100 lakhs in the 5th year. Even then, as per payback period, I will be selecting project B, because I will select a project which is having a lesser payback period. For suppose in 5th year I am getting 100 crores. Even then, as per payback period, I will be selecting project B, because I ignore the cash flows arising after payback period. So this is the drawback. However, this method is useful. Where is this method useful? This method is useful where a technological obsolescence is high. So generally where a technological obsolescence is very high, so you will not be getting this much cash flows at the end of a 5th year. Yes or no? Where a technology is okay, keeps on changing, so we will not be getting any cash flow at the end of 5th year. Yes or no? 100 lakhs or 100 crores వస్తుందా? టెక్నాలజికల్ అబ్సెలెసెన్స్ హై ఉన్నప్పుడు, టెక్నాలజికల్ అబ్సెలెసెన్స్ ఎప్పుడైనా హై ఉన్నప్పుడు ఇనీషియల్గా ఎక్కువ వస్తుంది. ఫర్ సపోజ్ ఐ హోప్, so there are pricing strategies, penetration strategy and skimming strategy. Penetration, skimming. Penetration strategy is nothing but low cost strategy. Penetration strategy. So initially we keep a low price and later on the price will be increased. So further the best example is DMart, Jio. So Reliance Jio is the best example for penetration strategy. Okay. Initially the data charges were low. Later on, so by keeping this low, artificially low prices for data, so we can eliminate the competitors from the market. That is what happened in telecommunication. Yes or no? So later on the data charges will be increased. Data charges were increased. Yes or no? So Jio has followed what? Penetration strategy. However, if you observe these mobile phones, they will not be okay following the penetration strategy, pricing strategy, because the reason is technology keeps on changing. Risk of obsolescence is very high in mobiles. Mobiles, okay. So that's why if you observe any mobile, new model, they will keep some price. After 2 months or 3 months, the price will get reduced. Okay, so this strategy is known as skimming strategy. If you observe the Apple phone also, when Apple new model will come, no new model comes, then the price will be very high. Later on, the price will be reduced because the logic behind it is, so that is a skimming strategy, and lot of research is involved in bringing that new model. Technological obsolescence is very high. Skimming means, I mean, nothing but, for example, curd. If you skim the curd, what happens? Output, you will get two output. One is butter and the buttermilk. So skimming. That's how what the butter is collected from the market. So by charging high prices to recover our research and development expenditure. Okay. So because whenever Apple brings a new model or Samsung brings a new model, so competitor to imitate this model will take some time, 5 months or 1 year. Before the competitor imitates the model, so the company will skim the prices, will collect a lot of amount from the market. Later on, when the competitor imitated the product, competitor imitated the product, competitor manufactured the similar kind of a model and he wanted to enter the market, then the price will be reduced, so that it will become difficult to the competitor to sustain in the market. Are you getting my point? సో ఈ మొబైల్స్ కేసులో, ల్యాప్టాప్స్ ఇట్లాంటి సిచ్యువేషన్లో ఏ స్ట్రాటజీ ఫాలో అవుతారు? స్కిమ్మింగ్ స్ట్రాటజీ. స్కిమ్మింగ్ స్ట్రాటజీ అంటే ఇనీషియల్గా హై, లేటర్ ఆన్ ఏంటి, ప్రైస్ లో. లేటర్ ఆన్ ఎందుకు తగ్గిస్తారు? రీజన్ ఏంటి? ఏదైనా సాఫ్ట్వేర్ వచ్చింది అనుకోండి, సాఫ్ట్వేర్ కొత్తగా ఉంటుంది కాబట్టి అవతలాడు ఏం చేస్తాడు? పర్చేస్ చేస్తాడు. బట్ నెక్స్ట్ 6 మంత్స్లోనో 1 ఇయర్లోనో ఏమవుతుంది? కాంపిటేటర్స్ విల్ స్టార్ట్ వాట్? ఇమిటేటింగ్. కాంపిటేటర్స్ మనల్ని ఇమిటేట్ చేయడం స్టార్ట్ చేస్తారు. అప్పుడు ఆ కాంపిటేటర్ మన మార్కెట్లోకి ఎంటర్ అవ్వకూడదు అంటే మనం ఏం చేస్తాం? ప్రైసెస్ రెడ్యూస్ చేస్తాం, సో దట్ కాంపిటేటర్ కష్టం అయిపోతుంది. సో దట్ will act as an entry to the barrier. Okay, so this method will be used where? This method, payback period method, will be used where technological obsolescence is very high. Obsolescence means change in technology, change in fashion or technology, change in fashion or technology. Am I clear? Okay. Next, ARR, accounting rate of a return. What is the next method? Accounting or average rate of a return. Simple method, accounting or average rate of a return. So accounting or average rate of a return is average profit after tax divided by initial investment. Okay, nothing but, so this is return on investment. This formula is similar to return on an investment. Average profit after tax divided by initial investment. Merit, it is simple to understand. Income throughout the project life is considered. Income throughout the life of the project is considered. Demerit, it ignores time value of money. It considers profit after tax rather than cash inflows. It considers profit after tax rather than cash inflows. Okay, already we have discussed, we should not consider what? Profits. We should not consider what? profits, but here we are considering profits rather than cash inflows. So this is the demerit. How do we calculate ARR? ARR is equal to average profit after tax divided by initial investment. So here profit after tax total 4 lakh 60,000, average 4 lakh 60,000 divided by 5, that is 92,000. So 92,000 divided by what is your initial investment? 10 lakhs. So ARR is 9.2%. We compare this ARR 9.2% with cost of a capital. Cost of a capital. What is cost of a capital? Cost of a capital is nothing but required rate of a return. Required. What we require is the cost of a capital. So for example, cost of a capital is 10%. ARR is 9.2%. So cost of a capital is what we require. ARR is what the project is giving. So project is giving what? 9.2. Okay, but we require what? 10%. So will I invest or not? I will not be making any investment. Okay. So this method is not used practically because it ignores what? Time value for money, and instead of a cash flows we are considering profit. Profit is a vague term. Clear? Am I clear? So ARR. So we can use alternative formula also for ARR. Instead of taking initial investment in the denominator, you can take net investment or average investment. Okay. So for us not relevant for CMA final. Initial investment 10 lakhs. Net investment means 10 lakhs minus 80,000. 80,000 salvage value. So that is the net investment. Then you will get 10%. Okay. So there are three alternatives for ARR. One is profit after tax divided by initial investment. Second one, profit after tax divided by net investment. Third one, profit after tax divided by average investment. Average investment. Nothing but opening WDV, closing WDV divided by 2. That's how we take for all the 5 years, and then again average. Okay. So this is what, which method? ARR. And there are two other non-discounting techniques. Payback reciprocal. Payback reciprocal is nothing but 1 divided by payback period. Payback reciprocal is nothing but 1 divided by payback period. Nothing but the formula is annual cash inflow divided by initial investment. Annual cash inflow divided by initial investment. So we select a project which is having a high payback reciprocal. Yes or no? Payback reciprocal means 1 divided by payback period. If it is payback period, we select a project which is having a less payback period. If we are following a payback reciprocal method, then we select a project which is having a high payback reciprocal. Am I clear? Next, payback profitability. Payback profitability is nothing but total net cash inflow minus initial investment. Nothing but this is similar to NPV. In NPV, we consider time value for money. We bring all the future cash inflows to the present value. But here what? We ignore time value of money, total cash inflow. For example, in time value for money, we have taken an example. Year 1, 10,000. Year 2, 10,000. Year 3, 10,000. So nothing but total 30,000. Are you able to understand this one? For example, what is the total cash flow here? 20, 25, 30, 30, 20. Total 125. For suppose if your initial investment is 100 lakhs, then payback profitability is 125 minus 100. So 25 is the payback profitability. Okay. So what is the drawback of this method? Time value for money. We are not considering time value for money. We should bring the future cash flows to the present value. But we are not doing that. So that is the drawback. Am I clear? So non-discounting, we have a four techniques. What are the four techniques? Payback period, ARR, payback reciprocal, payback profitability. So from examination point of view, payback period, you might get MCQ, multiple choice question. Done. What are the next methods? Discounting techniques. Okay, discounted payback period. In discounted payback period, instead of normal cash flows, we consider discounted cash flows. Instead of normal cash flows, what we consider? We consider discounted cash flow. Okay, example, initial investment 1 lakh, cost of a capital 10%, year 1 55, year 2 80, year 3 15,000. Okay, 55,000, 80,000 and 15,000. So now we should bring these cash flows to the present value. We should bring these cash flows to the what? Present value. So what is the present value factor? 10%. Present value factor 10%. So we are bringing all the future cash flows to the present value. Now cumulative cash flows column is required or not required? Cumulative, we should take another column. What is another column? Cumulative discounted cash inflow. Cumulative discounted cash inflow. So this also, okay, from this concept also you might get MCQ, multiple choice question. Cumulative discounted cash flow 49,995. Next 49,995. Next 1 lakh 16,075. So the only difference between payback period and discounted payback period is instead of normal cash flow, we consider discounted cash inflow. That's it. So payback period is greater than 1 year, less than 2 years. Yes or no? So payback period is equal to 1 year plus. Payback period is equal to 1 year plus. Okay. What is the balance to be recovered? 1 lakh minus 49,995. Okay, so 50,000 5 rupees divided by 66,080 into 1.757 years. If you convert these into months, 1 year 9 months, 0.757 into 12, exact 9, 9.08. So 1 year 9 months. So clear what is this method? So all these questions are not for practice. Just refer. Just refer. That's it. These questions are not for practice. Next one, what is the next method? NPV, net present value. Net present value, sum of a discounted cash inflow minus sum of a discounted cash outflow. Okay. So it considers time value of a money. Whole stream of a cash flow is considered. Demerit, it involves difficult calculation. Difficult calculation in the sense finding out present value factor and all. This method does not suit when there is a size disparity. Size disparity in the sense, for example, in one project 10 lakhs is invested, in the other project 1 crore is invested. Okay. So we have calculated NPV for both A and B. Now obviously for which project NPV will be greater? Project A or B? B. Because in project B investment is 1 CR. Yes or no? So we cannot say B is the best project because there is a size disparity. Are you getting my point? For suppose if you are preparing for examination, you might secure a rank. On the other side, one person is going to a job. So he is sitting in office from 9 to 6 and he is preparing for examination and he secured a rank. Who is best? Obviously the other person will be best because the reason is that other person is sitting for less number of hours and he is managing work and studies. Yes or no? Likewise here 10 lakhs is invested and 1 crore is invested. Which is the best project? We cannot say based on a NPV. So that's why there we use a profitability index. Okay. So the demerit of NPV is this method does not suit when there is a size disparity. Selection criteria. What is the selection criteria? If NPV is greater than 0, accept the project. If NPV is less than 0, reject the project. If NPV equal to 0, accept or reject. Nothing but sum of a discounted cash inflow is the theoretical value of a asset in our perception. In NPV also we are doing an asset valuation. Sum of a discounted cash inflow is nothing but value of a asset in our perception. Sum of a discounted cash outflow is the actual market value of a asset. We are comparing both theoretical value and actual market value and taking a decision. Okay. NPV positive means theoretical value is greater than actual market value. That means in the market underpriced. So that's why we are buying the machinery. If NPV is negative, that means we reject the project because the reason is theoretical value is less and actual market value is high, overpriced. So that's why you're not making a investment. Okay. So if NPV is equal to 0, what? Accept or reject. So now come to the next example, question number 7. Simple. I will bring all the cash inflows to the present value. What is the sum of a discounted cash inflow here? 1,27,340 minus NPV 1 lakh. So sorry, minus sum of a discounted cash outflow 1 lakh. NPV 27,340. NPV is positive, so accept the project. How do I get profitability index? Profitability index is equal to sum of a discounted cash inflow divided by sum of a discounted cash outflow. That is 1,27,340 divided by 1 lakh. 1.2734 is the answer. Clear? 1.2734 is the answer. Since NPV is positive, project should be accepted. Likewise, what is the, profitability index? 1.27. Sorry, profitability index is greater than 1. Profitability index is greater than 1, so the accept the project. Here NPV is absolute amount and profitability index is a ratio. What does 1.2734 denotes? For every 1 rupee outflow, we are getting an inflow of 1.2734. So profitability index is a ratio. NPV is an absolute amount. IRR is a percentage. IRR is a percentage. Okay. Clear? Now adjusted NPV. So this is important from MCQ point of view. Adjusted NPV. Adjusted NPV is nothing but base case NPV plus present value of a tax savings on interest. Present value of a tax savings on interest. Okay. Frequently asked MCQ, multiple choice question, simple concept. Difference between NPV and adjusted NPV. What is NPV? We are bringing the future cash inflows to the present value using the cost of a capital. Yes or no? Sum of a discounted cash inflow. Sum of a discounted cash inflow. How are we getting the sum of a discounted cash inflow? We are bringing the future cash inflows to the present value using cost of a capital. Overall cost of a capital, KO. How do I get KO? By doing a weighted average of KE, KD, KP and all. Yes or no? NPV is calculated from the perspective of all the investors. NPV is calculated from the perspective of the firm. But whereas adjusted NPV is calculated from the perspective of equity shareholders. Adjusted NPV is calculated from the perspective of equity shareholders. Nothing but base case NPV is nothing but sum of our discounted cash inflows minus sum of our discounted cash outflows, no doubt. But how I am discounting cash inflows? Using the cost of a equity KE. Are you getting my point? So base case NPV plus we are adding one more number. What is the one more number? Tax savings on. Tax savings on interest. Why I am taking tax savings on interest? By paying interest, we can save a tax. So the tax savings is a benefit to the equity shareholders. Okay, first year I will save tax, second year I will save tax, third year I will save tax. Whenever I pay interest, I will be saving tax. I will bring all the tax savings on interest to the present value and I will add it to the base case NPV. That will be my adjusted NPV. Nothing but adjusted NPV is calculated from the perspective of what? Equity shareholders. Okay. So this one is simple. So adjusted NPV and it is frequently asked MCQ. Okay. So are you getting my point? Base case NPV plus present value of a tax savings on interest. Generally in question MCQ, base case NPV is given, already given. Base case NPV will be given in the question. So we have to bring tax savings on interest to the present value. That's it. Okay. So clear. So in next class we have to start another method. What is the other method? IRR, internal rate of a return. Okay. Return. Okay. Yesterday we have covered how to find out annual cash inflow in last class and terminal cash inflow and then non-discounting techniques. What are the non-discounting techniques? Payback period. So payback period is the time taken for recovery of a initial investment. Okay. So what is the drawback of payback period? We ignore the time value of money, and we ignore the cash flows arising after payback period. And next, so payback period is used. What is the merit? Merit. Merit of a payback period is payback period method is used where the technological obsolescence is very high. And one more demerit is a payback period emphasize only on recovery rather than profitability. Okay. And next we have seen average rate of a return. How do you find out average rate of a return? Average rate of a return is equal to average profit after tax divided by initial investment. Average profit after tax divided by initial investment. Okay. So drawback is we ignore the time value of our money and we are considering profit after tax instead of cash inflows. Okay. Next payback reciprocal is nothing but 1 divided by payback period. Payback reciprocal is nothing but 1 divided by payback period. Payback profitability. Total cash inflow minus initial investment. Initial investment. In payback profitability also we are ignoring the time value of our money. We are ignoring the time value of our money. Okay. Done. Next discounting techniques. In discounting techniques, we have started with discounted payback period. What is the difference between the payback period and discounted payback period? So we consider time value of our money. Instead of normal cash flows, we consider discounted cash flows for finding out discounted payback period. Yes or no? Next, what is the next point? Okay, discounted payback period. And after that, we have discussed NPV, net present value. NPV is equal to sum of our discounted cash inflow minus sum of our discounted cash outflow. So this concept can be linked to valuation of asset. Sum of our discounted cash inflow is nothing but value of asset in our perception. In our perception. Okay. How do we get value of any asset? By bringing the future cash inflows to the present value. So NPV is equal to sum of our discounted cash inflow minus sum of our discounted cash outflow. If NPV is a positive, accept. If NPV is negative, reject. And if NPV is equal to 0, may or may not. NPV is an absolute amount. NPV is an absolute amount. So we can say it is a profit in present value terms. Profit in present value terms. Whereas profitability index is a ratio. How do we find out profitability index? Sum of our discounted cash inflow divided by sum of our discounted cash outflow. Okay. So it indicates inflow for every 1 rupee outflow. If a profitability index is less than 1, reject. If it is greater than 1, accept. If it is equal to 1, accept or reject. Accept or reject. Okay. So NPV drawback is NPV cannot be used when there is a size disparity. When there is a size disparity. Clear? Okay. So this investment decisions topic comes under what? C category. C category. So one 7 marks question and two MC. I mean one MCQ. You will get one MCQ and one 7 marks question. Okay. So clear? So what is the order? Order of preparation? I mean, you have to practice each and every question of a super 50 or important question, whatever guess questions, each and every question. Okay. So you might be thinking, why can't, I mean, I can teach directly super 50. But first you have to learn concept. Without learning concept, if you buy hard super 50, then it doesn't help you to get out. Okay. So first you have to understand the concept, then practice what? Super 50. Concepts plus super 50. Okay. If you directly start practicing super 50, you may not be able to understand conceptually. Okay. So next concept IRR, internal rate of a return. Internal rate of a return. ARR is different from IRR. IRR, we consider time value of a money. In IRR, we consider time value of a money. Okay. IRR is nothing but return from the project. IRR is nothing but return from the project. Return. IRR is nothing but return from the project. Okay. So this concept, so we have discussed in foundation level itself. Foundation level. So first, what is the formula for amount calculation? Amount A is equal to P into 1 plus I whole power n. A is equal to P into 1 plus I power n. Okay. Am I correct? Amount is nothing but what? Future value. P is nothing but present value. I is the interest rate. N is the number of periods. N is the number of periods. Yes or no? So future value is equal to present value into 1 plus I power n. Okay. At foundation level, they will give you amount. So the amount here is 2 lakhs and they will give you principal. The principal is 1 lakh. N is equal to 5. What is the interest rate? What is the interest rate? Okay. So if you substitute these figures in the above formula, then 2 lakhs is equal to 1 lakh into 1 plus I power 5. 1 plus I power what? 5. Yes or no? Next, 1 plus I is equal to nothing but 2 power 1 by 5. Now how to find out 2 power 1 by 5? So we have to find out the value of a 2 power 1 by 5. To find out the value of 2 power 1 by 5, we have to apply logarithms and then anti-log. That's how we find out what. Okay, so the value of a 2 power 1 by 5. Okay, logarithms వస్తాయి ఇటు వచ్చేవాళ్ళం కాదు కదా. So point it, we cannot apply, I mean we can apply logarithms but మనకు అది రాదు కదా. So the point ఏంటి? So మరి foundation level, how we have done this in foundation level? Because in foundation level, four options were given and we have found out interest rate on trial and error basis. On trial and error basis. Okay. So now the same question, the pattern changes. What is the pattern? Instead of amount, that will be given as a cash inflow. What is the cash inflow? 2 lakhs. Next, investment, nothing but initial cash outflow, 1 lakh. Cash inflow at the end of 5th year. Cash inflow at the end of a 5th year. Cash inflow at the end of 5th year is equal to 2 lakhs. Investment is equal to 1 lakh. Cash inflow at the end of 5th year is equal to 2 lakhs. Investment is equal to 1 lakh. Now the question is, IRR is equal to question mark. Okay. So nothing but the same question. At foundation level, we are calling it as an interest rate. Interest rate is nothing but IRR to the lender. Interest rate is nothing but what? Cost to the borrower and it is returned to the lender. So interest rate is nothing but what? IRR. Likewise, here, so in capital bursting, the same numbers, but we are not calling it as an amount. We are calling it as cash inflow at the end of a fifth year. Instead of principal, we are calling it as investment. So instead of interest rate, we are calling it as IRR. So without applying logarithms, how to find out this IRR? So first, what is our formula? Future value is equal to present value into 1 plus I power n. So this 1 plus I power n is nothing but future value factor. Future value factor. Yes or no? Now I can write present value is equal to future value into 1 divided by 1 plus I power n. Yes or no? Now what is this present value? Present value is nothing but initial cash outflow or investment or cost of a project. Initial cash outflow is nothing but investment or a cost of a project. That is equal to future value. What is the future value? Cash inflow is the future value into this 1 divided by 1 plus I power n is nothing but present value factor at the rate of IRR. So IRR is nothing but the rate at which sum of a discounted cash inflows will be equal to sum of a discounted cash outflow. The rate at which sum of a discounted cash inflows are equal to sum of a discounted cash outflow. Nothing but right hand side must be equal to left hand side. The rate at which RHS will be equal to LHS is IRR. That's why we say if NPV is equal to 0, okay, then cost of a capital is equal to IRR. For suppose we are bringing the future cash inflows to the present value using the cost of a capital. Using what? Cost of a capital. So we got NPV 0. What does it indicate? Cost of a capital is equal to IRR. For suppose we brought our future cash flows to the present value using the cost of a capital and we got NPV positive. NPV positive. That means we are getting more return than what we require. Nothing but IRR is greater than cost of a capital. That's why we are accepting the project. Cost of a capital is the required return. IRR is the return which the project is giving. For suppose if a sum of a discounted cash inflows minus sum of a discounted cash outflows negative, that indicates IRR is less than cost of a capital. IRR is less than cost of a capital. Okay, so that's why we are rejecting the project. Under IRR, we compare IRR with what? Cost of a capital. Cost of a capital is what the investor require. Okay, IRR is what the project is giving. If IRR is greater than cost of a capital, accept, otherwise reject. So, okay. So the point is initial cash outflow is equal to cash inflow into present value factor. So forget, now you have to forget the basic formula. A is equal to P into 1 plus I power n. Okay. So at intermediate level or final level, so this one is important. Initial cash outflow is equal to cash inflow into present value factor at the rate of IRR. Initial cash outflow is equal to cash inflow into present value factor at the rate of IRR. Okay. Now, what is the initial cash outflow? 1 lakh is equal to what is the cash inflow? 2 lakhs into, I have no idea about PVF. So I have to find out what present value factor. So present value factor is equal to 0.5. Now I have to find out where does this 0.5 lies. Okay, in the present value factor table. Okay, so trial and error. Trial and error. First I will take 10% as a trial. If it is, I mean, if error comes, then again trial, again error, again trial. So trial and error. So generally we take what trial at 10 percentage. Trial 1 at the rate of 10%. Present value factor for the fifth year. Present value factor for the fifth year is equal to present value factor for the fifth year is equal to 0.621. 0.621. Okay. So what is the desired factor? 0.5. I should get 0.5, but here I am getting what? 0.621. So that's why what trial 2 at the rate of, I should increase the rate or decrease? I would increase the rate. Why I have to increase the rate? So mathematically, for suppose rate is coming in the denominator. If rate in the denominator increases, then the value decreases. So this is the mathematical logic, okay? And the other logic, common sense. We have already discussed, if risk increases, required return increases. If required return increases, value decreases. If required return increases, value decreases. If risk increases, expectation increases. If expectation increases, value decreases. Okay, are getting my point? So trial 2 at the rate of, trial 2 at the rate of, let us take 15 percentage. Do not take 10.1, 10.2, 10.3. That is too much. Okay. At least 5 gap undela చూసుకోండి. At least 5 gap. So 15%. So PVF 0.497. So that means the desired factor 0.5 lies between 0.621, 0.497. 0.497. Okay. So let us find out the accurate answer. Interpolation. So we have to do interpolation. So IRR is greater than 10%, but less than what? 15%. Greater than 10, but less than 15. In examination, okay, so there is only a minor difference, so that's why you can write approximately IRR is equal to 15%. Because 0.5 minus 0.497, there is a slight difference, so that's why you can write approximately 15. But if you have to find out the accurate answer, then we have to do interpolation. So IRR is greater than 10%, less than 15%. So let us take PV factor at the rate of 10% is equal to what? 0.621. PV factor at the rate of 15% is equal to 0.497. What is the difference between the factor? 0.1, 0.124. 0.124. Am I clear? Next, PV factor at the rate of 10%, 0.621. Next, desired factor. What is the desired factor? 0.5. The difference is 0.121. 0.121. Next, PV factor at the rate of 15%, 0.497. Desired factor 0.5. The difference is 0.003. This is the difference. Okay, so you can take 10% as a basis for finding out IRR or 15% as a basis for finding out IRR. So now here the factor, percentage difference is 5. For 5% difference, the factor difference is 0.124. If you are taking 10% as a basis, then your question is for 0.124, the percentage difference is 5%. For 0.121, what is the percentage difference? Are you getting my point? If you are taking 15% as a basis, then for 0.124, the percentage difference is 5%. So for 0.03, what should be the percentage difference? Am I clear? Okay. So, am I clear? Done. So now what is the calculation? IRR is equal to 10% plus 10 percentage plus, because IRR is greater than 10%, we know that. Okay, so IRR is greater than 10%. So how to find out? 10 percentage plus. What is the desired change? 0.121. So for 0.124, the percentage change is 5%. Now we require percentage change for 0.121. So what is the calculation? 0.121 divided by 0.124 into 5. Yes or no? So 14 point, overall 10 plus 14.87 percentage. Am I clear? If I am taking 15% as a basis, then 15% minus 0.003 divided by 0.124 into 5. Then also I will get the same answer, 14.87 percentage. Am I clear? IRR. So every time I need not write like this. Okay, so direct I can calculate IRR. IRR is equal to 10 percentage plus. IRR is equal to 10% plus desired change. What is the desired change? At 10 percentage factor is 0.621, but I require 0.5 desired change divided by the given change. What is the given change? 0.621 minus 0.497, the change available, into 5. So the answer is 14.87 percentage. So clear? Are you able to understand the interpolation? Interpolation. So When single cash flow is given, then we write initial cash outflow is equal to cash inflow into PVF at the rate of IRR. For suppose in IRR we have a three models. One is single cash inflow. Second one is multiple even cash inflow. Third one is multiple uneven cash inflow. Three models. Now we have covered one model. So single cash inflow. If there is a single cash inflow, then so we write initial cash outflow is equal to cash inflow into present value factor at the rate of IRR. But suppose if it is even cash inflow question, then we write initial investment is equal to annual cash inflow into present value annuity factor. Instead of present value factor, we take what? Present value annuity factor, because investment is producing an annuity. So to bring an annuity to the present value, we should multiply with present value annuity factor. Already this concept we have discussed in time value of a money. Yes or no? Am I clear? Okay. So this is the answer 14.87. So when single cash flow is given, so see the question number 8. So question number 8 is not for practice. Investment is equal to 1 lakh. Cash inflow at the end of 10th year equal to 3 lakhs. Calculate IRR. Calculate what? IRR. At IRR, initial cash outflow is equal to sum of a discounted cash inflow. That is nothing but initial cash outflow is equal to cash inflow into present value factor. Here what is the cash inflow? 3 lakhs. So 1 lakh is equal to 3 lakhs into present value factor. What is the solution? So 1 lakh is equal to 3 lakhs into present value factor. మీకు ఏసీ కావాలమ్మా? పర్లేదు చెప్పండి. నాకు అవసరం లేదమ్మా, కొంచెం ఆఫ్ చేయండి, ఏసీ ఆఫ్ చేయండి. అదే ఏసీ రిమోటేనా? అది ప్రొజెక్టర్ రిమోట్ ఇది 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 ఏసీ లేకపోతే ఉండలేరని నేను అనుకుంటాను. మీరు అలాగే అనుకుంటున్నారేమో. చలికాలం కదా వద్దని. So present value factor is equal to what? 0.33. Present value factor is equal to 0.33. Now, what is the next one? So we have to find out where does this present value factor lies. So let us try what? 10%. PV factor at the rate of 10%. Which year? For the 10th year. PV factor at the rate of 10% for the 10th year is equal to 0.385. What is the regular desired factor? 0.33. So we have to increase the rate or decrease? Increase the rate. So present value factor at the rate of 5%. Huh? Okay, 12 or generally we go to 15. Let us try 15. For the 10th year is equal to 0.2247. Very good. Next, IRR is equal to greater than 10% but less than 15%. Yes or no? We have to do interpolation. Okay. Sometimes we might get direct answer like 12%. Okay. Interpolation 10% plus. What is the desired change? 0.385 minus 0.33 divided by 0.385 minus 0.247 into 5. Desired change divided by available change into 5. Am I clear? Difference between 10 and 15. If you are taking 10, difference between 10 and 13, then you will take 3. Clear, Likita? So what is the answer? $11.99. When gap increases, gap between the percentage increases, then you will get inaccurate answer. For suppose if you take 10 and 13, you will get accurate answer. Okay. If you are doing an interpolation between 10 and 20, so inaccuracy will increase. Okay. Students who don't want to, make so many trials, they might take 1% and 100%. Okay. 1%, trial 1 at the rate of 1% and trial 2 at the rate of 100. Definitely you will get what? The value between 1 and 100. But you will get most inaccurate answer. So generally the gap must be 5. So clear? So 11.99 is the answer. Here in the question bank, what? Directly we have tried 12%. Next question number 9. Initial investment is equal to 1 lakh. Annual cash inflow is equal to 30,000 for 5 years. Calculate IRR. Calculate IRR. What is the difference between 8th and 9th question? In 8th question, we are getting a single cash inflow, but whereas in 9th question, we are getting even cash inflows. For how many years? 5 years. So what is the calculation? Let me know the calculation. 9th one. Okay. So at IRR, initial cash outflow, nothing but this is cost of a project. Initial cash flow is equal to annual cash inflow into present value annuity factor at the rate of IRR. Instead of cash inflow, we are writing annual cash inflow because we are receiving cash flow every year and that too equal. As the cash flows are equal, we are multiplying with present value annuity factor. Already we are told annuity means same amount at same intervals. So to bring the annuity to the present value, we multiply annuity with present value annuity factor. So initial cash flow 1 lakh is equal to, what is the annual cash inflow? 30,000 into present value annuity factor. So present value annuity factor is equal to 3.33. So now we should find out the rate at which this present value annuity factor lies. Trial and error. Let us take trial at 10%. PVAF at the rate of 10% for 5 years is equal to 3.791. 1 divided by 1.1 equal to how many times? 5 times, and then grand total. If a question is silent, we assume that annuity is regular. So that's why we are multiplying equal to how many times? N times, 5 times. So next, we have to increase the rate or decrease. If you decrease the rate, value increases. What is the desired value? 3.33. Desired value 3.33. Okay, right now the value is 3.791. The value has to what? Decrease. To decrease the value, we should increase the rate. So that's why next trial PV AF at the rate of 15% for 5 years. 3.352. Okay. Some students might start doing interpolation. Subconscious mind. Be careful with your subconscious mind, because most of the times we have done only 2 trials. Yes or no? The desired factor lying between that 2 trials. But this time the desired factor is 3.33, and it is not lying between 10% and 15%. At 10% we got 3.791. At 15% we got 3.352. Okay. So most of the students will do a subconscious mistake. Subconscious means nothing but our subconscious mind will say, okay, the desired factor lies between these 2 trials. Start your interpolation. Okay. But the 3.33 is not lying between 3.791 and 3.352. So that's why what next trial? There is only a slight difference. Slight. So that's why take next trial at 16% instead of 20. PVAF at the rate of 16% for 5 years. 3.274. Now IRR is equal to, so IRR, it lies between 15% and 16%, because 3.33 lies between 3.35 and 3.27. So IRR is equal to, what is the calculation? 15% plus 3.352 minus 3.33 divided by 3.352 minus what? 3.274 into 1. This time 1. You might multiply with 5. The answer is 15.25. 15.28 percentage. So 15.28 percentage is the answer. So IRR is equal to 15.28 percentage. Done. So this will be done when even cash flows are given. Okay. Question number 10 is also related to even cash flows. Let us see question number 10. Question number 10 is for refer, not for practice. A company proposes to install a machine involving a capital cost of rupees 3,60,000. The life of the machine is 5 years and its salvage value at the end of the life is nil. The machine will produce the net operating income after depreciation of rupees 68,000 per annum. In this question, the special point is net operating income after depreciation of rupees 68,000 per annum. The machine will produce the net operating income after depreciation of rupees 68,000 per annum. The company's tax rate is 45%. The NPV for 5 years are as under 14. The NPV factors are as under. You are required to compute the internal rate of a return of the proposal. So in this question, the special point is what? Net operating income after depreciation. Net operating income after depreciation. So this is the special point. What is the operating income? Operating income means nothing but net operating income means EBIT, earnings before interest and tax. Nothing but earnings before tax. We have no interest, so earnings before tax. Okay. He is mentioning that after depreciation. After depreciation means already depreciation was reduced. This is not a profit before depreciation and tax. This is profit before tax but after depreciation. Okay. So we have to find out IRR. So to find out IRR, first we have to find out what? Annual cash inflow. Question number 10. Working note 1. Annual cash inflow. Annual cash inflow. Particulars amount. Per annum we are earning a profit before tax of 68,000. In this question only this point has to be referred. Net operating income after depreciation. Net operating income is nothing but earnings before tax. So 68,000 minus what? Tax at the rate of 45%. So that is what is the amount? 30,600. Profit after tax 37,400. Next, add depreciation. What is the depreciation amount? 3,60,000 divided by 5. Life is given and asset cost is also given. Even though they have not mentioned the method of a depreciation, we have to assume it as a straight line method. So what is the answer? 72,000. Annual cash inflow. What is the annual cash inflow? 1,09,400. So 1,09,400 is the answer. Annual cash inflow. So next, What is the next one? Next we have to find out what? IRR. So main answer at IRR. Initial cash outflow is equal to annual cash inflow into Mammuti Evramadi. Annual cash inflow into present value annuity factor. So 3,60,000 is equal to 1,09,400 into PV. Yes. Now PVAF is equal to present value annuity factor is equal to what is the amount? 3.291. 3.291. Okay. Next what? So we have to find out IRR. IRR is equal to. So before finding out IRR, trial. So trial need not required because already factors were given. The desired factor 3.99 lies between what? 3.29. 15 and 16. 15 and 16. So IRR is equal to 15 percentage plus 3.35 minus 3.29 divided by 3.35 minus into 1. The answer is 15.75 percentage because numerator difference 0.06 divided by denominator difference 0.08. So what is the answer IRR? 15.75. Am I clear? Done. Next question number 11. Uneven cash inflows. Initial investment is equal to 1,36,000. Year 1, 2, 3, 4, 5. Cash flow 30,000, 40,000, 60, 30 and 20. So we have to find out IRR. IRR. This time the cash flows are uneven. When cash flows are uneven, we cannot apply, we cannot write initial cash outflow is equal to annual cash inflow into present value annuity factor because cash inflows are uneven. So when cash inflows are uneven, we cannot multiply with present value annuity factor. In that case, we follow trial and error method. Trial and error. Okay. So take heading calculation of IRR. Calculation of a IRR. Year cash flow PV factor at the rate of 10%, discounted cash flow. I'm taking a trial rate, random rate. What is the rate? 10%. So instead of 10, you can take 15 also. Year 1, what is the cash flow? 30,000. Year 2, 40. Year 3, 60,000. Year 4, 30,000. Year 5, 20,000. So if I bring all these cash flows using 10% rate, if I get 1,36,000, then 10% is my IRR. Let us see, I will get 1,36,000 or not. If I get 1,36,000, sum of a discounted cash inflow, that means IRR is equal to what? 10 percentage. So PV factor 0.909, 0.826, 0.751, 0.683, 0.621. Discounted cash flow. Discounted cash flow 27,270. 27270. Next, what? 30. Okay, corporate 33,040. Next, 45,060. 24,90. Next, 12,420. What is the total? 1 lakh 138,280. 138,280. So I have to get 1,36,000. But I got what? 1,38,280. I'm getting NPV positive. That means IRR greater than, this is not a cost of a capital. IRR is greater than what? 10%. Okay. So that's why I have to go for next trial. So I have to increase the rate or decrease? Increase the rate. So trial 2 at the rate of 15%. PVF at the rate of 15%. PVF at the rate of 15%. What are the factors? 0.869, 0.756, 0.657, 0.571, 0.497. Discounted cash flow. 26070, 30,240, 29,420. Okay. 39,420. Next, 17,130. Next, 99,400. Total. So what is the answer? 122,800. So 122,800. So the desired sum of a discounted cash inflow 1,36,000. That 1,36,000 lies between 10% and 15%. For suppose for the second trial I have got 1,37,000. Then I have to go for third trial. Okay. So IRR is equal to IRR is equal to, what is the rate? 10% plus IRR is equal to 10% plus 138,280 minus 1,36,000 divided by 138,280 minus 122,800 into 5. So the answer is, what is the answer? 10.7. So 74%. 10.74% is the answer, IRR. So in IRR, we have seen three models. A single cash flow. If it is a single cash flow, we find out present value factor and then the rate at which that factor lies. When the cash flows are even, we find out present value annuity factor and the rate at which that annuity factor lies. When the cash flows are uneven, we follow the trial and error method. We bring the future cash flows to the present value on trial and error basis. Okay. Now we shall see the difference between IRR, NPV and profitability index. So what is IRR actually? IRR is the discount rate that equates the sum of a discounted cash inflows with the initial cash outflow. IRR is nothing but rate of a return from the project. Rate of a return from the project. So what are the merits? Merits, time value of a money. It considers time value of a money. The whole stream of a cash flows are considered. Whereas in payback period, we are not considering cash flows arising after payback. Yes or no? In payback period, we ignore the cash inflows arising after payback period. But here we are considering whole stream of a cash flows. Maximizes the shareholders' wealth. So this demerits, difficult to compute. Obviously interpolation and all. So first time you might find difficult. This is your second time because already you are done in CMA Inter or CA Inter. Okay. Next, the profitability index fails as a guide in resolving capital rationing where projects are indivisible. So we shall discuss this point later. When the projects are indivisible, we use IRR or a NPV methods for selecting the projects. But where the projects are divisible, we use profitability index method. Profitability index method. And next, the third demerit is the assumption of a reinvestment of cash flows may not be possible in practice. The assumption of a reinvestment of cash flows. What is that point? Let us discuss. But before, we shall complete selection criteria. If IRR is greater than cost of a capital, accept. If IRR is less than cost of a capital, reject. If IRR equal to cost of a capital, may or may not. May or may not. Let us discuss the difference between NPV, profitability index, IRR. NPV is an amount. NPV is an amount, absolute amount. Profitability index is a ratio. IRR is a percentage. Okay. So if NPV denotes what? Present value of a net benefit. Profitability index denote inflow for every 1 rupee outflow. IRR denotes return from the project. If NPV is greater than 0, then obviously profitability index will be greater than 1 and IRR will be greater than cost of a capital. If NPV is negative, So NPV is negative, that is less than 0. Then profitability index will be less than 1 and IRR will be less than cost of a capital. If NPV is equal to 0, profitability index will be equal to 1 and IRR will be equal to cost of a capital. Nothing but for project A, if NPV is positive, then profitability index will also be greater than 1 and IRR will be greater than cost of a capital. That means all the three methods will result in same decision. Then why do we require these three models? Because the another difference between NPV, PI and IRR is in NPV and PI, we assume that the cash inflows are reinvested at discount rate, that is cost of a capital. And in IRR, we assume that the cash inflows are reinvested at the rate of IRR. What? What is the assumption for NPV? In NPV, we assume that the cash inflows are reinvested at discount rate, that is cost of a capital. In IRR, we assume that the cash inflows are reinvested at IRR. This is an implied assumption. Implied assumption. So that's why there might be a ranking conflict between NPV, PI and IRR. For suppose if we do not have a capital rationing situation, we do not have any capital rationing situation, then one method is enough, NPV or profitability index or IRR. So whatever the method, so one method is enough when there is no capital rationing situation. What is this capital rationing situation? Okay. So generally we might take a three types of a decision: accept, reject decision, accept, reject decision, mutually exclusive decision, and the third one is contingent decision. So third one is not that important. So mainly accept, reject decision, mutually exclusive decision. When there is no capital rationing situation, we take accept, reject decision. Okay. When there is a capital rationing situation, we take mutually exclusive decision. So when we have to take a mutually exclusive decision, then ranking has to be given to the projects. Let us discuss what is this capital rationing situation. So capital rationing situation means whenever we go for shopping, we face that capital rationing situation. Whenever, especially girls, when they go for shopping, they face capital rationing situation. What is this capital rationing situation? First, suppose Ishwar he went okay for shopping, and after going to the shop, so in entire 50 pairs, he liked 20 pairs. He liked what? 20 pairs. Okay. He does not like other 30, but he liked how many pairs? 20 pairs. Okay. But his mother gave 500 rupees for birthday. That means he will be able to buy what? One t-shirt. Okay. So might be one t-shirt, that too in Judy or something. So the point is here, how many pairs? He liked 20 pairs. Out of 50, okay, he liked 20. He didn't like what? 30. But the fund is limited to only one pair. Fund is limited to only one pair. Now he cannot take an accept reject decision. So this situation is called a capital rationing situation. He cannot accept all the 20 and reject 30, because the reason is he is having a limited funds. Now he has to take a mutually exclusive decision. If he accept one pair, then he has to reject the remaining 19 pairs. Are you getting my point? If he accept one pair, then he has to reject what? all other 19. So this is called as a mutually exclusive decision. He can accept only one, okay, out of the 20. So this is called mutually exclusive decision. Okay. For suppose Kamesh alias Gautam Nanda, you might have seen Gautam Nanda movie, Gopichand movie. Okay, unlimited funds, unlimited funds. Now he is going to buy one pair, 20 pair, or 50. Generally 50. No, because even though we have unlimited funds, why do I buy? I mean, the pair which I doesn't like, yes or no? So generally, what he accept 20 and reject 30. So what is the decision? Accept, reject decision. Okay, instead of shopping, so let us say projects. Out of 50 projects, 20 are profitable, 20 profit projects having positive NPV, 30 projects having negative NPV, and I have a limited funds. I have a limited funds. If I have a limited funds, then the situation is known as a capital rationing situation. In that capital rationing situation, I have to take what? Mutually exclusive decision. Mutually exclusive decision. For suppose if I have unlimited funds, then I accept all 20 projects. Okay. So when there is no capital raising situation, then ranking need not be given to the 20 projects. Ranking, okay, based on NPV or IRR or profitability index, ranking is not at all required, because if NPV is positive, accept. We accept all the projects. But when there is a capital rationing situation, then I have to give a ranking to the projects. If I have to accept only one project, then I will accept the project which is getting rank 1 as per NPV, IRR, and profitability index. Are you getting my point? Out of 20, I have to accept only one project. Out of so what I will do as per NPV, I will give ranking. I will give rank 1 to the project which is having a highest NPV. And next I will give rank 1 which is having a the project which is having a highest profitability index. And next IRR. So I will give a rank 1 to the project which is having a highest IRR. Are you getting my point? So, but here there can be a ranking conflict. There can be a ranking conflict. So instead of 20 projects, let us take 3 projects: NPV, PI, IRR. Project A, B, C. Okay. So I can select only one project out of these 3 projects, because there is a capital rationing situation. NPV is positive for all the 3 projects. PI is greater than 1 for all the 3 projects. IRR is greater than cost of a capital for all the 3 projects, but I can accept only one project because if there is a capital rationing situation. In that case, I have to give a ranking to the projects as per NPV. But suppose rank 1 goes to A, rank 2 goes to B, and rank 3 goes to C. First, suppose if as per profitability index, rank 1 goes to A, rank 1 goes to B, and rank 3 goes to C. As per IRR, same. Rank 1 goes to A, rank 2 goes to B, and rank 3 goes to C. Then there is no ranking conflict, because unanimously all methods NPV, PI, IRR, all these 3 methods giving rank 1 to the project A. So that's why I will select straight away project A. But there can be a situation that profitability index might give rank 1 to B and rank 2 to project A. Are you getting my point? So now there is a ranking conflict. Okay. And here there is no conflict between NPV and IRR, but there is a conflict between NPV and profitability index. NPV and profitability index. Generally, the ranking conflict between NPV and profitability index arises when there is a size disparity. When there is a when there is a size disparity, the ranking conflict may arise between what? NPV and profitability index. NPV and profitability index. Am I clear? So what is this size disparity? What is this size disparity? Let us take an example. Okay. Project A. Sum of a discounted cash inflow 1.2 crores. Sum of a discounted cash outflow 1 crore. NPV is equal to 0.2 crores. Yes or no? Then profitability index is equal to 1.2. Profitability index is equal to sum of a discounted cash inflow divided by sum of a discounted cash outflow. Okay. So profitability index is equal to what? 1.2. Next, project B. Project B. Sum of a discounted cash inflow 75 lakhs. 75 lakhs. Sum of a discounted cash outflow 60 lakhs. Okay. Sorry. Let us take 15 lakhs. Sum of a discounted cash inflow 15 lakhs and sum of a discounted cash outflow 10 lakhs. So what is the NPV? 5 lakhs. So let me know, as per NPV, which project are you going to take? First project or second project? As per NPV, rank 1 goes to first project. I will select a project which is having a highest NPV. So project A is having a highest NPV. So I am going to select project A. Yes or no? Now, what is the profitability index? 1.5. As per profitability index method, I will select project B because for every 1 rupee outflow, I am getting 1.5 inflow. So when there is a size disparity, there can be a conflict between NPV and profitability index method. Okay, are you getting my point? So why are we discussing this ranking conflict actually? Why are we discussing? Because the reason, generally a company may face a capital rationing situation. What is meant by the capital rationing situation? So we have unlimited opportunities but limited funds. In that case, I cannot accept all the profit making investments. I have to select the best of the profit making investment. Yes or no? So for that I have to give a ranking. I have to give a ranking. When I give a ranking, there may not be a conflict. Example, all three methods may give a rank 1 to what? A, rank 2 to B, and rank 3 to C. Then no problem arises. But there can be a ranking conflict. There can be a ranking conflict. For suppose in second case, in project B, the investment is 105 lakhs. Sorry, investment is 100 lakhs, and sum of our discounted cash inflow is 105 lakhs. Then NPV will be 5 lakhs, and your profitability index will be 1.05. Then both NPV and profitability index, both methods are giving rank 1 to project A. Are you getting my point? There can be a ranking conflict. There can be a ranking conflict. And the reason for conflict between NPV and profitability index can be what? Size disparity. Difference of a size investment. For example, if you see the project A investment is 1 crore and project B investment is 10 lakhs. Project A investment what? 1 crore. Project B investment 10 lakhs. This is known as what? Size disparity. Okay. And next, there can be a conflict between NPV, PI and IRR. And IRR. Why the conflict arise between NPV and IRR? The reason for conflict between NPV and IRR is reinvestment rate. What is that? Reinvestment rate. Reinvestment rate. What is this reinvestment rate? So the last difference between NPV, PI and IRR is under NPV and PI, we assume that the cash inflows are reinvested at discount rate, and IRR, cash flows are reinvested at IRR. In NPV method, under NPV method, there is an implied assumption. Under NPV method, there is an implied assumption. What is that implied assumption? Cash inflows are reinvested at cost of a capital, both in NPV and PI. Let us see the question number 7 again. See the question number 7. I will explain this concept with question number 7. Generally, how do I calculate NPV? Here, cash flow. What is the PVF at the rate of 10% discounted cash flow? Here 1, 2, 3. Cash flow. What is the cash flow? 55,000, 80,000, 15,000. Factor 0.909, 0.826, 0.751. Next 55,000 into 0.909. 40, 49,995. 66,000, 0, 66080. Next 11,000, 11,265. Total 126, 127, 340 minus. So this is what sum of a discounted cash inflow. 127, 340 minus what? Sum of a discounted cash outflow. What is the sum of a discounted cash outflow? 1 lakh. NPV 27,340. Am I clear? Done. So now let us discuss that last difference. This is very important for to learn the concept of modified NPV and modified IRR. Modified NPV and modified IRR. Okay. So in NPV and profitability index, both methods, because profitability index also we are taking sum of a discounted cash inflow divided by sum of a discounted cash outflow. In both methods, we assume that the cash inflows are reinvested at cost of a capital. That is an implied assumption, not visible. So, okay. So now I will make you visible the assumption. What is the assumption? Cash inflows are reinvested at cost of a capital. What does it mean? Here, cash flow, future value of a cash flow. Year 1, what is the cash flow? 55,000. Year 2, 3. Year 2, 80,000. Year 3, 15. 15,000. Under NPV, what is the assumption? Cash inflows are reinvested at cost of a capital. What is that? At the end of a first year, I am getting 55,000. I will not keep that 55,000 idle. Why do I keep that 55,000 idle? I will be reinvesting that 55,000 at the rate of cost of a capital. For how many years I can make investment? I can make investment for 2 years. For next 2 years, I can make investment, yes or no? So, the value by the end of third year will be 55,000 into 1 plus 0.1 power 2. Yes or no? Yes or no? Next, 80,000 into 1 plus 0.1 power 1. So this I cannot make a reinvestment because I am going to receive 15,000 at the end of a third year. Now let me know the total. 55,000 into 1 plus 0.1 square. 80,000 into 1 plus. What is that? 55,000 into 1 plus 0.1 square. 60. 66,550. 88,000. What is the total? 169,550. So what is this 169,550? This is the terminal cash flow. We call it as a terminal cash flow. Cash flow at the end of the project. 169,550. Okay. Now to find out NPV, I should bring that 169,550, the value at the end of a third year, to the present value. Yes or no? So now sum of our discounted cash inflow is equal to 169,550 into, what is the third year factor? 0.751. 169,550 into 0.751, that is 127,332. So this chapter is C category for examination, but A category for interview. Okay. So they're asking difference between modified NPV and NPV. Okay. And they will give a case study and they ask you to find out NPV. So 127,332 is the sum of a discounted cash inflow. And next what? Minus sum of a discounted cash outflow, 1,27,000. Nothing but you will get same NPV. So instead of finding out future value of a cash flow, directly we are bringing the cash flows to the present value. But there is an implied assumption, invisible assumption. What is that invisible assumption? Cash inflows are reinvested at cost of a capital. Cash inflows are reinvested at the rate of cost of a capital. Are getting my point? Okay, but whereas in IRR, we assume that the cash inflows are reinvested at IRR, which is not practically Okay, possible. That is not practically possible. Investing at IRR. That is the demerit of IRR. So, as there is a difference between the assumptions of NPV and IRR, the conflict may arise between NPV and IRR. Conflict means as per NPV, project A may get rank 1, but as per IRR, project C may get rank 1. Am I clear? Are you able to understand? Okay. So what is the NPV here? 27,332. Done. So let us find out IRR also for the same question. For the same question, let us find out IRR. At 10% we got what? Positive NPV. Let us take another trial. Here cash flow, PVF at the rate of 20% discounted cash flow. I'm taking 20% because I got NPV greater amount, so that's why. Year 1, 2, 3, cash flow 55,000, 80,000, 15,000. Factors 0.893, 0.1 divided by 1.2, 0.833, 0.694, 0.578. Discounted cash flow 45,815, 55,520, 8670. Total 155. Uh-huh. 1,10,000 double 1,10,000 Clear? So this is sum of a discounted cash inflow. But what is the desired cash inflow? 1 lakh. I should get 1 lakh. That means I have to increase rate again. I have to increase the rate or not? I have to increase the rate. Let us take what next rate? 25%. PVF at the rate of 25% and discounted cash flow 0.8, 0.64, 0.512, 44,000, 51,200, 7,680. The total 1,02,880. So let us go for another trial. PVF at the rate of 30%. Let me know the rate. 0.769, 0.591, 0.455. Discounted cash flow 42, 295, 45,680, 4568, 6827. Second one 47,280. Next
6825. The answer 96,400. So IRR lies between 25 and 30. Yes or no? We are finding out IRR. That's it. So IRR is equal to 25% plus. I want a change. 1,02,880 minus 1 lakhs divided by 1,02,880 minus 96,400 into what? 5%. 20, 27.2 percentage. So 27.2 percentage is the answer. IRR. Okay. So I hope, you understood the assumption of a NPV. What is the invisible assumption? Cash inflows are reinvested at the rate of cost of a capital. Likewise, under IRR method also, there is an invisible assumption that cash inflows are reinvested at IRR. To discuss that point, just now we have calculated IRR. We have calculated only IRR. What is IRR? 27.2%. Okay, now we shall understand the assumption. What is the assumption? Cash inflows are reinvested at the rate of IRR. So here cash flow, future value of a cash flow. Year 1, 2, 3. Year 1 cash flow 55,000. Year 2 80,000. 15,000. So under IRR method, what is the assumption? Cash inflows are reinvested at IRR. Nothing but this 55,000 is reinvested at the rate of 27.2. For how many years? 2 years. What is the value? 80,000. 88,989. Are you getting my point? Cash inflows are reinvested at IRR. This is the assumption under IRR method. Okay. Next, 80,000 into 1 plus 0.272 power 1. 1,01,760. And this one remains same, 15,000. What is the total? 2,05,749. That means by investing 1 lakh, we are able to get a cash inflow of 2,05,749 at the end of a third year. This is as per IRR. But as per NPV, we are getting what? 1,69,550 at the end of the third year. Okay. Now we shall calculate IRR again. So what is my investment? 1 lakh is my investment, but I am getting 2,05,749 at the end of the third year. Nothing but multiple uneven cash inflows question is converted into single cash flow. Multiple uneven cash inflows question, it has got converted into what? Single cash inflow. By investing 1 lakh, I am getting 2,05,749 at the end of the third year. So into present value factor. We shall find out present value factor. What is the present value factor here? 1 lakh divided by 2,05,749. 0. So this 0.486 lies at 27.2%. Okay. So take 1 divided by 1 divided by 1.272. Press equal to how many times? 3 times. 1 divided by 1.272. How many times? 3 times. Then you will get what? 0.486. So IRR what? Uh, Nothing but we are calculating IRR like this. Okay, now are getting my point. So IRR invisible assumption is cash inflows are reinvested at IRR. Clear my point? So that's why there can be a conflict between what? NPV and IRR. Conflict means NPV will give rank 1 to A and IRR may give rank 1 to B. The ranking conflict may arise. So to resolve this ranking conflict, we have a concept of modified NPV, modified IRR. Modify. Nothing but NPV only, but we are modifying. IRR, modify. Modified NPV and modified IRR is nothing but what? We are modifying. What is that modification? Under NPV, we assume that the cash inflows are reinvested at cost of our capital. Under IRR, we assume that the cash inflows are reinvested at IRR. So the modification is to resolve the ranking conflict, we take a common reinvestment rate. We take a common reinvestment rate. We take a common reinvestment rate. So that can be a cost of our capital, that can be IRR or some other rate. But we take one rate for both. One rate for both. For suppose here I got 2,05,749. Yes or no? So this 2,05,749 into what is the third year factor? Present value factor. 0.751. So 2,05,749 into 0.751. 154,517 minus 1 lakh. So 54,517. This 54,517 is nothing but modified NPV. I'm modifying. What is the modification? Instead of reinvestment rate cost of a capital, I have taken what? IRR. So that's why this is what? Modified NPV. Clear? Likewise, for suppose here I got what? 169. Here I got what? 169, 550. For suppose if I am writing 1 lakh equal to 169, 550 into present value factor. Find out the present value factor. 0.589. Now you find out the rate at which this 0.589 lies. So that rate is known as modified IRR. Because for reinvestment we are considering cost of a capital. Are you able to understand the concept modified NPV and modified IRR? Okay. So how the conflict will get resolved? By finding out modified NPV and modified IRR, because the reason we use a common reinvestment rate for both NPV and IRR. That can be a cost of a capital or IRR or some other rate, whatever the rate is. Okay. So almost all the concepts were completed in investment decisions, capital bursting. Are you able to understand this concept? Modified NPV, modified IRR. Why the modified NPV and modified IRR came into picture? Because in NPV and IRR, we are taking two different assumptions. In NPV, we are considering the reinvestment rate as cost of a capital. In IRR, we are considering reinvestment rate as IRR. Okay. What is the modified NPV and modified IRR? taking a common reinvestment rate for both NPV and IRR. Okay, if you are taking a common rate, then it is said to be what? Modified NPV and modified IRR. Okay, am I clear? Are you able to understand this one? So go through this concept again. This is important for the last attempt also. MCQ was asked on modified IRR. They asked us to find out the reinvestment rate. Reinvestment rate. Okay. So this one is advanced concept. You have to learn this modified NPV and modified IRR. Clear? So almost all methods were completed. So are you able to understand the differences between NPV, PI and IRR? When the projects are indivisible, we use NPV and PI, NPV and IRR. But when the projects are divisible, we use profitability index. When the projects are divisible, what is the divisible project, what is the indivisible project, we shall discuss in next class. Okay, right now today you just go through the modified NPV, modified IRR and NPV assumption, IRR assumption. Okay, Likita, thank you. Kamesh. Okay, so if NPV is greater than 1, I mean greater than positive, then profitability index will be greater than 1 and IRR will be greater than cost of a capital. All methods will say you to accept the project. Then what is the necessary of 3 methods? What is the necessity? So to know that necessity, first we have to understand the types of a capital budgeting decisions. What are the types of a capital budgeting decision? Accept, reject a decision. And the second one is mutually exclusive decision. Mutually exclusive decision. So what is this mutually exclusive decision and accept, reject decision? Let us see. So first, capital rationing situation. Capital rationing. So in simple terms, capital rationing means limited funds limited funds in simple terms. So what is the meaning of a limited funds? For example, so we have only 10 lakhs. We have only 10 lakhs. So but we can accept project A, B, C and D. Project A cost 4 lakhs, B cost 4 lakhs, 4 and 3. What is the total investment required? Total investment required is 15 lakhs. Total investment required is equal to 15 lakhs. So, but the amount we have is only 10 lakhs. And all the 4 projects having positive NPV. All the 4 projects having positive NPV. Let us assume positive NPV. And we shall assume another project E. Project E investment is equal to 5 lakhs and the total amount required is 20 lakhs. Okay. So total 4 projects NPV positive except E. Project E NPV is negative. Project E, okay, NPV is negative. What is the amount available? 10 lakhs. Now the point is, so we cannot accept all the profit making investments. Obviously we are not going to accept E, project E, because the reason is it is having a negative NPV. Okay. So with 10 lakhs, can I accept A, B, C and D projects or not? No, I cannot accept what? A, B, C and D projects. Okay. So I have to take a mutually exclusive decision. Mutually exclusive decision. Nothing but what is the meaning of mutual exclusive decision? If I accept some projects, then I have to reject the other projects. I cannot accept all the projects. Okay. Nothing but this situation is known as a capital rationing situation. I have only 10 lakhs, but so to accept all the profit making investment amount required is 15 lakhs. So this situation is known as a capital rationing situation. In that situation, I have to take what? Which decision? Mutually exclusive decision. Mutually exclusive decision. Lakshmi is the option. Mutually exclusive decision. Mutually exclusive decision. For suppose if I have 20 lakhs, if I have 20 lakhs, then if I have a 20 lakhs, then I am not facing a capital rationing situation because amount required to accept profit making investments is 15 lakhs, but I have 20 lakhs. So what I am going to do? I am going to accept A, B, C and D. Nothing but accept all profit making, reject all loss making. I am rejecting E not just because I am accepting A, B, C, D. E is loss making, so that's why I am rejecting. So this decision is known as accept reject decision. Accept reject decision. So when there is no capital rationing situation, ranking need not be given to the projects. When there is no capital rationing situation, I will take accept reject decision. Okay. And that's why I need not give a ranking to the projects. I will accept all the profit making projects and reject loss making projects. But when there is a capital rationing situation, I cannot accept all the profit making investments. So that's why, okay, I will give a ranking. I will give a ranking and I will give accept best projects out of 4 projects. Out of 4 I will accept what? Best projects. Okay. Are you getting my point? Are you able to understand why the ranking is coming into the picture? So when we have unlimited funds, ranking is not required. But when there is a capital rationing situation, we give ranking to the projects. Okay. And we accept the project which is having a best rank. Okay. So what is this ranking? Let us say for example 3 projects A, B, C. NPV, profitability index, IRR. We give rank 1 to the project which is having a highest NPV. Which is having a highest NPV. Let us assume rank 1 comes to A, rank 2 comes to B, and rank 3 comes to C as per NPV. As per profitability index also the same rankings 1, 2 and 3. And as per IRR also same ranking. Okay. Nothing but project A is having highest NPV, highest profitability index, highest IRR. Okay. Out of 3 projects I have to accept only one. Nothing but I have to take mutually exclusive decision. Of course, all the 3 are profit making. All the 3 are profit making, but I do not have a funds to accept all the 3. I have a fund only to accept one project. Nothing but I have to take a mutually exclusive decision because I am facing a capital rationing situation. Now the point is, so I will be accepting which project? Unanimously, all the methods are saying accept project A. I will accept project A. So, is there a ranking conflict or not? There is no ranking conflict. There is no ranking conflict. But there can be a situation so where profitability index may give rank 2 to project A and rank 1 to project B. Now, is there a ranking conflict? Yes, there is a ranking conflict. Okay. And IRR may give rank 3 to project A and rank 1 to project C. Now the point is there a ranking conflict? Yes, obviously there is a ranking conflict. There is a ranking conflict. So which project should be selected? As per NPV I have to select A. As per profitability index I have to select B. As per IRR I should select C. So there is a ranking conflict. So as I am facing a capital raising situation, I can accept only one. So which project I should select? So for that I have to resolve the ranking conflict. First I should resolve the ranking conflict. I have to resolve the conflict. Okay. To resolve the conflict, first I should know the reason for the conflict. Why there is a conflict? First I should know the reason for the ranking conflict. There can be reasons, three reasons for ranking conflict. There can be what? Three reasons for ranking conflict. There can be three reasons for ranking conflict. Okay. Are you able to understand the order? What is the order? If there is no capital raising situation, this concept have no relevance because I am going to accept all the profit making and reject loss making. But if there is a capital raising situation, of course there will be a capital raising situation. Of course, what we face a capital raising situation. When there is a capital raising situation, company has to take a mutually exclusive decision. If a company has to take a mutually exclusive decision, it has to give a ranking. There can be a conflict in ranking. Okay. So before selecting a project, first we should resolve the ranking conflict. To resolve the ranking conflict, first we should know the reason for ranking conflict. Reason for ranking conflict. There can be three reasons for ranking conflict. First one, life disparity, of course size disparity also. Life disparity. Next B, size disparity. Next C, cash inflows disparity. So nothing but timing of cash flows. Timing of cash flows. Okay. So reasons. Reasons can be what? Life disparity, size disparity, cash inflow disparity. Three reasons. Okay. So methods. So what are the methods to resolve the ranking conflict? First we should know the what? Reason. So what can be the reason? The reason can be life disparity. If it is a life disparity, then I will use equated annual benefit or equated annual cost method. Equated annual benefit or equated annual cost method. If it is a size disparity, if it is a size disparity, incremental NPV method. If there is a size disparity, what is the size? Life disparity means project A life is 5 years and B life is 10 years. Project A life 5 years, B life 10 years. Obviously project B will be having a higher NPV because project B life is 10 years. So comparing 5 years life and 10 years is not correct. Yes or no? Are you getting my point? Okay. So we should find out what? Equated annual benefit. Then we can compare because we are finding out benefit per annum. Okay. Equated annual benefit or equated annual cost. If there is a life disparity. Size disparity means investment size. Example, project A investment size 1 crore. Project B investment size 50 lakhs. Then obviously 1 crore investment will have a highest NPV. Yes or no? There can be a chance that project A will have a highest NPV because investment is 1 crore. So in that case we use what? Incremental NPV method. Nothing but simple. We select a project which is having a highest NPV. We select a project which is having a highest NPV. And next, when there is a cash inflows disparity, timing of a cash flows. In that case, we use modified NPV and modified IRR. Modified NPV and modified IRR method. So when there is a cash inflows disparity, we use what? Modified NPV and modified IRR method. Yesterday I have told you what is the modified NPV and modified IRR. Under NPV method, we assume that the cash inflows are reinvested at the rate of cost of a capital. Okay. And under IRR method, we assume that the cash inflows are reinvested at IRR. But under modified NPV and modified IRR, we take a common reinvestment rate. For both modified NPV, modified IRR, I will be taking one common rate. That's how the conflict will get resolved. Okay, nothing but before finding out modified NPV and modified IRR, let us say there are two projects A, B, NPV, IRR. Let us assume NPV. As per NPV method, rank 1 goes to A and rank 2 goes to B. But as per IRR, rank 2 goes to A and rank 1 goes to 1. Okay. So what is the reason? I have already told there can be a conflict between NPV and IRR, and the reason for that is assumption. Cash inflows are reinvested at the rate of. Of course, the reason is if there is no cash flow disparity. If there is no cash flow disparity, so then there may not be a conflict between what? NPV and IRR. Okay. But when there is a timing, when there is a cash flow disparity, then the reinvestment rate will make a difference. What is the reinvestment rate under NPV? Under NPV, we assume that the cash inflows are reinvested at the rate of cost of a capital, and under IRR, we assume that the cash inflows are reinvested at the rate of IRR. Okay. So to resolve the conflict, what we are doing? We are finding out modified NPV and modified IRR. So modified NPV and modified IRR. So if you give ranking as per modified NPV and modified IRR, then if rank 1 comes to A, okay, as per modified NPV, then as per modified IRR also rank 1 comes to A, rank 2 B. Why, sir? Because we are taking a common reinvestment rate. Common reinvestment rate. If you see the last discussed example, then you will get to know. First, we are finding out the terminal cash flow. Terminal cash flow. So, we use the same terminal cash flow for finding out both modified NPV and modified IRR. So, that's why the conflict will get what? Resolved. Are you getting my point? So, first, what is the cash flow disparity? Cash flow disparity is nothing but, let us say, under A, cash inflows are 20, 30, 40, 50. First year 30, 20, second year 30, third year 40, and fourth year 50. B project 50, 40, 30, 20. Nothing but one project might be having a cash flows in increasing trend. The other project will have a cash flows in decreasing trend. Okay, so this is called as what? Cash flow disparity. Timing of a cash flows. Timing of a cash flows. Are getting my point? So modified NPV and modify. We are modifying instead of reinvestment rate cost of a capital or reinvestment rate IRR, we take one common reinvestment rate for finding out NPV and IRR. So then it is called as modified NPV and modified IRR. Okay. So I hope you have understood these concepts. I mean difference between NPV, PI, IRR. Okay. So there can be a scenarios under which the NPV, PI and IRR may reach different conclusions. Being IRR a relative measure, profitability index and NPV an absolute measure. IRR is a percentage, PI is a ratio, NPV is an amount, absolute measure. Absolute measure. These methods may contradict in ranking the projects. The reasons for this ranking conflict can be disparity in size, cash inflows, life of a project. Okay, if it is a size disparity, then I follow incremental NPV method. Nothing but I will select a project which is having a highest NPV. Next, modified NPV, modified IRR methods in case of cash flows disparity. Equated annual benefit or equated annual cost method in case of life disparity. In case of life disparity. Am I clear? So next, incremental NPV. Incremental NPV. So this theory is not required. Simple, we select a project which is having a highest NPV. Next, modified NPV. The value of investment or a project that includes a value for flexibility. When the investment and reinvestment rates are the same, investment and reinvestment rates are the same as a NPV discount rate. Modified NPV will be a better measure because it directly accounts for a reinvestment of the cash flows at a different rate. So see the steps. What are the steps? First one, compute present value of a cash outflow, nothing but initial cash outflow. Second step, compute future cash inflow using reinvestment rate. We find out the terminal cash flow. We find out the terminal cash flow, future cash flow. We reinvest all the cash inflows. Next, compute and then bring the terminal cash flow to the present value. Bring the terminal cash flow to the present value. Compute present value for future cash inflow. Then thereafter, sum of a discounted cash inflow minus sum of a discounted cash outflow, you will get modified NPV. Are you getting my point? I'm taking a simple example. Year 1, 2. Cash flow, future value of a cash flow. Just for understanding purpose. 10,000, 20,000. Let us take a common reinvestment rate for both NPV and IRR. 15%. So now the point is this 10,000 can be reinvested for how many years? 1 year, because life is 2 years. So this 10,000 can be reinvested for how many years? 1 year. So 10,000 into 1 plus 0.15 power 1 power 1, and this is what? 20,000. So what is the answer? 31,500. This 31,500 is the value at the end of a second year. Okay, let us assume cost of a capital is 10%. Cost of a capital is 10%. If a cost of a capital is 10%, then sum of a discounted cash inflow is equal to 31,500. That we should bring that 31,500 to the present value. So 31,500 into, if a cost of a capital is 10%, what is the present value factor for second year? 0. 826. Second year 0.826. The number is 26033, and sum of a discounted cash outflow is equal to, let us assume sum of a discounted cash outflow is equal to 20,000. So 6033 is the modified NPV. Are you getting my point? Modified NPV. What is the normal NPV? For normal NPV, instead of 10,000 into 1 plus 0.15 power 1, I will take 10,000 into 1 plus 0.1 power 1. Yes or no? If it is normal NPV, instead of 15%, I will take reinvestment rate cost of a capital, because under NPV method assumption is cash inflows are reinvested at the rate of cost of a capital. Am I correct? Are you getting my point? Okay. So nothing but let us find out normal NPV also. Year 1, 2, 3 cash flows. What are the cash flows? 10,000, 20,000. Present value factor, discounted cash flow. NPV can be calculated using two. I mean, what is the normal method? Directly we bring the future cash flows to the present value. What are the factors? 0.909, 0.826. So 9090, 16, 5, 20. Total 25, 610. Minus what? Investment 20,000. So 5610. This is how the normal NPV is calculated. But there is an invisible assumption. What is the invisible assumption? Cash inflows are reinvested at the rate of cost of a capital. So year 1 and 2 cash flow, future value of a cash flow. Cash flow 10,000, 20,000. What is the future value of a cash flow? 10,000 into 1 plus 0.1 power 1 and 20,000. Total I will get 31,000. Are getting my point? This is an invisible assumption that cash inflows are reinvested at cost of a capital. Now I bring that 31,000 to the present value. So 31,000 into 0.826 25,606. Next. So what is the outflow? 20,000. So 5606 is the NPV. So here also I have got same number. What is NPV? 5610. Are you getting my point? So, but generally we won't calculate future value of a cash flow. Directly we bring the future cash flows to the present value. This is how the NPV is calculated. Yes or no? So while you calculating like this, you may not be able to see the assumption. What is the assumption? Cash inflows are reinvested at cost of a capital. So what is the difference between NPV and modified NPV? We are modifying. What is that modification? Reinvestment rate. Instead of taking reinvestment rate cost of a capital, we are taking some other rate. Okay. So here we are taking what? 15% reinvestment rate. Now, how the normal IRR is calculated? Normal IRR. Here NPV is 5606. That means IRR is greater than what? Cost of a capital. What is the cost of capital? 10%. Yes or no? The investment is only 20,000. For 20,000 we got NPV 5606. That means IRR might be 25% somewhere else. So let us take a trial at 25%. Here 1, 2, cash flow 10,000, 20,000. Present value factor. Cash flows are uneven. So that's why I am taking trial and error method. I am following trial and error method. PV factor at the rate of 25%. What is the PV factor? 0.1 divided by 1.25. 0.8. 0.64. Discounted cash flow 8,000. So total 20,800. But I should get 20,000. That means IRR might be greater than 20%. So that's why let us take a trial PVF at the rate of 30%. Discounted cash flow. So PVF at the rate of 30%. 0.769. 0.591. What is the amount? 11,820. Total 19,510. So that means IRR lies between 25 and 30. So IRR is equal to 25% plus, I decide a change, 20,800 minus 20,000 divided by 20,800 minus 19,510 into 5. Yes or no? 28.1. So this is IRR. Okay. Are you able to understand? Now to find out what modified IRR, I am modifying the IRR. So under IRR method, we assume that the cash inflows are reinvested at the rate of 28.1% IRR. Yes or no? But modified IRR means we take a common reinvestment rate for modified NPV and modified IRR. Not the cost of a capital 10%, not the IRR 28.1%. We take one common rate. Already for modified NPV, I have taken a rate. What is the rate? 15%. I have used the reinvestment rate 15%. I have calculated terminal cash flow. I got a terminal cash flow. What is the terminal cash flow? 31,500. I will use the same reinvestment rate for modified IRR also. So now how to find out modified IRR? Simple. I have invested what? 20,000 and I am going to receive 31,500 at the end of second year. I need not calculate terminal cash flow again. So same terminal cash flow for modified NPV and modified IRR. And this is a single cash flow. I have invested 20,000. I am going to get 31,500 at the end of second year. So how do I write initial cash outflow is equal to cash inflow 31,500 into present value factor. So present value factor is equal to 0.634. So now I have to find out where does this 0.634 lies. Definitely this 0.634 will be lying at the rate which is less than 28.1. Apply common sense, because under IRR we assume that reinvestment rate is at IRR. But now we have taken a reinvestment rate of 15%. Earlier reinvestment rate 28.1, now the reinvestment rate is 15. Then obviously modified IRR will be less than 28.1 IRR. Are you getting my point? Apply the common sense. Earlier reinvestment rate 28.1. Now the reinvestment rate is 15. Are you getting my point? So that's why you will get IRR less than 28.1%. Let us take a trial at 20%. So PV F at the rate of 20%. See the second year factor. 1 divided by 1.2 2 times. 0.694. PV factor at the rate of 20%, 0.694. So what about, 0.694, but what is the rate required? 0.634. Then try 25%. 0.64. But what do I require? 0.634. That means I have to increase the rate. Take 26. 0.629. That means IRR lies between 25 and 26. Nothing but modified IRR is equal to 25 plus. IRR is 25 plus. So first understand the concept. What is the IRR actually? 28.1. But the modified IRR is 25 point something. So if you observe, the modified IRR is less than IRR. Why? Because reinvestment rate has got reduced. When reinvestment rate has got reduced, then terminal cash flow will get reduced. Are you clear? But if you observe the NPV and modified NPV, NPV and modified NPV, what is the NPV? 5606. But what is the modified NPV? 6033. Modified NPV is greater than what? Normal NPV. Why? Because for NPV reinvestment rate is 10%. For modified NPV reinvestment rate is 15%. Am I clear? But suppose if you are taking for both modified NPV, modified IRR, reinvestment rate 8%. Reinvestment rate 8%. Then modified NPV will be less than NPV. Why? Original NPV reinvestment rate is 10%. But for modified NPV reinvestment rate is 8%. What about modified IRR? Obviously modified IRR will be less than IRR, original IRR, because original IRR reinvestment rate is 28.1, modified IRR reinvestment rate is 8%. If you are taking reinvestment rate 35%, then modified NPV will be greater than NPV. Modified IRR will also be greater than IRR. Are you getting my point? Okay. So modified NPV and modified IRR. Clear concept? Okay. So we have discussed what discounting techniques. What are the discounting techniques? Discounted payback period, NPV, profitability index, and IRR. Tell me the flow. After learning these methods, so ranking conflict came into the picture. Why ranking conflict? What is ranking? So there can be two situations, capital raising situation and so there may not be a capital raising situation. What is this capital raising situation? Limited funds, unlimited opportunities. Are you getting my point? Every day we face the same thing. Limited funds, unlimited opportunities. Yes or no? Okay. So are you getting my point, Ishwar? Tomorrow you might go for shopping, but you will be having what? Limited funds, but unlimited opportunities. Okay. So you will compromise. Yes or no? So the point is limited funds and unlimited. So that situation is known as a capital rationing situation. In that situation, we have to take a mutually exclusive decision. To take a mutually exclusive decision, I have to give ranking. So there can be a ranking conflict between the projects. And the reasons for the ranking conflict may be life disparity, size disparity, cash flow disparity. If it is life disparity, then I use equated annual benefit or equated annual cost method. If it is a size disparity, I use incremental NPV method. If it is a cash flow disparity, then I use modified NPV or modified IRR method. Modified NPV or modified IRR method. Am I clear? Okay. Now let us see the questions. We will be discussing ranking conflict questions at the end. See the question number 12. Question number 12. Question number 12. Lockwood Limited wants to replace its old machine with a new machine. The models A and B are available at the same cost of rupees 5 lakhs each. Replacing a old machine with new machine is also a capital budgeting decision. Okay. Replacing old machine with new machine is a capital budgeting decision. We have our two models having a same cost of rupees 5 lakhs each. Salvage value of the old machine is rupees 1 lakh. The utilities of the existing machine can be used if the company purchases A. Additional cost of utilities to be purchased in that case are rupees 1 lakh. The utilities of the existing machine can be used if the company purchases A. The existing parts, utilities can be used if I am going to purchase model A. And the amount to be spent on utilities is 1 lakh. If the company purchases B, then all the existing utilities will have to be replaced with the new utilities costing 2 lakhs. Are getting my point? I have two options, model A, model B. If I purchase model A, I can use existing utilities. If I purchase model B, then I cannot use existing utilities. I have to replace all the existing utilities with new utilities. The salvage, in that case, the salvage value of old utilities will be 0.2 lakhs. Nothing but if I go for model B, so I have no use of old utilities. So I can sell it in the market. So what is the salvage value of old utilities? 0.2 lakhs is the salvage value of old utilities. The earnings after taxation are expected to be nothing but they have mentioned specifically cash inflows. Cash inflows. Don't get confused. Earnings after tax is different from cash inflow. Earnings after tax plus depreciation is the cash inflow. You might get confused. What, sir, whether it is a earnings after tax or a cash inflow? In table they have clearly mentioned what cash inflows. Okay, so that means those are the cash inflows. Depreciation need not be added. Year 1, 2, 3, 4, 5 salvage value at the end of year 5. The targeted return on a capital is 15%. You are required to compute for the two machines separately net present value, discounted payback period, and desirability factor. Desirability factor is nothing but profitability index. State which of the machine to be selected. State which of the machine to be selected. Simple question. So in question they have mentioned earnings after tax and later on mentioned cash inflows. So that's why I am assuming these given figures are cash inflow. For suppose in both the cases, in both places they have mentioned earnings after tax. Then what? I have to add depreciation to get cash inflow. Okay. In this question the special point is calculation of initial cash outflow. So what is the question number? 12. The referral point is initial cash outflow. Initial cash outflow. Initial cash outflow. So how many models we have? Two models, A and B. You have to refer this point. This is the only point you have to refer. Particulars A and B. So now what is the cost of a machine? Both the machines cost me same. Cost of a machine. The cost of a machine is 5 lakhs. Okay. So to this I have to add cost of utilities because this is also my outflow. Cost of utilities. What is the cost of utilities for A? 1 lakh and for B 2 lakhs. Why 2 lakhs for B? Because old utilities cannot be used for model B. And next minus salvage value of old utilities. What is the salvage value of old utilities? First case nil because I am using old utilities to the new machine. In second case 20,000. Okay. And what is the salvage value for old machine? 1 lakh. If I purchase new model, then I will sell old model. Yes or no? I will sell old machine or not? So minus what? Salvage value of a old machine in both the cases. So whether I purchase model A or model B, in both the cases, I am going to what? Sell old machine. What is salvage value of old machine? 1 lakh. So my initial cash outflow is 5 lakhs, 5 lakh 80,000. 5 lakhs and 5 lakh 80,000. 5 lakhs and 5 lakh 80,000. Clear? So this is the only point to be referred. Next practice is not required because you know how to find out NPV. We should bring all the future cash flows to the present value. A cash flows are given, B cash flows are given, present value factor is also given. So we have to bring future cash flows to the present value. Then you will get what? Sum of a discounted cash inflow minus what? Sum of a discounted cash outflow. Okay, NPV. Are you getting my point? This is not for practice. I mean calculation of NPV because you know how to bring the future cash flows to the present value. Generally, what we do is what our way of a preparation is we note down the initial cash outflow, the point which has to be guessed or referred, that you will note down, and later on you will take heading calculation of NPV, and if you you start practicing. What is that practice? You bring the future cash flows to the present value. That is a calculator practice, not IQ practice. Okay. So in this question, what is the referral point? Initial cash outflow. Okay. But generally students by calculating NPV they will waste time during preparation. You know how to find out NPV. You should not waste time on finding out NPV. And you know how to find out discounted payback period. How to find out discounted payback period? What are the columns? Year, discounted cash inflow, cumulative discounted cash inflow. That's how I find out, I mean, discounted payback period for both A and B. And next, desirability factor, sum of a discounted cash inflow divided by sum of a discounted cash outflow. Okay, are you getting my point? The point here to be referred is what? Initial cash outflow. Okay, you feel like practicing this part, calculation of NPV, but no, not required because you know how to find out present value factor. Cash inflows into present value factor is nothing but what? Discounted cash flow. You should not waste time. Clear? See the question number 13. Question number 13. Hind Liver Company is considering a new product line to supplement its range of products. It is anticipated that the new product line will involve a cash investment of rupees 7 lakhs at time 0 and 10 lakhs in year 1. In this question, the special point is the investment is made at the end of, I mean at the beginning of first year, that is 0 year, and 10 lakhs in year 1. So we are investing what? 7 lakhs in 0 year. Initial cash outflow 7 lakhs, and at the end of a first year outflow 10 lakhs. So this is the only special point in this question. And after tax cash inflows of rupees 2,50,000 are expected in year 2. Generally, in all the questions, cash inflows are arising from the first year. But in this question, cash inflows are arising from second year. What is the second year cash flow? 3 lakhs. Sorry, 2 lakh 50. Third year, 3 lakhs. 3 lakh 50 in year 4. And 4 lakhs each year thereafter through year 10. 4 lakhs every year from 5 to 10 years. Although the product line might be viable after year 10, after 10 also product line is viable, but the company prefers to be conservative and end all calculations at that time. Getting my point? So product line will be after 10 years also, but company to be conservative will be considering only what? Calculations up to 10th year. Okay. If the required rate of a return is 15%, compute NPV of the project. Is it acceptable? Is it acceptable? Simple question. We bring all the future cash inflows to the present value minus what? Outflow. Next, analyze what would be the case if the required rate of return were 10%. Instead of 15%, we should take what? 10%. And what is the next one? Calculate its IRR. You might have commit a mistake while finding out what IRR. Be careful. Next word, compute. Compute the project's payback period. Compute the project's payback period. Okay. So this question is also not for practice. Just refer IRR. But now we shall do in the class. Question number 13. Question number 13. What is the first question? Calculation of NPV. Year, cash flow, PVF at the rate of calculation of NPV, PVF at the rate of what? 15% discounted cash flow. Year column. First year. First year. Take first year. First year. What is the first year cash flow? Is it inflow or outflow? Outflow. What is the outflow? 7 lakhs. Year 2. Year 2. What is the cash inflow? 2 lakh 50,000. Year 3. Year 1 10 lakhs. Okay. Year 1 10 lakhs. Year 2 2 lakh 50. Year 3 3 lakhs. 4 3 lakh 50,000. Next 4 lakhs. From 5 to 10 years 4 lakhs. Okay, nothing but I will take 0 year cash flow at the end. Okay. So what is the present value factor at the rate of 15% for the first year? 0.869. Next is 0.756. 0.657. 0.571. 0.497. Discounted cash flow. Sorry, not 0.5497. 5 to 10 years. How do I get 5 to 10 years factor? Total 10 years factor minus first 4 years. Nothing but 1 divided by 1.15 equal to 10 times grand total. Then you will get 10 years factor. Two point what? 165. How to get 5 to 10 years factor? Total 10 years factor minus what? First 4 years factor. Am I clear? So now discounted cash flow. Discounted cash flow. First one 8 lakh 69,000. Next 1 lakh 89,000. Next 1 lakh 97,100. Next 1 lakh 29,850. 1 lakh 99,000. 1 lakh 99,850. Next 8 lakh 66,000. The total is the sum of our discounted cash inflow. What is the sum of our discounted cash inflow? Sum of our discounted cash inflow 582,950 minus sum of our discounted cash outflow 7 lakhs. You're getting a negative NPV. What is the negative NPV? 1,17,117,050. 117,050 is the NPV. Am I clear? Now the second part of the question is, if required rate of a return is 10%, does it make a difference? Does it make a difference or not? Obviously, if I take 10%, then NPV will increase. Yes or no? Now this is NPV positive or negative? Negative. Now I should take what? 10%. B part. B part, calculation of a NPV. Calculation of a NPV. Calculation of a NPV. Calculation of NPV. What are the columns? Year, cash flow, PVF slash PVAF at the rate of 10% discounted cash flow. Year column. 1, 2, 3, 4, 5 to 10. What are the cash flows? Year 1, 10 lakhs, 2 lakh 50,000, 3 lakhs, 3 lakh 50,000. Factors 0.909, 0.826, 0.751, 0.683, 2.975. Consider only 0 year cash flow as outflow, okay? I mean, first year also outflow. Take first year outflow along with inflow, okay? Discounted cash flow 9 lakh, 9,000, 2 lakh 6,500, 2, 2, 225,300, 239,050, 11 lakh 90,000. The total 951, 850. So this is the sum of a discounted cash inflow minus sum of a discounted cash outflow is 7 lakhs and your NPV is positive. What is NPV? 251, 850 is the NPV. NPV is positive. NPV is positive. 251, 850. Now what is the next part of the question? Calculate the IRR. Calculate the IRR. Okay. So how to find out IRR? Simple. At 15% I got NPV negative. Yes or no? At 10% I got positive. That means IRR lies between 10% and 15%. IRR is equal to 10% plus. At 10%, IRR is a discount rate at which sum of our discounted cash inflows are equal to initial cash outflow. What is my initial cash outflow? 7 lakhs. If I discount all the future cash flows, I should get 7 lakhs. Yes or no? Then the rate will be at IRR. So at 10% I got sum of a discounted cash inflow 9 lakh 51,850. What is the required? What is the desired cash inflow? 7 lakhs. That means I want a change 251 850 divided by 951,850 minus at 15%. What is the sum of a discounted cash inflow? 5,82,950. Note down the solution and follow the solution in order to avoid confusion. Okay. Into what? 5. I am doing interpolation. 10% plus the desired change 251 850 divided by the available change into 5. 13.41 percentage. 13.41 percentage is the answer. Done? Okay. So IRR is equal to 13.41 percentage. And what is the next part of the question? Compute the project's payback period. Project's payback period. What is the investment? 0 year, 7 lakhs. First year, 10 lakhs. Overall, 17. Okay. So by the end of a second year, I am able to invest, get 2 lakh 50. By the end of a third year, 3 lakhs. Fourth year, 3 lakh 50. Fifth year, 4 lakhs. And sixth year, 4 lakhs. The total investment is recovered by the end of sixth year. A table and calculation is not required. So our investment is 17. We are able to recover 17 by the end of sixth year. So 2.5 plus 3 plus 3.5 plus 4 plus 4. Okay, done. So in December 24, the first MCQ is with related to modified. Okay, reinvestment rate was asked. See the question. The investment given is what? 36 crores. Investment. So modified NPV is given already. Modified NPV. What is a modified NPV? 8.123 crores. Okay. These two are given in the question. Mod investment, modified NPV. So if you add modified NPV to the investment, then you will get sum of a discounted cash inflow. What is the sum of a discounted cash inflow? 44.123 crores. The question is, they asked you to find out reinvestment rate. See the how, reverse working is given. Cost of a capital is already given in the question. What is the cost of a capital? 12%. Using the cost of a capital. Generally, I bring the future cash flows to the present value. But here, I have a present value, sum of a discounted cash inflow 44.123, and I have a cost of a capital. So I am finding out what terminal cash flow. To bring the terminal cash flow to the present value, I will multiply with present value factor. But to find out the terminal cash flow, I have to divide the sum of a discounted cash inflow with present value factor. So 44.123 divided by 0.5674, then I got 77.76 crores terminal cash inflow. Terminal cash inflow. Annual cash inflow is given in the question. What is annual cash inflow? 12 crores. Annual cash inflow is given in the question. 12 crores. Are you getting my point? Even cash inflow, annual cash inflow is given in the question. Terminal cash flow is there, 77.76. So in annuity chapter, time value for money, I have discussed. Future value of annuity is equal to annuity into future value annuity factor. I know the future value of annuity, that is 77.76. that is equal to annual cash inflow 12 crores into future value annuity factor, and the future value annuity factor is 6.48. So the table is given, future value annuity factor table is given in the question. So that 6.48 future value annuity factor lies at 13%. So the final answer is 13. So very hard, not that easy question, because generally students will ignore modified NPV and modified IRR concept, and that too this is asked in reverse. At most conceptual clarity is required to solve this 2 marks MCQ. Uh, 5 years. 5 years. Annual cash flow 12 crores for how many years? 5 years. అంటే ఇప్పుడు క్వశ్చన్లో ఇచ్చిన, ఐ మీన్ ది ఇన్ఫర్మేషన్ గివెన్ ఇన్ ద క్వశ్చన్ ఈస్ ఇన్వెస్ట్మెంట్ 36 crores, modified NPV 8.123, cost of our capital 12%, annual cash inflow 12 crores. So this is the information given in the question. Okay, and the table, future value annuity factor table is given. Okay, this is the first one, first MCQ. Okay, first MCQ. Generally first MCQ will be from investment decision, and the last attempt also IRR related question is asked. That is not that easy. I mean generally first MCQ will you find tough. First MCQ, only the first MCQ you will find tough. Okay, I have written the review here. So first MCQ hard, second one is very simple, from security valuation, very simple, the basic understanding, and the third one also forex basic, forex basic, and fourth one also portfolio management, the basic, easy. Fifth one moderate, I will not say it easy, and again sixth one is very easy from digital finance. Seventh one easy from derivatives. Eighth one easy, that it a repetitive question, that one past exam question has got repeated. And ninth one hard, you will not be able to do. Okay, so ninth one. 10th one easy, and 11th one easy, basics of derivatives, basics. And 12th one easy, mutual funds basics, mutual funds basics, nothing but. So out of 15 MCQs, 10 will be asked from basics. Even if basic level of understanding is there, you will be able to answer. Not from investment decision. Investment decision question is being asked hard, I mean that is not that easy. But whereas in portfolio management, derivatives, forex, mutual funds, you will find MCQs easy, not that hard. Okay, so out of 15 MCQs, okay, so 10 easy, I mean without wasting time you can pick the answer, and remaining 5 you can, I mean if you work you can answer 2, and 3 always hard. I will not say you will get 30 out of 30. In SFM you will not get 30 out of a 30. In AFM student can get 100 out of 100, but in CMF and SFM student cannot get 100 out of a 100, rare. Okay, even if he gets, that is I mean by luck. So 3 MCQs can be picked, I mean by luck. Okay, because we have a vast theory, unnecessary theory is there. Out of that theory he will be picking 2 to 3 MCQs. We cannot go through all that theory. So clear? So this question, are you able to understand what is the payback period? Okay, so the only point here to be highlighted is there are two cash outflows. One is in 0 year and the other one is first year. 0 year cash outflow 7 lakhs. Take it at the end. take only initial cash outflow at the end. Are you getting my point? Okay, otherwise you might get confused. So that's why take 0 here, initial cash outflow at the end. Okay, see the next question. Question number 14. Navajivani Hospital is considering to purchase a machine for medical projectional radiography which is priced at rupees 2 lakhs. Hospital is considering to purchase a medical projectional radiography which is priced at rupees 2 lakhs. The projected life of a machine is 80 years and has an expected salvage value of rupees 18,000 at the end of a 8th year. The annual operating cost of the machine is 22,500. It is expected to generate a revenue of rupees 1,20,000 per year for 8 years. Presently, the hospital is outsourcing the radiography work to its neighbor test center and is earning commission income of rupees 36,000 per annum net of taxes. So in this question, this is the new point. Required, analyze whether it would be profitable for the hospital to purchase the machine. Give your recommendation under NPV profitability index. Consider tax at the rate of 30%, present value factor at 10% are given below. Okay, so NPV and next what? Profitability index. So here the important point is presently the hospital is outsourcing the radiography work to the neighbor test center. I told you RMP will refer patient to the diagnostic center, will get a commission. Will refer patient to medical shop and will get a commission. Will refer to a super specialty hospital and get a commission. Likewise here this hospital is what? Outsourcing work to the neighbor test center and is earning a commission income of rupees 36,000 per annum net of taxes. Am I clear? So now the point is, so if company purchases an equipment on its own, if a hospital purchases an equipment on its own, then it is foregoing an income of 36,000 and be careful, it is a net of taxes. 36,000 is the income net of taxes, nothing but after tax. That is income foregone after tax. Okay. So analyze whether it would be profitable. Give your recommendation based on NPV and profitability index. Okay. What is the equipment cost? 2 lakhs. On spending 2 lakhs, you can generate a revenue of 1,20,000 every year, and against that you have to incur annual operating cost 22,500. 22,500. At the same time, you are losing an opportunity of earning commission income. Commission income. So question number what? 14. Question number 14. Annual cash inflow. particular amount. Just visualize what is the revenue we are able to generate. What is the revenue? 1,20,000. We receive 1,20,000 from patients minus operating cost. What is operating cost? 22,500. Okay. So this amount is nothing but profit before depreciation and tax, not the cash inflow. Be careful. This is not the cash inflow after tax. This is what? Profit before depreciation and tax. 97,500. Some student might directly reduce the tax, but before reducing the tax, depreciation is an allowable expenditure. So that's why this 97,500 is profit before depreciation tax. Minus what? Depreciation. What is the depreciation amount? 2 lakhs minus 18,000 divided by 22,750. 22,750. So this is what profit before tax. What is the profit before tax? 74,750 minus tax at the rate of 30%. 22,420. Profit after tax. 52,325 minus opportunity cost. Commission minus opportunity cost commission. What is the commission amount? 36,000. Add depreciation. What is the depreciation? 22,750. So this is my annual cash inflow. What is my annual cash inflow? 39075. Why I am reducing my opportunity cost at the end? Because the reason is it is given that net of taxes. Net of taxes. Net of taxes. Okay, clear? For suppose if it is not mentioned net of taxes, then I might have reduced opportunity cost along with operating cost. Okay. So there is another alternative. This 36,000 is net of taxes. Find out the before tax commission income. How do I get before tax commission income? What is the tax rate? 30%. That means this 36,000 is equal to 70. I have to find out 100. So 36,000 divided by 70 into 100. 51,428. Along with operating cost, you reduce what? 51,428. Then also you will get the same answer. Clear? Okay. So clear. So this is a CA inter question. Our fate is sometimes depends upon what ICAI. For the first time when I started teaching, this question was asked in examination. The only difference is tax rate is not given in the question. Tax rate is not given in the question. Are you getting my point? Tax rate is not given in the question. So I had started my career at that first attempt. So if tax rate is not given in the question, what is the way out? Generally, what you are going to do? For suppose if I am in that position as a student, I will take revenue minus operating cost minus opportunity cost. I consider that itself as a cash inflow because in question no tax rate is given. Okay. So that's why I will consider revenue minus operating costs minus what? Commission income. So this is my annual cash inflow. I will bring it to the present value and find out NPV. Okay. But whereas in suggested answer, so they have assumed a tax rate as 30%. Okay. So when there is no tax rate in the question, how can we assume? Okay. So if that is the case, now also the CA inter study metal would remain same. Why now they are giving 30% tax rate? Are getting my point? Nothing but if a question is wrong, okay, if a question is wrong, they will give a correct answer. Sometimes question will be wrong. After a certain period of time, what? They will not change answer according to the question. They will change what? Question. I have came across lot many questions in FM and SFM, especially in CA study material. They will not change answer. They will not change answer. They will change what? Question according to the answer. Okay. And the very same attempt, they gave one more ratio. What is that ratio? Fixed asset divided by fixed assets plus working capital 1.2. Nothing but fixed assets to net worth something. So 1.2. Okay, they gave this ratio and they asked to prepare a balance sheet in ratio analysis. Now the point is fixed asset divided by fixed asset plus working capital cannot be 1.2. What is the meaning of 1.2? Fixed asset plus working capital, if it is 1, then fixed assets is equal to 1.2. Okay, so similar kind of a ratio is given. The point is, so in suggested answer they gave an answer. What is the answer? You have to assume it as a fixed asset plus working capital divided by fixed asset. 8 plus 8, 16 marks gone. Students failed and my career also ruined. Because my career linked with what? Student career, yes or no? So that's how. There are lot many questions. Over a period of change. So that's why I go through the study material because the reason is I have a clarity with concepts. But I have to go through what? Study material and I have to tell the answer which is given in the study material. Are you getting my point? Sometimes in forex also the same questions. Okay. So these days the errors have been reduced. When compared to CA, CMA is better in my point of view. CMA answers will be a little bit better. Not the study material. I am talking about exam paper. Not the study material. You will find lot of mistakes in study material. But whereas in question paper, that's okay, fine. They will give properly only. Okay. But irrespective of that, focus on this. What is the answer? So what is the special point in this question? Only commission income, opportunity cost. So 39,075 is the annual cash inflow. So 1 to 8 years, 39,075, and at the end of the 8th year, salvage value 18,000. So generally you might forget taking a salvage value. Be careful. Salvage value is also a benefit received at the end of the life of a project. And one more benefit you might get, that is working capital. Working capital. Initial outflow. At the end of a life, working capital is the inflow. And what is the NPV here? 16,832. And the desirability factor 1.084. 1.084 is the profitability index. Done. Clear, Prasanna? Okay. So what are the A category topics? Portfolio management, mutual funds, derivatives, security, valuation, digital finance, securitization. Okay. In that six topics also, the most important is digital finance, securitization, two theory topics. These two theory topics are very, very, very important because the reason is compulsory you will get 14 to 16 marks, and that too by investing less time, by investing around 5 to 6 hours. Okay, for the entire 6 months you can score what, 14 to 16 marks. So that's why digital finance and securitization, these two are very, very, very important. And thereafter the important topics are portfolio management, mutual funds, derivatives, forex. I mean, not the forex. Forex comes under B category. So four categories, practical topics comes under A category. Portfolio management, mutual funds, derivatives, security, valuation. Why these topics comes under A category? If you see this paper also, this 13th one, portfolio management, easy. Okay, 2 marks. And mutual funds, easy, 2 marks. Derivatives, easy, 2 marks. And derivatives, easy, 2 marks. This one is hard, leave it. 8th one, easy. And 7th one, easy. That means you will get a easy MCQs from these topics. Okay, so that's why this comes under what? A category. And next to the B category is foreign exchange exposure, forex. Forex comes under what? B category. And evaluation of risky proposal will also come under B category. These two are more important in B category. And there are two other topics. What are the two other topics? IFM, International Financial Management, Interest Rate Risk Management. In the new syllabus, no question was asked from interest rate risk management till now. But we can expect for June 25 or December 25 for sure. Because in old syllabus, lot many times it was asked, currency swap question. So I was expecting. And IFM theory question is being asked, International Financial Management. Okay. So under B category, what are the two important topics most important? Evaluation of risky proposal, forex. These two are important. So out of two, ERP is important. The third one is third category, C category, investment decision. And I'm giving the logic also why it comes under C category. Sir, we are able to understand investment decisions. We find it easy. Then why it comes under C category? So why I am categorizing it under C category? Because the investment of a time. How much time are we investing in this topic? First point. Second point. After practicing 30 to 40 questions or even 100 questions from CA Inter, CM Inter and CMA panel also, you might get a new question in the examination. So that's why understanding the concept is enough, not the practicing many questions. Okay, you will be able to attempt a question irrespective of a practice. Okay, so that's why this comes under what? C category. Leasing also comes under C category because leasing also you might find a new question in examination. I mean, we cannot guess questions. For example, I cannot guess question from leasing and investment decision, but I can guess question from ERP. Okay, I can guess question from Forex. I can guess question from portfolio management, but I cannot guess question from investment decision and leasing, because anyway they will be asking what new question. Okay, and you will be able to attempt even if new question is asked. And one more topic comes under C categories: security analysis. Security analysis. Okay, in this also we have a categorized questions into what? Main and additional. Main and additional. And in main questions also I have mentioned questions to be practiced, important questions. And in that again I have refined and given super 50. Super 50. So what is the order? First, super 50, you have to practice each and every question by writing, not just referring. By writing, you have to practice what? Super 50 questions. And super 50 plus main category, I mean A category main questions, B category main questions. If time permits, what? CMA final compiler, and then CA final compiler, and then MLA MP, and then come to additional questions. Okay, and mainly depending upon if you are writing both, then just restrict to what? A category and B category main questions if you are writing both groups. For suppose if you are writing single group, then go for CMA final compiler and CA final compiler. If you are writing only single group, okay, so clear. If you are writing both, then you have to reduce your sources. Adodna, okay. B category, that too on main questions. Okay. So in capital bursting, in investment decisions, we have already discussed techniques. What are the techniques? Non-discounting techniques. What are the non-discounting techniques? Payback period, average rate of a return, payback profitability, payback reciprocal. Payback period means time taken for recovery of a initial investment. Time taken for recovery of initial investment. Okay. So we select a project which is having a lower payback period. Lower payback period. Okay. So what are the drawbacks of payback period? In payback period, we are not considering time value of money. Next, we ignore the cash inflows arising after payback period. We ignore the cash inflows arising after payback period. So, however, this method is useful where an industry is having a high technological obsolescence. Technological obsolescence. Okay, obsolescence means change in technology. If technology is changing fast, then we use a payback period. Okay. So what is the next one? ARR, average rate of a return. So what is the formula? Average profit after tax divided by initial investment. We compare ARR with cost of a capital to take a decision. And under ARR method, we ignore time value of money. Instead of cash inflows, we consider profit after tax for decision making, and that is the drawback. And next one, payback reciprocal. Payback reciprocal. 1 divided by payback period. Payback profitability. Payback profitability is nothing but total cash inflows minus outflow. Okay. So next, discounting techniques. NPV, net present value, profitability index, IRR, internal rate of a return, IRR. And next, so modified NPV, modified IRR. And we have seen adjusted NPV, adjusted NPV. So there can be a capital raising situation. What is that capital raising situation? Where the funds are limited. Where the funds are limited, we cannot take accept rejected decision. Accept rejected decision means accept all profit making and reject all loss making. So we cannot take accept rejected decision when the funds are limited. We cannot accept all the profit making investments. So we have to take a mutually exclusive decision. Mutually exclusive decision means if we accept one project, then we have to reject the other projects. So this is known as mutually exclusive decision. Mutually exclusive decision. Okay. And next, so after, so mutual exclusive decision. Generally, a business will face a capital raising situation and it has to take a mutually exclusive decision. It cannot accept all the profit making investments. So we give a ranking. We give a ranking to the projects and there can be a ranking conflict. There can be a ranking conflict. So to resolve the ranking conflict, first we should know the reasons for ranking conflict. The reasons for ranking conflict can be, first one, life disparity. If it is a life disparity, that can be resolved using equated annual benefit or equated annual cost method. For suppose if the ranking conflict is due to the size disparity, then we use incremental NPV method. Incremental NPV method. For suppose if it is a, okay, if a ranking conflict is due to cash flow disparity, then we can use modified NPV or modified IRR method. Modified NPV and modified IRR method. So what is that modified NPV and modified IRR? We have seen the difference between NPV and IRR. Under NPV, we assume that the cash inflows are reinvested at cost of a capital. Whereas in IRR, we assume that cash inflows are reinvested at IRR. But under modified NPV and modified IRR, we assume a common reinvestment rate. So that's why that is called modified NPV or modified IRR. So these concepts may not be important from examination point of view, but in interview they are generally asking the difference between NPV and IRR, what are the assumptions, what is the concept of modified NPV and modified IRR. Okay. So modified NPV, nothing but we are modifying NPV and we are also modifying IRR. Instead of taking reinvestment rate cost of a capital or IRR, we are taking a common reinvestment rate. Okay. Am I clear? And we have learned how to find out annual cash inflow. Annual cash inflow. So how do we get annual cash inflow? So sales minus variable cost minus fixed cost. Profit before depreciation and tax. When there are no taxes, the profit before depreciation and tax itself is the cash inflow. PBT is also known as cash inflows before tax. So profit before depreciation and tax minus what? Depreciation. So profit before tax minus tax, profit after tax, and then add depreciation. Okay, then we get annual cash inflow. Annual cash inflow. So clear? So okay, next we shall see question number 15. Question number 15. Question number 15. Question number 15. Tektronix Limited, an existing company. Tektronix Limited, an existing company, is considering a new project. Considering a new project for manufacture of pocket video games. for manufacturing of a pocket video games involving a capital expenditure of rupees 600 lakhs and working capital of rupees 150 lakhs. The capacity of the plant is for an annual production of 12 lakh units and capacity utilization during the 6-year working life of the project is expected to be as indicated below. Year 1 capacity utilization 33.33, year 2 66.67, year 3 90%, year 4 to 6 100%. The average price per unit of the product is expected to be rupees 200, netting a contribution of 40%. Annual fixed cost excluding a depreciation are estimated to be rupees 480 lakhs per annum from the third year onwards. For the first and second year, it would be 240 lakhs and 360 lakhs respectively. The average rate of a depreciation for tax purpose is 33 1/3% on the capital assets. No other tax reliefs are anticipated. The rate of income tax may be taken at 50%. At the end of the third year, an additional investment of rupees 100 lakhs would be required for working capital. The company, without taking into account the effects of financial leverage, has targeted for a rate of return of 15%. You are required to indicate whether the proposal is viable, giving your working notes and analysis. Terminal value for the fixed assets may be taken at 10% and for the current assets at 100%. Calculation may be rounded off to lakh of rupees. For the purpose of your calculation, the recent amendments to tax laws with regard to balancing charge may be ignored. Okay. So first, we have to pick up the relevant information from this question. Similar kind of questions you will find in SCM also, strategic cost management. The drawback of SCM is question is lengthy. You will find question lengthy and you have to filter the information. You have to take only the relevant information. Okay. Here also, if you see the information, so they are producing what? Video games. What is the capital expenditure? 600 lakhs. What is the working capital? 150. So that is the investment. So that is the investment. So that means if you want to start the new project, initial outflow would be 600 plus 150. So around 750 we are going to spend. Okay. What is the capacity of the plant? 12 lakhs is the capacity of the plant. What is the working life? 6 years. That means if you purchase this asset, if you commence this project, you will get a benefit for how many years? 6 years. Okay. Am I going to get a same benefit for every year? No. Because first year capacity utilization is 33.33%. 33.33. Okay. So second year capacity utilization 66.67, 66%. Third year 90 and 4 to 6 years 100% capacity utilization. Obviously. Okay. So first year what is the capacity utilization? 33.33. The average price per unit of the product is expected to be rupees 200, netting a contribution of 40%. Average price is 200, but contribution ratio is 40%. That means what is the per unit contribution? 80 rupees is the okay. This is 2 table. 2 into 4, 8. For 2 table, we should not use the calculator. So 200 into 40%. What is the amount? 80 rupees is the contribution. Okay. So next, annual fixed cost excluding depreciation are estimated to be rupees 480 lakhs per annum for the third year. For the third year, 480. But for the first year, 240, second year, 360. So fixed cost is 240, 360, 480, 480, 480, 480. The average rate of depreciation, 33 1/3% on the capital asset. Is it SLM or WDV, return on value? The average rate of depreciation for tax purpose is 33 1/3%. Is it straight line method or return on value? So for suppose let us assume straight line method. Okay. 33 1/3%. If asset cost is 100, the depreciation is 33.33. First year depreciation 33.33. Second year depreciation 33.33. Third year depreciation 33.33. That means in 3 years the asset will get depreciated. Then how come the life of asset will be 6 years? So that means is it SLM or return on value? Return on value. Okay, not SLM. It is what? Return on value. No other tax reliefs are anticipated. The rate of income tax is 50%. At the end of the third year, an additional investment of rupees 100 lakhs would be required for working capital. Working capital. So apply the common sense. Working capital, initial already we have discussed. Working capital is the outflow in the beginning, okay, and inflow at the end of the project. Inflow at the end of the project. Are you getting my point? You can assume, even you can visualize a business, any business, okay. You can visualize a business, okay, any kind of a business. So if you start a new project or a new business, you will be making investment in what? Working capital. Working capital. Okay. So let us assume Kamesh, okay, for suppose he is starting a sweet shop. Okay, visualize the situation. If he is commencing a sweet shop, if he is starting a sweet shop, he will making investment in fixed assets. Okay, fixed assets like utensils, furniture, machinery, etc. Okay, and at the same time he will be making investment in working capital. At any point of a time in that particular sweet shop, you will be finding sweets, you will be finding work in progress, you will be finding raw material. Yes or no? If you have observed any sweet shop process, okay, go down, especially process where the process is being done, you will be finding the raw material stock in the stores, work in progress, and finished goods in the sweet shop. Yes or no? That is the investment in working capital. But at the end of the life of the project, for suppose the sweet shop life is, let us assume 10 years. At the end of a 10 years, if the life has got completed, then what happens? He will take back the investment made in working capital. Nothing but you will not find any sweets further after 10 years. So that's why the working capital is initially it is outflow, but at the end of the life it is inflow. Okay. If nothing is mentioned in the question, then outflow 100 rupees, inflow is also 100. We take the same amount. But in this question, they have clearly mentioned the required rate of a return is 15%. Terminal value of fixed assets. What is the terminal value of fixed assets? 10%. Current assets? 100%. Okay. So generally for working capital, there won't be any depreciation. For working capital, there won't be any depreciation. For example, we have to maintain some amount of a cash. When we start a business, we have to maintain some amount of a cash. Yes or no? Okay. If you go to the hotel, there will be some cash in the counter. Yes or no? they will be maintaining some amount of a cash at any time. So that cash is a working capital investment. Whether that cash will get depreciated or not, no, will not get depreciated. But when the project ends, we take back that cash. Okay. Likewise, we might make an investment in debtors. We might make investment in raw material. Okay, this raw material will get depreciated or not? No. The sweets which are there in sweet shop will not get depreciated because that sweets will be sold and the new sweets will come into that place. That's how the sweets will get rotated. So that's why in working capital, generally if we make investment of 100, at the end of the project we get back what? 100. Okay. But whereas fixed asset what? It will get depreciated. Plant and machinery value will get depreciated due to usage or passage of time. Okay. So calculation may be rounded off to 1 lakh rupees. So you have to understand the concept. So for suppose if we start the project, first we should identify initial cash outflow. So question number 15. Question number 15. Likita, am I audible? A initial cash outflow. A initial cash outflow. A initial cash outflow. So particulars. Amount. In particulars, what is the first one? Capital expenditure 600 lakhs. Next, working capital. What is the working capital? 150 lakhs. Total 750 lakhs is the outflow. Initial cash outflow. Okay. So there is a time value for money. Yes or no? How do we procure the 750 lakhs? We procure the 750 lakhs from debt holders and equity shareholders. They have some expectation. That overall expectation is known as a weighted average cost of a capital, or that can be called as opportunity cost of a capital or required rate of a return. In this question, the required rate of return is 15%. What is that 15%? Minimum return required by the company to meet the expectation of the investors. To meet the expectation of investors, minimum return required is 15%. Okay. By using this 15%, we bring the future cash inflows to the present value. Okay, if some of our discounted cash inflows are greater than 750, then we accept, otherwise reject. And you just link this concept with valuation of asset concept. How do we get the value of any asset? We should bring the future benefit to the present value. Any asset, value of any asset. That might be a BCCA, plant and machinery, building, whatever. Even business valuation also similar. Business valuation also, business value also depends upon the future economic benefit. Okay, future economic benefit. Okay. India is the fast developing company, and right now India is getting an importance throughout the world because the reason is India is having the young population. The average age of Indians right now is 29 years. No other country is having a young population. Okay, so China population has got decreased. Now they are providing incentives to increase the population. Okay, Japan, nobody is interested to marry in Japan. US, Germany, all countries, the average age is more than 45 years. The only India is having young population, that is Okay, 29 years average age. I hope you know the average age. Okay. So the point is the value depends upon the future economic benefit. Why the India value is increasing? Because the age is average is 29. So the future economic benefit is what? When compared to other countries, so here the population future economic benefit is more. Future depends upon the value depends upon what? Future. Okay. So this is initial cash outflow. Next, what is the second step? We should find out the future benefit, and thereafter we should bring that future benefit to the present value. So B. So now future economic benefit, whether it is even or uneven, here in this question, if I commence this project, I'm going to get a benefit for how many years? 6 years. Whether benefit is same for every year or not? No, because first year capacity utilization is 33.33, second year 66.67, third year 90%. So that's why you should take columns. How many columns you should take? So cash inflows is the heading. Next columns, particulars, year 1, year 2, year 3, next year 4 to 6. Yes or no? Year 1, 2, 3, year 4 to 6. So particulars. So first, straight away we can take what? Contribution. What is the contribution? Malaysia, Lakshman. Sorry. Contribution. What is the contribution? Year 1 calculation. How many units? 12 lakhs into 33.33% into 80. Yes or no? 12 lakhs into 33.33% into 80. 320 lakhs. Year 2. Year 2. Year 2 capacity utilization, is it same or not? No, the capacity utilization is 66.66. So 640 lakhs. What about year 3? Capacity utilization is increasing. 864. Next year 4 to 6. 960 lakhs. Yes or no? If I commence the project, I'm able to get a contribution in year 1 320, year 2 640, year 3 864, year 4 to 6 960 lakhs. Contribution. Next what? Minus fixed cost. What is the fixed cost here? 240, 360, 480, 480. Yes or no? So now you will get what? Profit before depreciation tax. What is the profit before depreciation tax? First case 80 lakhs. Second 280 lakhs, 384 lakhs, 480 lakhs. Clear? So profit before depreciation tax minus what? Depreciation. If a depreciation is SLM method, then working note is not required. But here it is what? Written down value method. If it is written down value method, then working note is required for finding out depreciation and book salvage value at the end of the life. So take working note. So working note 1. Calculation of depreciation. Calculation of a depreciation. So asset cost. What is asset cost? 600 lakhs minus first year depreciation 200 lakhs minus second year depreciation minus second year depreciation. What is the second year depreciation? 400 lakhs into 133.32. So return on value 60, sorry, 2, 60, 68 minus third year 88.8, 88.88 lakhs. Next, what is the number? 1 177.79 minus what? Fourth year depreciation 59.25. Amount 118.54 minus fifth year 39.51, 79.03 minus sixth year depreciation 26.34. The amount, what is the amount? 52.69. 52.69 is the written down value at the end of what? Sixth year. At the end of a sixth year. Okay. So we should round off to lakhs. Yes or no? So that means if we take it as 53 lakhs. Done. Now take the depreciation. What is the depreciation for the first year? 200 lakhs. Next 133. 133. Next rounded off to lakhs. 89 lakhs. I'm sorry, here we should take year 4, 5, 6 because it is what? Written down value. Instead of year 4 to 6, we should take what? Year 4, year 5, year 6. Year 4, year 5, year 6. Because the method of a depreciation is what? Written down value. So that's why 960, 960, 480, 480. Okay, you add two columns from here, year 4, 5 and 6. What is the depreciation fourth year? 59. Fifth year 40. Next 26. Lakshman, what is the profit before tax? Minus 120. 147. Next 295. 421. 440. 454. Profit before tax. Next minus tax at the rate of 50%. So first year we got a loss. This loss can be set off with profit from another project, or else it can be carried forward to the next year and it will be set off with profit of the next year. So we can say what? Tax. So that means 60 is the tax savings. So the profit after tax would be minus 60. Okay. Capital bursting is, C category, because the reason is in some answers, if you go deep, the answer would change. Here I am taking the tax savings as 60. So minus 120 plus tax savings what? 60. So the overall is profit after tax minus 60. Yes or no? So there can be an alternative also. Okay. Here my assumption is I am getting a loss of minus 120 and this loss can be set off with profit from another project in the same year and I can save a tax of 60 lakhs. So there can be an alternative assumption. Let us assume there are no other projects. If there are no other projects, then I cannot save tax in first year. I have to carry forward this loss to the next year. That is minus 120 will be carried forward to the next year. And I will be saving tax next year. Not the, current year. I will be saving tax what? The next year. That means here we should take profit after tax minus 120. Profit after tax minus 120. But for the second year, the profit before tax is 147. 147 minus first year loss. What is the first year loss? 120. The overall taxable profit is 27 for the second year. And the tax for the second year is 27 into 50%. That is 13.5. Okay, are you getting my point? You can take n number of assumptions in capital bursting. If you apply the taxation complete knowledge, then answer might change. Okay. So when I go through the C inter FM capital bursting, CM inter capital bursting, and CMA final capital bursting, so the answers are different. So here my assumption is what? I'm setting off the loss with the profit of another project in the same year. So that's why I'm taking what? Tax savings in the same year. Okay, if you go through the number of problems, you might find a problem where tax savings will be considered in the second year. If they are taking tax savings in the second year, then what is the assumption? What is the assumption? There is no other project, so only one project is there. So that's why I'm carrying forward this loss to the next year. సో క్లియర్ అర్థమవుతుంది చెప్పింది. ఆన్సర్స్ అనేవి సేమ్ ఉండవు, చేంజ్ అవుతూ ఉంటాయి. మీరు ఎక్కువ ప్రాబ్లమ్స్ చేసే కొద్దీ క్యాపిటల్ బస్టింగ్లో కన్ఫ్యూజనే ఉంటుంది. బికాస్ ఒక్కొక్క చోట ఆన్సర్ ఒక్కొక్కలా ఉంటుంది, దానికి మళ్ళీ లాజిక్ ఉంటుంది, లాజిక్ ఏం లేకుండా ఉండదు. సో వాట్ ఇస్ ద లాజిక్ అంటే చెప్పాను కదా, ఇఫ్ ఐఎమ్ టేకింగ్ 60 in the same year, what is the logic? The loss is being set off with the profit of another project in the same year. If I am considering tax savings in the second year, then what is the assumption? There is no other project, I have only this project, so that means I have to carry forward this loss to the next year and I can save tax next year. Okay, so 60 and next 73.5, next okay, that's why if you ask ChatGPT also for the answer, you might get multiple answers, not the same answer. Okay, so 295 into 50%, 147.5. Next 210.5, 220, 227. So 73.5, 147.5, 210.5, 220, and next 227. Next add depreciation. Add depreciation. What is the depreciation? 200, 133, 89, 59, 40, 26. So next, what is the total? First case 140. Next 206.5, 236.5, 269.5, 260, 253. So the answer is not at over. In this question, the special point is, so we have a additional working capital investment. We are making an additional investment in working capital at the end of third year. Okay, so that is not the initial cash outflow, that is the cash outflow at the end of third year. And on investment in working capital, we cannot save tax, so that's why we have to reduce working capital outflow at the end. So what is the outflow at the end of third year? What is the working capital outflow? 100 lakhs. And the one more special point here is salvage value. One more point is salvage value. Okay, so here add working capital. Again I am adding working capital. What is that working capital? At the end of a sixth year, I will receive Overall, what is my cash inflow? Working capital. In 0 year, working capital investment is 150, and in third year, 100 lakhs. Overall, 250 lakhs will be inflow at the end of a sixth year. Am I clear? Done. 130. Sorry, 250. And the one more special point here, it is salvage value. What is the salvage value? Salvage value. So this point is important. Salvage value. Okay. In question they have specifically mentioned what they have mentioned here. Terminal value for the fixed asset may be taken at 10%. Terminal value at the end of the life value will be taken as 10%. That means 600 lakhs into 10%, that is 60 lakhs. So 60 lakhs is the salvage value. Okay. Sometimes you might take 60 lakhs at the end of the sixth year. Then your assumption is there no tax is applicable on capital gain or a loss. Generally, this is not a practically not correct assumption, because general tax is applicable on capital gain or a loss. Okay. But in some questions they will take directly 60. So, but here, what is the written down value at the end of a sixth year? 53 lakhs. Book salvage value 53, but the actual salvage value is 60. That means I am getting a gain. What is the gain? 7 lakhs. On that 7 lakhs capital gain, I should pay 50% tax. So 3.5 will be paid as a capital gains tax. That means even though I am selling asset at the rate of 60 lakhs, so the net inflow is 60 lakhs minus what? 3.5 lakhs, that is equal to what? 56.5. So take working note 2. Working note 2, terminal cash inflow. Working note 2, terminal cash inflow. Terminal cash inflow. Working note 2. Terminal cash inflow. Working note 2. Sale value. What is the sale value? 60 lakhs. 600 lakhs into 10% minus book value. What is the book value? 53 lakhs. Capital gain 7 lakhs. Capital gain tax 3.5 lakhs. Okay. So terminal cash inflow is equal to terminal cash inflow is equal to 60 lakhs minus 3.5 lakhs. That is 56.5 lakhs. Done. 56.5. So at the end of the sixth year, I am going to get 56.5. In this question, you might forget these three. So we have a additional working capital investment at the end of a third year. We receive working capital 250 lakhs at the end of a sixth year. And at the end of the sixth year, we receive a salvage value of 56.5, not 60 lakhs. Okay. So the overall So 140 206.5 140 206.5 next 136.5 269.5 260 550 9.5. So if I make investment of 750 lakhs as on today, I'm going to get 140 at the end of first year, 206.5 at the second year, 136.5 at the end of third year, 269.5 at the end of fourth year, 260 at the end of fifth year, 559.5 at the end of sixth year. So in this question, important point to be noted is the rate of a depreciation. The method of a depreciation is written down value. Method of depreciation, written down value. And next, the second point to be noted is additional working capital investment at the end of a third year. So that outflow is at the end of a third year. And next, working capital inflow at the end of sixth year. Overall, 150 plus 100, 250. And the one more crucial point is salvage value, not 60 lakhs. We should take 60 lakhs minus what? Capital gains tax. First, suppose in this question, the terminal value, I mean sale value at the end of a sixth year is not 60 lakhs, it is 50 lakhs. Then what is my answer? If sale value is 50 lakhs, if sale value is 50 lakhs, then what? Simple, I will get capital loss. What is the capital loss? 3 lakhs. If I get capital loss, I can save tax. 1.5 lakhs tax will be saved. So the terminal cash inflow is equal to 50 lakhs plus 1.5 tax saving, overall 51.5 lakhs. Okay, clear? Okay. And next, the last step is what? Finding out NPV. That is simple. Year 1 cash inflow 140. Next, 2 not 7 130 7 270 260 559.5. We are bringing to the present value and overall NPV positive. So accept the project. Calculate NPV. Calculate NPV. So clear, what is the answer? 140? 141, huh? 140? Okay. 141. See the next question. Question number 16. Question number 16. Question number 16. A product is currently manufactured on a machine that is not fully depreciated for tax purposes and has a book value of rupees 70,000. It was purchased for rupees 2,10,000 20 years ago. The 2,10,000 is not relevant for decision making because it is a sunk cost which was already incurred and not relevant for future decision making. The cost of a product are as follows: unit cost, direct labor, indirect labor, other variable overhead, fixed overhead. In the past year, 10,000 units were 10,000 units were produced. It is expected that with suitable repairs, the old machine can be used indefinitely in future. The repairs are expected to average rupees 75,000 per year. An equipment manufacturer has offered to accept the old machine as a trade-in for a new equipment. The new machine would cost rupees 420,000 before allowing for rupees 1,05,000 for the old equipment. The project costs associated with the new machine are as follows: direct labor, indirect labor, other variable overhead, fixed overhead. The fixed overhead costs are allocated for other departments plus the depreciation of the equipment. In this question, the new learning point is the fixed overhead costs are allocated for other departments plus the depreciation of the equipment. So this is the special point in this question. The old machine can be sold now for rupees 50,000 in the open market. The new machine has an expected life of 10 years and salvage value of rupees 20,000 at that time. The current corporate income tax is assumed to be 50%. For the cost of the new machine and the book value of old machine may be depreciated in 10 years. For the purpose of tax, cost of a new machine and the book value of a old machine would be depreciated in 10 years. The minimum required rate is 10%. It is expected that the future demand of the product will stay at 10,000 units per year. PVF factor for 9 years 5.759. PV factor at the rate of 10% at 10th year 0.386. Should the equipment be purchased? Should the equipment be purchased? Once again, we shall go through the question. Already we had a machine. We bought this machine how many years back? 20 years back. What is the cost of a machine? 2,10,000. So 2,10,000, whether it is relevant or not relevant? Not relevant for decision making. What is the book value? 70,000 is the book value. The cost of the product are as follows. Okay. If I use the old machine, direct labor 28, indirect labor 14, other variable overhead 10.5, fixed overhead 17.5. So overall cost of the product is 70. In the past year, how many units were produced? 10,000 units. So if I make a suitable repairs, the old machine can be used for indefinite period and the repair cost per year is 75,000. Okay. I can use the old machine, but to use the old machine I have to incur 75,000 every year. And by using old machine I can produce 10,000 units every year and the cost of a unit is 70 rupees overall. Okay. So the equipment manufacturer has offered to accept the old machine as a trade-in for a new equipment. So we have an offer. He is offering a new equipment in exchange of old machine. I can use old machine, but I have another offer. What is the another offer? Another offer is equipment manufacturer offering a new machine for the exchange of old machine. New machine cost 4,20,000 before allowing rupees 1,05,000 for the old equipment. That means for exchange, old equipment value is 1,05,000. Okay. That means my net outflow, if I purchase new equipment, my net outflow will be 4,20,000 minus 1,05,000. 3,50,000. That means if I decide to buy the new equipment, then my outflow will be what? 3,15,000. 3,15,000 is the outflow. The project costs associated with the new machine are as follows. What is the direct labor? 14. Indirect labor 20. And next other variable overhead 7. Fixed overhead 22.75. And the overall cost is 64.75. By using new equipment also I can produce only 10,000 units. So what is the benefit I am going to get? Reduction in unit cost. Yes or no? If I continue old machine, the unit cost is 70. If I use new machine, unit cost is 64.75. That means I am able to save cost per unit. Okay. The main benefit. Forget about the amount. So what is the benefit I am going to get if I purchase a new equipment? Cost per unit will be saved. So that is the benefit. The old machine can be sold now for rupees 50,000 in the open market. Is it a relevant information or not relevant? When do I sell old machine? If I decided to buy the new machine, then I will sell old machine. Yes or no? Okay. So if I purchase new machine, then why would I sell the old machine for rupees 50,000 in the open market? Because I have an option to exchange the old machine for rupees 1,05,000. So what I will do? I will exchange old machine for rupees 1,05,000. So that's why this 50,000 is the irrelevant information, not relevant. And next, the salvage value. The new machine has an expected life for 10 years and the salvage value of a new machine. What is the salvage value of a new machine? 20,000 at that time. The current corporate income tax is assumed to be 50%. Okay. For the purpose of tax, cost of a new machine and old machine can be depreciated in how many years? 10 years. So the minimum required rate 10%. So the future demand will stay at 10,000 units. Okay. So here the important point is allocation of a fixed overhead. What is the important point? what is this allocated fixed overhead? Okay, what is this allocated fixed overhead? In overhead chapter, you might have seen 5 steps. The first step is estimation of overhead. Second step, allocation. Third, apportionment. Fourth, reapportionment. And fifth, absorption. Absorption. Okay. So let us assume. So recently we have shifted to this J&T building. Yes or no? Total we have a 6 classrooms. How many classrooms? 6 classrooms. Right now we have started only CMA final. Yes or no? Okay. So total 4 floors plus cellar we have. Now, right now we are conducting only CMA final, group 3 and group 4 classes. The entire rent will be allocated to CMA final batch. Yes or no? Entire rent will be allocated to this CMA final batch. Let us assume the CMA final batch is a separate cost center. Separate cost center. Okay. So cost center can be a department, location or a person for which the cost is ascertained separately. So entire rent will be allocated to one particular batch, that is CMA final. For suppose we are going to start CA final classes after Pongal. Okay. If I am starting CA final classes after Pongal, so my rent is going to increase or not? Whether my rent is going to increase or not? No, my rent is not going to increase because the reason is I'm using right now I'm using only 2 classrooms. I have another 4 classrooms. Yes or no? So next point. Okay. So if I'm using only what? One, I mean, if I start CA final classes, then the rent is not relevant for decision making. Yes or no? But from February month, I will be allocating this rental for CMA final batch and CA final batch. That is for costing purpose. For costing purpose, I might allocate some portion of a rent to CA final batch as well. But in reality, my rental expenditure is not increasing just because I start CA final batch. Yes or no? Are you getting my point? My rent is increasing or not? No. And next, in the month of March, I might start CA inter batch. My rent is going to increase or not? No. I'm going to start CMA inter. My rent is going to increase or not? No. But I might allocate some portion of a rent to CA inter batch, CMA inter batch, CA final for costing purpose. Okay. But in real terms, my rental is not going to increase. That is a mere allocation. Mere allocation. Likewise, here fixed overhead allocated for the old machine is 17.5 and the new machine is 22.75. That is a mere allocation. Kevala allocation maatrame. So, okay. For suppose if I have no new equipment, this cost might have been allocated to another machine. For suppose if I am not going to start CA final batch, CA inter and CMA inter, then I will charge entire rent to CMA final batch. Yes or no? Okay. If I start CA final, then I will be sharing some portion of cost to the CA final batch. But actually my rental expenditure is not increasing. మీకు అర్థమవుతున్నది కేవలం అలొకేషన్ మాత్రమే. And that allocation is being done for costing purpose. Okay. So likewise ఇక్కడ 22.75 ఏదైతుందో ఫిక్స్డ్ ఓవర్హెడ్ allocation, that is not relevant for decision making. Why it is not relevant? As I am going to purchase this new equipment, you are allocating 22.75. If I am not purchasing that new equipment, this cost will be allocated to some other machine or existing machine. మీకు అర్థమవుతుందా? ఇప్పుడు నేను ఇక్కడ ఎలా అయితే మొత్తం రెంటల్ని దేనికి అలొకేట్ చేస్తున్నా, సిఎంఐ ఫైనల్ బ్యాచ్కి. కొత్త బ్యాచ్ స్టార్ట్ చేస్తే, ఒకవేళ న్యూ బ్యాచ్ స్టార్ట్ చేస్తే, ఐ విల్ బి అలొకేటింగ్ కాస్ట్ టు బోత్ ఎగ్జిస్టింగ్ అండ్ న్యూ వన్. ఓకే, బట్ మై రెంటల్ ఎక్స్పెండిచర్ ఈజ్ ఇంక్రీజింగ్ ఆర్ నాట్? నాట్ ఇంక్రీజింగ్. ఒకవేళ న్యూ బ్యాచ్ స్టార్ట్ చేయకపోతే ఏంటి? The entire overhead is charged to the existing batch. Yes or no? సో అందుకని ఇక్కడ ఈ ఫిక్స్డ్ ఓవర్ రేట్ అనేది ఏంటి, నాట్ రిలవెంట్ ఫర్ డెసిషన్ మేకింగ్. అంటే ఇక్కడ వాట్ ఆర్ ద కాస్ట్ సేవింగ్? కాస్ట్ సేవింగ్ ఈజ్ నాట్ ఈక్వల్ టు 70 minus 64.75. We should consider only what? Direct labor, indirect labor, other variable overhead. ఈ 3 మాత్రమే రిలవెంట్. మీకు అర్థమవుతుందా? For example, in this building, total 6 machineries can be installed. Right now, only 1 machinery was installed. Now, I will charge entire rent to this 1 machine. If I purchase second machine, then I will allocate rent to 2 machines. If I purchase 6 machines, I will allocate rent to 6 machines. That is a mere allocation. But already I have 1 machine. If I am going to purchase second machine, my rental is going to increase or not? No. Then that rent allocation is relevant for decision making or not? Not relevant for decision making. So that's why ఇక్కడ మనం కన్సిడర్ చేయాల్సింది ఏంటమ్మా, ఓన్లీ 28, 14, 10.5. సో టోటల్ 52.5. అండ్ ఇక్కడ 14, 21, 7, 42. So if I purchase new equipment, my cost is 42. So old case 52.5. That means overall my savings is 10.5. So this is the new point, and this is a special point in this question, the only special point. Okay, so clear? సో ఇక్కడ ఏంటమ్మా, ఫిక్స్డ్ ఓవర్ హెడ్ అలొకేషన్ ఏంటి? ఇర్రెలవెంట్. ఇర్రెలవెంట్ ఎందుకు అర్థం అవుతుందా? న్యూ ఎక్విప్మెంట్ కొంటున్నాను కాబట్టి నువ్వు అలొకేట్ చేస్తావు, కొనకపోతే దట్ విల్ బి అలొకేటెడ్ టు ద ఎగ్జిస్టింగ్ వన్. సో దట్స్ ఇట్. నౌ లెట్ us come to the solution. First, initial outflow. What is the initial outflow? New equipment cost 4,20,000 minus old equipment cost 1,05,000. What is the net outflow? 3,15,000 is the net outflow. Okay, and one more point to be considered is, what is the book value of old equipment? 70,000. But I am exchanging the machine for rupees 1,05,000. So I will get a capital gain. What is the capital gain? 1,05,000 minus 70,000, 35,000 into tax 50%. So I have to pay capital gains tax 17,500. So my initial outflow is 3,32,500. Clear? 3,32,500. Next, cash inflow. Incremental cash inflow. Incremental cash inflow. What is the savings in variable cost? 10,000 into 52.5 minus 42. The overall savings is 1,05,000. Not only this 1,05,000, the other saving is repair cost. If I have to use the old machine, I have to incur a repair cost of 75,000. So that's why my overall savings, what is the overall savings? 1,05,000 plus 75,000, 1,80,000. If I purchase new equipment, every year I am going to save 1,80,000. If I save 1,80,000, then income tax department will ask me to pay tax. Okay, yes or no? So that's why this 1,80,000 will be considered as incremental profit before depreciation and tax. Incremental when compared to old machine. Okay, my profit before depreciation tax will increase by 1,80,000. Incremental profit before depreciation and tax 1,80,000. Incremental PBDT minus what? Incremental depreciation. I should take only incremental depreciation. What is my incremental depreciation? Depreciation on a new machine. What is the depreciation on new machine? Cost of a new machine is 4,20,000 minus salvage value 20,000. Okay. So be careful with this calculation. 4,20,000 minus 20,000 divided by 10. So that means 40,000 is the depreciation on a new equipment minus old equipment depreciation. What is the old equipment book value? 70,000 divided by 10. 7,000. If I continue the old machine, my depreciation is 7,000, but new machine depreciation 40,000. What is my incremental depreciation? 33,000. Okay. So 1,47,000 minus tax rate at the rate of 50%. 73,500. Profit after tax 73,500. Add depreciation. Annual cash inflow 1,06,500. Year 129 1,06,500. Year 10 1,06,500 plus 20,000 salvage value. At the end of the 10th year, we are not considering capital gains tax. Why? Because book salvage value 20, actual salvage value is also 20. No capital gain or capital loss. So NPV is 3,29,662. 329,662. So since NPV is positive, it is advised to replace the machine. So in this question, what is the special point? Fixed overheads. Irrelevant. So clear? Fixed overhead is not relevant for decision making. So last question special point enti. What was the last question special point? Additional working capital investment, salvage value. Okay, ee question lo special point enti. Fixed overhead allocation is not relevant for decision making. So clear?